Good morning. It is Friday, December 31st. You know what that means. Happy New Year's Eve, everyone. This is Yahoo Finance Live. I'm Julie Hyman. That's Brian Sazi. He is pumped to be closing out 2021 and getting started for 2022. What do we see this year? Well, we're seeing futures down a little bit here today, so ending the year on a lackluster note, but it's been a big one, right? For the major averages, 70 S&P 500 record highs, crypto going mainstream, and AMC, Brian Sazi, I know you can't believe it, ending the year with a more than 3,000% gain. We're going to take a look at the big market moves and themes of 2021 and ahead to the next big ones for 2022. Meanwhile, the challenging year for airlines is set for a turbulent landing. Adam Shapiro is going to join us with a look at the latest cancellations affecting that industry. And one of the year's best performers, riding atop the S&P 500 for much of the year, it slipped back a bit. It's now down almost 50% from its peak. We're going to talk about what's next for Moderna and what other biotech stocks could be tops in 2022. But first this morning, the latest on the coronavirus. As we have been doing all week, we begin with Anjali Khemlani this morning and what we are seeing in terms of coronavirus cases versus hospitalizations. Good morning.
Good morning, Julie. You always know it's a bad news when you start off with me. We've got news that the U.S. has set another record, unfortunately, with spiking cases, now nearing 600,000 cases in a single day yesterday. Another new record for the country, moving the daily average for the week to 355,000 per day. And that, again, is another world record. This is really comprising a majority of the cases globally still. Meanwhile, over in South Africa, we know that the Omicron wave has sort of faltered out. So that is some good news to look forward to, that this will eventually pass. But until then, we are continuing to gain cases. And many experts say it might be undercounting considering how many at-home rapid tests are being done in the recent past. And meanwhile, looking at hospitalizations, comparatively still pretty low, even though we are seeing some health systems under pressure, because even though the level of severity is not as much per se right now, we do still see cases going in either because of COVID or COVID being caught as individuals go into the hospital. That is particularly true for children right now, which we are seeing a significant rise in hospitalizations right now. And also just another note that the treatment for COVID when those individuals are in the hospital has sort of changed. We know that monoclonal antibodies haven't been as effective against Omicron, so it's caused the NIH to give out some new guidelines. And so what we've seen is that the new guidelines entail favoring Pfizer's new oral pill that recently got emergency use authorization, as well as GlaxoSmithKline's monoclonal antibody, the only one that seems to be working still. We also see Gilead's remdesivir on the list, as well as Merck's oral pill, which also, if you recall, did recently get emergency use authorization, but an asterisk there, as Merck's pill is being really used as a last resort. The NIH saying only to use it when all the other options are exhausted, and it's not recommended for pregnant individuals. Also, a note that this pill is only useful for those 18 and up, while others are authorized for younger patients. So just a quick note there on what's changing as we deal with this new interesting variant. Back to you.
Yeah, and it's not all bad news, to be clear, in terms of the fact that there are at least some more treatment options, et cetera. Let's go back to hospitalizations for a minute, Anjali, because as we were talking about, there is that uptick in children's hospitalizations with this latest wave. But we've also been getting information about why those children are being hospitalized, which I think is an important distinction. It's not necessarily because of COVID, right?
That's right. Yes, to your point, and that's what I was mentioning, is that really we're seeing hospitalizations happen when people are getting sick, and COVID is being caught as either one of the symptoms or one of the reasons why they're there. There are some kids going in because of COVID, but largely speaking, it's being caught in the hospitals, and that's where we're getting the reports from. One of the most well-known virologist, Dr. Paul Offit, has noted that in his hospital specifically, a lot of these kids who are coming in are unvaccinated, and that's including that 5 and up range where we do have, vaccines authorized. And it's not just that the kids are unvaccinated, but also the entire family is. So really vulnerable individuals ending up in the hospital. On that note about the kids, though, 5 to 11, 5 to 12, that age range, the FDA is set to take a look at boosters for this age group. There's a meeting set next week to discuss, and that should open the door to really more protection there. So that's another thing, a new development to really look forward to in the new year.
It is, even as vaccination rates among kids are still running behind perhaps where authorities want them to be. But we're going to continue watching that numbers. And definitely that would be big news if there is the booster thumbs up for those kids. Thanks, Anjali. Happy New Year. Thanks for all of your reporting this year on this important topic. All right, we want to take a look at the year that has been for the market. So I want to run through the numbers for you on the Yahoo Finance Interactive. If you will join me, we'll take a look here. First, let's start with the major averages and what we have seen here. The Dow up about 19% year to date. The NASDAQ up 22% year to date, but it's the S&P 500 that's been the winner here. It's up 27%, as I mentioned, has closed at record highs 70 times over the course of the year, which has been pretty remarkable. And what's also been remarkable is that even though this is obviously a pretty large gain for stocks here, and it's coming, as we have seen now, a recovery last year and then this year in stocks. But if you look at other asset classes, we've seen outperformance elsewhere as well. Before we get to that outperformance, do want to mention what we have seen in bonds. Now, you can kind of ignore the percentage gain here because you don't look at a percentage gain in bonds on the yield basis. What we have seen is about a 60 basis point gain in the 10-year this year. That's the largest one-year yield gain since 2013. So even though we are finishing the year well below many forecasts for 2% yield, it's still a pretty big move over the course of the year. So that's something to keep in mind. US dollar index up about 6.6% year to date. This strength as well has been unexpected by many. So that's something that has been important this year. And what's interesting about that gain is that the gain in the dollar usually comes at the expense of oil and other commodities. That hasn't happened this year. Crude oil futures are up some 60% year to date. So that's been one of the other big winners. And then we got to look at Bitcoin as well. Bitcoin up 63% year to date. So well down off its highs. We know this is a very volatile asset. And some of the other cryptocurrencies have performed even better, much better in some cases of some of the smaller coins. But Bitcoin this year has really been characterized by much broader adoption, seemingly, including among institutions. All right, bear with me here, switching on over. Want to take a look at some other themes that we've been watching this year. Here's what's going on yesterday for the sectors within the S&P 500, but we want to switch that on over to year to date. So another interesting thing about this year is, even though we talk a lot about how large cap contributed so very much to the gains over the course of the year, it really has been a broad-based rally in terms of sectors within the S&P 500. And it's not tech that has led the pack on a percentage basis. It's energy. That has been consistent here, along with those oil prices. So the XLE, that's the one on the upper left here, is up 46%. Real estate up 41%. XLK is the tech sector, 34%. But it's the XLC on the bottom, by the way, that includes communication services, quote unquote, which is things like Meta. It's up 16.7% year to date. And then as well, if you look at the NASDAQ heavyweights year to date, you can see, yes, certainly it is a valid point that large cap tech has contributed disproportionately, as it always does, to the rally because of how these stocks are weighted. The largest stocks in the NASDAQ 100 have done remarkably well. Apple 34%, Microsoft 53%, Google 67%, Tesla 52%, even Amazon 3.6%. Because it's so large, it gives a big gain. NVIDIA 127% is what we have seen from that stock for the year to date, which is also just an incredible number. And then finally, this one is for you, Mr. Sazi. Let's take a look at the meme stocks just for fun. You know, these guys have waned in the latter part of the year, but nonetheless, we have still seen some incredible gains for them. And let's just look at the two tops ones, right? As we look at the year-to-date performance, you can see here about more than 12%, 1,200%. for AMC, despite coming down quite a bit from its high, Saz. And then GameStop still up more than 700%. So that's just touching on all of the many, many things that we've talked about over the course of the year, Saz. But hopefully that hit the highs for you.
It certainly did, Julie. You were leaving it all in the field in the final show of the year. That was your most impressive market tour year to date. Very good stuff. I'll just quickly head here. I'm looking at deal activity. The data is starting to roll in from Refinitiv. $5.8 trillion in deals done this year. That is up 64% year over year, up about the fastest pace since the mid-90s. Deal value up 54% versus 2019, aka pre-pandemic. And this has been a year of really some impressive deals as companies and sponsors take advantage of the still cheap money environment. Look, you have Coca-Cola spending $5.7 billion on sports drink brand Body Armor. You have Amazon buying MGM Studios for about $8.5 billion. And then, Apollo, our parent company, buying Yahoo, which is us, for $5 billion this year. So there's been a lot of headline grabbing and buzzy deals, and a lot of IPO bankers that I talked to, they expect another year. It may not be as strong next year as this year, just given the fact you may see rates increase thanks to the Federal Reserve. But that first half of next year, you could see a nice upswing in deal activity.
Yeah, we're going to talk about the IPO pipeline in the second hour of the show today, and whether that momentum is indeed set to continue and for how long. But we already have seen some of that momentum rolling over, right? As we have seen, and this is a theme that we started to talk about yesterday, that really in the waning part of the year here, we have seen all of those sort of hot money, thirsty cash names, whatever you want to call them, from the meme stocks to the new entrants into the market, whether they be SPACs or IPOs. A lot of that momentum has started to cool, even as we've still seen those huge double-digit gains for many of the large cap tech names, the growth names, that long-awaited value over growth didn't quite materialize. Like, what's interesting here, Saz, to me is everybody kept talking about, oh, value is going to come, value is going to come. And it has to some extent, right? Financials outperformed on the year, but growth didn't underperform either. So it didn't really seem to be an either or situation in 2021.
Well, I think what you've seen, Julie, really is a melt up in the markets where everyone sees value. Every single stock, for the most part, looks like a great value. Look at GameStop. You were still running through the charts there. AMC, investors coming into the year apparently saw those as great values. Not so much the past few months, but you see money just chasing money out there right now.
Yeah, it definitely feels that way. And that also means it's been tougher for stock pickers, as we've seen some stories perking up here at the end of the year. All right, we're going to take a quick break. As we do, of course, we are going to take a look at some of the New Year's celebrations around the globe, even though some of them, many of them, have been scaled back. This is not a scaled back fireworks display happening in Sydney.
Wow.
Yeah, they don't mess around. I guess that's pretty impressive. All right, we're going to take a quick break. We'll be back with more.
The U.S. economy is slowing down a bit due to the spread of the Omicron variant. It could have ramifications for Fed policy next year and the direction of the U.S. dollar. Christopher Vecchio is a senior strategist at dailyfx.com and joins us now. Chris, Happy New Year to you. As Julie mentioned at the top of the show, it has been a pretty decent year for the dollar. What's your outlook for next year?
It looks like that the dollar still has a chance to further its gains as we head into early 2022, in part because of the juxtaposition between Fed policy and the policy of other major central banks, mainly the European Central Bank and the Bank of Japan. Rates markets have pulled forward rate hike expectations to March 2022 for the first rate hike per Fed funds futures. But we've seen both a hawkish and a dovish twist in a sense, whereby the market's now saying, yes, we'll get rate hikes sooner. And as a result, we may need fewer rate hikes for the Fed to accomplish its goals. So right now, the dollar index has been consolidating over the last few weeks. Not surprised as it works off the longest net long position in the futures market since October 2019. Historically speaking, December hasn't been a great month for the US dollar. But as the calendar turns into 2022, we do think that the dollar still has more upside from here, looking at that 100 handle before June 2022.
Oh, wow. And what does the trajectory of the dollar tend to look like once the Fed actually starts raising rates?
So it really depends on the relative position of Fed policy compared to other central banks. But importantly, right now, the dollar still has this 2-5-10 butterfly that's widening. And historically speaking, as you look back into the QE era of the 2010s, that was actually good for greenback strength. So early on, the first few rate hikes can be good. It's when you get into the second half of the rate hike cycle that they tend not to have the same type of positive impact for the US dollar. As by and large, that's expected, it's priced in. And moreover, as the Fed rate hike cycle matures, other central banks begin to play catch up.
And Chris, do you see any wild swings in international currencies once the Fed does start hiking rates?
Sure. I think emerging markets right now are very vulnerable. I think that when you look at a country like Turkey, for example, even if they've implemented some of these measures to shy away from speculation among domestic currency holders, it's really going to put a lot of pressure on their fiscal position. It looks like Turkey's burned through a significant portion of their foreign assets over the past 2 weeks to prop up the value of the lira. Even though the Turkish lira rallied by 50% last week, it's still down over 40% year to date versus the US dollar. Same situation against the euro. And so I see a Turkish lira, I see a South African rand, a lot of pressure there as external financing conditions become more and more difficult for these emerging market currencies, not dissimilar from what we've seen during previous Fed hiking cycles.
You know, I want to ask a little bit more about the Turkish lira because it has been such, we saw this a couple of years ago, right? And now seeing this again, this just wild move in the Turkish lira. And you talked a little bit about it in the broader context of emerging markets, but how are we to view, particularly those of us who are not currency traders, how are we to view the Turkish situation? Like, is there a sort of bigger takeaway, or is this story just kind of a curiosity?
No, this is a full-blown currency crisis. They have rising external debt, wide bond premiums, rising inflation expectations, record low real yields. I mean, they check every single box in the textbook for an emerging market currency in crisis. So this is a situation that's going to get worse before it gets better. For some reason, Turkish President Recep Erdogan has this fascination with the notion that lower interest rates will not lead to higher inflation. That's news to mostly anyone in macroeconomics. I certainly haven't read that in any textbook. Don't recall reading that during the CFA charter studies. But good luck to him. I think it's going to cost a lot of social capital there. I think that there's more and more political pressure in Turkey. And the central bank has lost any semblance of independence under Governor Kavsioglu, if I'm pronouncing that correctly.
Yeah, I think you're right, Chris. I don't think you'll find any of that stuff in those CFA giant books. But look, interesting, we've seen a recent push higher in the dollar, and at the same time, Bitcoin prices have been under pressure there. Is any correlation?
I don't really think so. Bitcoin prices have been falling across the board against a number of major currencies, in part because we're starting to see the creep in of the expectation that liquidity conditions will become a little bit more difficult henceforth. Listen, 2021 was a banner year for stimulus. We had rising fiscal deficits around the world. We had monetary policy that was still incredibly stimulative. But when you look forward down the line, in the UK, for example, austerity already appears to be underway. In the US, We're having questions over the Build Back Better program. We have the Fed on the verge of a hiking cycle, And then when you look further into 2022, the midterms are right around the corner. And as things stand right now, it doesn't look like Democrats will retain control of the House, of the Senate, which means we could be back in a situation like we were in the early 2010s when we had a Democrat in the White House, Republicans controlling both houses of Congress. And ultimately, that means potentially less deficit spending. So risk impulses are starting to turn the corner. I think actually one of the reasons why when we get this question, do you see any meme stocks or altcoins performing well in 2022? That speculative fervor may die down to a certain extent as the year goes on.
So what does that mean specifically for Bitcoin then as well? Or if we broaden out and say cryptocurrencies more broadly, do you have a Bitcoin target, for example? Do you think institutions who may have been selling at the end of this year are going to come back in January?
So what we've noticed over the course of 2021 is that on-chain transactions and the number of active wallets have actually fallen little by little over the course of the year. They peaked right around the GameStop and AMC frenzy in early January, February. And so it does look like Bitcoin could have a little bit more downside from here, perhaps down to 42,000 once more. Again, the lows that were tested in early December. But I think that Bitcoin and the broader cryptocurrency market is going through a moment of reflection here, a bit of a crisis of faith right now, because for much of this year, we've heard all these thought leaders, all these individuals who have been right about their Bitcoin prognostications in the past, telling us that we're going to get to 100,000 by year end. Now, technically, that's still possible. I guess there are, 15 hours left in this year. So I can't say 100,000 is out of the question, but I think it's really unlikely. And so a lot of these people who have been, more or less the flag leaders standing at the front of the marching band, they now look wrong. And this could cause some individuals who have jumped into the market late to question whether or not they should continue to participate. They didn't get the gains that they were seeking. Ultimately, I do think there's a little bit of a sentiment letdown right now in cryptocurrency. So further unwind from here wouldn't be a surprise, but Bitcoin likely to be the least impacted during this unwind. It's those secondary and tertiary, the derivative altcoins, meme coins, if you want to call them that. Those are the ones that will see deeper and deeper losses. I'd be very surprised if Dogecoin and Shiba Inu have a good year unless someone like Elon Musk is pumping them on Twitter.
Yeah, 15 hours left, Chris. Bitcoin can still hit 100,000, and I might win the $500 million Powerball this weekend. Both very, very likely. Chris Vecchio, senior strategist at dailyfx.com. We'll check you later. All right,
Thanks so much for having me. Happy New Year.
Yeah, of course. You bet it, bud. The market doesn't know it's New Year's Eve. We're back with a few top trending tickers ahead of the opening bell on Wall Street. Stay tuned.
This is Yahoo Finance Live. We are setting up for a bit of a down day for the final trading session of 2021. All three major averages pulling back just a bit, but to be fair, it's been a good year. People are probably okay with this being a little bit negative on the last day, and it looks like we are setting up for that so-called Santa Claus Rally, right? Because we're still higher on the week. We'll see what happens the first couple trading days of the year. Let's take a look at a couple of potential movers or just stocks that we have been watching in today's session. We got the news late yesterday that Advanced Micro Devices, which is acquiring its peer Xilinx for $35 billion, that there would be a delay in the closing of that. Before, the two had planned to close at the end of this year. Now it looks like it's being pushed back to the first quarter of 2022. We are seeing Xilinx shares pull back a little bit. And it feels like to me, Saz, that this is not the only deal this is happening to. We are seeing a little bit of a delay in some deals. I don't know if there's a big takeaway there, if regulators are being tougher across the board, or if it's just there are some specific individual cases.
I think in the case, well, let's keep in mind, this Xilinx deal with AMD, that was announced, I believe, in late 2020. It is a very big acquisition for AMD, $35 billion. It will, should it close, fundamentally transform what they do, make the company even more of a powerhouse. My sense of the matter is, and I know Lisa Su, the CEO of AMD, has been working very hard to get this deal closed. I think it just boils down to getting approval from Chinese authorities, and that is taking a little bit longer than I believe they would have liked to see. But I will note this, even with no Xilinx in the mix at AMD, AMD right now has been at the top of its game with its products. I mean, it is a major market share taker. Should this deal even fall through, AMD is still winning right now in the spaces it's supposed to win in.
Yeah, good point. And of course, there's some other pending chip deals as well that we have been watching. We are also, or you are watching, shares of SoFi, which was near the tops of our Yahoo Finance trending ticker list yesterday, continues to kind of linger there today. What's up with SoFi? What's going on here?
Yeah, I'll put this under the hashtag wacky movers list, Julie. Yesterday, SoFi shares popped up about over 10%. No real news here, and Jared Blickery did mention to us, still no news here this morning. Genius Sports, another SPAC name, up close to 10% yesterday. Still seeing some action here on our platform. IronSource, Payoneer. Interesting day out of the blue, Julie, for all things SPAC stocks.
And another stock that we like to talk about a lot is Peloton. It looks like the stock is getting a downgrade from JMP, which cut the stock to a market perform from outperform on concern that December quarter is not going well, which I think is not a surprise to either of us. We've been talking a lot about some of the negative trends for the company.
Yeah, no, I have to pull up this report, Julie. I want to see if they linked to my story earlier in the week on Google search trends being under pressure here for Peloton. It's hard. I think the consensus has now formed that Peloton is having a tough holiday quarter. Estimates are probably still too high, and now there's, I think, whispers on the street that they come out here and miss on earnings in a couple weeks.
Yeah, this data that is cited in this report in particular is similar web traffic information that we are seeing a decline here in traffic and searches for Peloton, which is something that you talked about as well, and Aaron Kessler, another analyst, talked about as well. So all of this seeming to point in the same direction. All right, we're going to pause here for the opening bell on this December 31st, 2021.
Did we find out who that guy is, Julie?
We didn't. This is what I keep wondering. He's got on a festive tie. And obviously, he's got the energy to match.
He's the Vanna White of the NYSE. I mean, he just unveils like the people on the board.
Yes, he did. And he has, as all this week has been very excited. We are going to have to figure out who that is for sure. Let's take a look at what's going on with stocks here as we get underway this morning. I don't know what else to say. We are seeing a little bit of a downdraft here for stocks. We want to bring in Jared Blickery here, who's been watching all the action, of course, not just today, but for the year alongside us. Jared, I talked at the top of the show about some of the ongoing themes and big moves that we've been watching. How about you? What are you watching?
Well, I was watching you earlier. You did a fantastic job. Way to close out the year. And let me just maybe add to the discussion here a little bit. First, let's go over the morning's price action. Not going to spend a lot of time on this because not a lot happening. And not a lot is supposed to happen. We talk about the low volatility during this time of year. See the Dow Jones down a whopping 13 points here. But also, we talk about the Santa Claus Rally, and that has positive seasonality. The last day of the year has actually been pretty bearish over the last 20 years. So wouldn't be surprised to see a little bit of a downdraft today, but the losses, not really seeing any big outliers for the most part. 2018 might have been around there. I think it was pretty dicey around Christmas, but things had kind of calmed down. But for the most part, don't really expect too much to happen today. Here's the S&P 500 up 2 basis points. So we're going to call that break even. Bond market also pretty quiet. So let's just skip to the Wi-Fi Interactive and a couple of observations here. I want to do a month to date versus a year to date comparison. Now, if we go to a month to date in the NASDAQ 100, we have quite a bit of green. I think it's more instructive to look at some of the losers as opposed to the winners. DocuSign down 33%. Lucid, which we're going to find out in a second, and as you pointed out before, is the best performing NASDAQ 100 stock this year, having only been added a couple months ago. It is the second worst this month. Moderna, one of the best, also off 20%. JD.com, that's a Chinese stock, another story. But Peloton down 12% as well. And as we know, that is the worst performing stock of the year. But I think it's instructive because when I was mentioning Moderna and Lucid before, because we have seen a lot of profits given back from some earlier I would say, bellwether winners of the year. So if we take a look at the sector action, we have energy and real estate, both over 40%. By the way, this is the best year ever for both energy and real estate. It's the best year ever for tech since last year. So not a lot of history being made right there. That's up 34%. But let's just see what happened this month, because we're still looking at a defensive setup. Real estate is up the most. That's up over 10% along with staples. Healthcare, those are each up 9%. Utilities up 8%. So still looking kind of defensive for the month. However, we did have a rally that started 8 days ago, and this is bullish. And all of this is just to show that you can have different time frames with different bullish and bearish outlooks. So in the short term, discretionary, tech, materials, all of those are outperforming. In the meantime, just want to take a look at the SPAC situation because I think this is really instructive as to what's happened this year. I picked out some winners and losers, but Lucid, again, one of the top players here, Playboy up 150%, but you take a look at some of the losers, and there are quite a few. QuantumScape, a big standout there, down 72%, and then Laser, that is down nearly 50%. That's Luminar. Guys?
Hey, Jared, I'm just curious. Can you pull back up that NASDAQ 100 movers and look at it on an equal weight basis? Because, you know, we talk a lot about, there's a lot of ink spilled on how much the overall averages are pulled up by the largest cap companies. And yet, if you look at this NASDAQ 100 year to date, like it's still mostly green, right? It's not just the Apples, the Microsofts, the Alphabets of the world that are supporting stocks, it seems. And I would imagine it's a similar picture if you looked at the S&P 500.
Yeah, and let me just pull up a chart of Lucid because I think this is very instructive. A lot of these NASDAQ 100 stocks are green because they peaked earlier in the year, and Lucid's a great example. I think they peaked in, what is this, February right here? Never took out those highs recently, and it's been impressive that they were able to rise to those levels, but a lot of stocks are significantly off their highs. You take a look at a month-to-date basis, it's actually still pretty green here. Let me change this to a 3-month view, so this will be the quarter. I think we do have some outliers here to the downside, but when we talk about market breadth, NASDAQ breadth in particular, this is the NASDAQ 100. I'm talking about the NASDAQ composite that has something like 3,000 stocks. It's really been poor over the last few months, and it's been trending down. It's not necessarily a huge bellwether, a warning sign for the market, simply because it's the S&P 500 really that dominates, and we have seen better breadth in the S&P 500. So there are mixed discussions around what can specifically happen into the new year regarding the liquidity situation. So once the traders return, not necessarily next week, but really January 10th is when traders are going to return, probably going to be able to capitalize on some of this momentum that we've had from the late year. And a lot of times that just translates into January, calling it the January effect. February is another matter. I see parallels to 2009, 2010. We did have, and also 2011. I think there was a big sell-off in January of 2011 too. Doesn't mean it's the end of the world. Stocks tend to go up, but we need to be prepared for that when it comes, but probably don't have to worry about that for a few weeks here.
Jared, hang tight, because we asked pros such as yourself what they learned about the markets and investing more broadly. Take a listen.
I think it's been a fascinating year because there's the circus show that we always have with Musk, from the Twitter poll to what we see, across social media. You have the China issues. That was some dark days earlier this year. Would have been very easy, I think, for many to throw in the white towel. But look, this is always going to be an emotional bull bear story.
The lesson I learned is that earnings are the primary driver of stock market prices and expectations about those earnings.
The biggest thing I learned, I've learned over the last few years, is that the Fed, the last 22 months, the Fed has played a big impact on the market.
I was reminded of how quickly just how quickly downturns and then the recovery can be.
Jared, you've been covering these markets tick by tick since, well, for quite some time. What'd you learn? I think you're on mute, Jared.
Jared, I think muted.
Sorry about that. I was teeing off.
Here's one lesson that's still in
I could
progress.
tell you learned things. I was
Yes.
listening to you. I was listening.
I was talking about Dan Ives' comments on China. If we can go to the Wi-Fi Interactive one more time, he was talking about some dark days earlier in the year. I'm not sure that it's any sunnier right now. This is a very beaten down sector, and I don't see any equitable relief in the meantime. I think we're going to get more bad news in 2022 regarding China. Doesn't mean that we're not going to have some spectacular short covering bounces here, but that was one of the big stories. I don't want to say it was under the radar. It's not followed as closely, but I think it has implications for years to come. Splitting capital markets between East and West, that has political ramifications as well. So I think we're at the beginning, the very beginning of this process.
Sas, super quick. Did you learn anything this year?
Every day. If you're not learning, you're dying. For me, money is going to continue to chase money, and the stock market can stay overvalued for a long, long time.
I've learned
Feeling
to
irrational?
live with car alarms going off during the show and dogs barking. All right, we're going to take a quick break, Jared. Thanks so much. When we come back, we're going to talk more about the tough road for the airlines as of late, as we have seen more cancellations.
Airlines continue to be in flight cancellation mode. JetBlue is reportedly reducing its flight schedule through January 13th by nearly 1,300 flights as the Omicron variant rips through its staff. Yahoo Finance anchor Adam Shapiro is here with more. Adam, is there any relief in sight here?
For whom? For the passengers or for the airlines? First, let's talk about the stock price for the airlines right now, because if we can pull that up, you're going to see that the airline shares are actually trading a little bit higher right now. They've been taking a beating for the last couple of days, especially because of the cancellations, which it depends which airline you ask. For instance, in the cases of Delta, they're talking about it being a contributing factor of both people, their staff getting ill, but also there have been real bad weather problems out west. SeaTac Airport up in the Northwest has been a problem because of snow in that part of the world. So where do we stand right now? First, let me give you the overall TSA numbers, because the number of people going through airport checkpoints is still pretty high, especially when you compare it to 2019. Just yesterday, we had 2,049,000 people go through security at airports. In 2019, it would have been 2,300,000. And the numbers have actually been very close, despite the cancellations, to 2019. So where do we stand with this weekend? I'm going to quote from Delta Airlines. It's not encouraging. For the upcoming weekend, Delta projects daily cancellations between 200, 300 flights out of more than 4,000 total daily departures, as teams across our system continue to do all possible to mitigate constraints from increasing winter weather and the Omicron variant. Delta, by the way, is going to report earnings for the fourth quarter on January 13th. They're always the first to do that. So we're going to get a sense of what's really going on, especially as we look forward to bookings. If you get canceled, each airline has a different policy regarding cancellations, whether it be Delta, American, Southwest, United. For instance, if you just Google your airline and then cancellation policy, your eyes will bug out trying to make heads or tails of this. But I've pulled up the United refund policy. And if your travel plans have been impaired by COVID-19, depending on the severity of the schedule disruption, you may be eligible for a refund. There was a period when they had to refund you, and there have been all kinds of issues with people getting the cash value refund at the beginning of the pandemic. That's no longer the case. Each airline has a different policy, which corresponds to did you buy a ticket that allows for a refund and all of those different issues. So they don't have the change fees, but the cancellation policies are different, and you're going to have to go to their website to read the cancellation policy, and you might want to have a lawyer with you when you read it to try and understand it.
Man, that's no fun. Adam, there was that big change that the CDC made to the quarantine recommendations, in part to help staffing issues at places like the airlines, right? Yep. Over protests from the flight attendants union, for example, they made this change. Have we gotten any indication from the airlines as to whether this is helpful?
Well, Delta has already instituted its new requirements that you will get 5 days paid sick leave if you have COVID infection, if you're an employee, but then you have to come back to work. And by the way, you don't have to provide a negative test in order to come back to work. So I'll let you make the judgment call as to how at least Delta Airlines is implementing this. One thing to keep in mind, too, the flight attendants union, Sarah Nelson, is a great advocate for flight attendants, but the largest airline within that realm with which the flight attendants union represents is United. Delta is not organized, its flight attendants union, and Sarah Nelson's union is attempting to organize the Delta flight attendants. So the verbiage that comes out of the flight attendants union is a little bit more aggressive when they're talking about Delta. But at all of the airlines, they're looking at, you saw the CEOs testify before the Omicron variant really started to impact all kinds of things, talking about mask mandates and how they would like to drop the mask. Well, the mask mandate gets revisited in mid-March. TSA extended it before Omicron started to sweep across the country. On December 2nd, they announced the mask mandate on airlines will go until mid-March. They'll revisit it then. You also have Anthony Fauci, Julie, talking about he would be in favor, but he's not saying they should do it, a vaccine requirement to fly domestically. It's not the issue yet, but it's certainly something that's being put out there by very influential people.
I think I'm just going to try to stay home. Adam Shapiro, thanks so much. Have a happy new year.
See you guys.
All right, it's been a big year for France's champagne producers. Sales this year are expected to exceed 5.5 billion euros, according to Reuters, topping a previous peak of 5 billion euros 2 years ago. but it has also been an impressive year for sales of luxury spirits such as tequila. Tequila sales surged 83% in the third quarter, according to data from the Distilled Spirits Council of the U.S. Yes, that is an actual thing. Cheers. All right, brace yourself, folks. Friend of the show, Sam Rowe, is here to reveal some big investing themes for 2022. I saw his list, and I can tell you that you probably haven't thought of any of these things. We'll be right back.
Well, we are in the midst of wrapping up 2021 and also looking ahead to 2022. We're going to do the latter with our old friend Sam Rowe, editor of ticker.co, and he has been looking at some of the big market themes to watch going ahead to 2022. Sam, welcome back. We want to look, first of all, as you did, at earnings, because earnings I think it's safe to say that a number of different metrics in 2021 were better than expected. We tend to see analysts sort of lowball these sorts of things, but nonetheless, earnings have been doing really, really well. So I guess one of the big questions that you're asking here is, will they continue to do as well?
Yeah, no, 2021, this whole pandemic period has just been really crazy in that everything has been very difficult to model. And that's what every single one of these analysts, and then you ask the strategists too, is there's, all these models are so sensitive to all these different inputs that whatever it spits out, whether it's 10% earnings growth or 30% earnings growth, there's always this wide margin of error. Not to mention the fact that, so many of these inputs are, unpredictable. And I think one of the more interesting periods from 2021 was Q3, where and even early Q4, where everyone was trying to understand the impact of the Delta wave of the coronavirus. And yes, there was an incredibly terrible variant of this virus, but people were out there shopping, and corporations were raising prices, and profit margins were getting fatter, and earnings crushed estimates yet again, as it often does. And so that's basically kind of the setup going into 2022, right? So 2021, based off of the estimates so far and all the data that we've already had, earnings are estimated to have grown 45% year over year since 2020. Now, 2020 has kind of a low base, but 45% is still pretty extraordinary. And going into 2022, all these strategists who are forecasting where the stock market is headed, on average are forecasting about 9% earnings growth for next year. So if when you consider it relative to 45% growth in 2021, 9% seems kind of ambitious. But when you consider the long history of the stock market and earnings growth, 9% ends up becoming pretty average. So the question ranges from everything to is the bar set too high? Is it just right? Or are we going to find out that a lot of the things that we talked about last week, right? All these sort of signs of pent-up demand in the economy, is that going to translate to something that leads to even better earnings than what's currently being projected for 2022?
And Sam, I love me some gross profit margin calculations, but you, my friend, are looking at net profit margins next year.
Yeah, I mean, net profit margin, operating profit margin, gross profit margin, right? So, gross profit margin, Brian, that's sort of the starting point, right? Like what are costs going to look like? What are input costs going to look like for companies going into 2022? And, if it is the case that supply chains start to ease up and, actions from the Fed or whatever lead to a situation where input costs start to come down and, all these inflation metrics start to come down, then, gross margins could potentially expand. Not to mention the fact, and then if you go further down the income statement, I don't know how wonky we want to get here, but I like your setup, Brian. If we want to talk about, operating profit margins, so after all those input costs, you talk about all the various fixed costs that a business has, like, the leasing of office space or ongoing salaries for, the finance department or whatever. If there is going to be some sales growth, like we were talking about just before, if demand is going to continue to increase and sales is growing based off of a fixed cost structure, then yeah, you can get some more improvements in operating profit margin just because companies are producing more with their existing infrastructure. And but yeah, the forecast that you see in the chart, is net profit margin, and so that also incorporates things like interest costs, interest expenses, and taxes. And this sort of relates to the third item in 2022 market themes. What happens with interest rates? Because of course, interest rates is something that's going to factor into things like interest expenses and interest costs. And yeah, it's going to have to do with what happens with interest rates in 2022. And I think we were talking. You guys were talking about this in an earlier segment. The forecasters out there are predicting long-term interest rates to rise. Like I think the 10-year yield is somewhere around 1.5% right now, but there's an expectation that that's going to start to grow to 2% and even potentially higher. So that's going to be an interesting one to watch because, of course, when interest rates rise, it's not just, the cost of borrowing for corporations, but it's the cost of borrowing for everybody. And that has a potential to ripple through the economy.
Although as one of the other charts that you have shows, stocks still traditionally have gone up after rate hikes. Finally, let's talk valuations for a sec, Sam, because this has been a perennial topic, right, for the past several years, where a lot of belly aching about high valuation, stocks priced to perfection, and then valuations just keep going up, or at least are elevated versus historical levels. So I guess that's one of the other lingering questions going into this year. Will this be the year finally that we see valuations start to come down in a more decided fashion?
Yeah, that's a great question. And this is the thing that's been driving investors and market forecasters, insane since, the beginning of the stock market. Like, I think Brian even mentioned, in the earlier segment that, one of the things that, he's learning is that valuations can stay very high for a very long period of time. And Yeah, that's exactly what we're learning. It's not just this past year; it's the year before and the year prior that these valuation levels have been elevated. If we want to start to get into the sort of the math of it all, there is this kind of irony that happens when if valuations do stay this high for long enough, these elevated valuation levels end up becoming the long-term average that it's being measured against. There's a lot of different sort of questions as to what happens here, including what happens to interest rates, because there is this this thinking that low interest rates is one of the reasons that valuations have been elevated, because it justifies a higher level of valuation for a number of reasons, including lower borrowing costs. But when interest rates are really low, other kinds of securities that aren't stocks, that aren't equities, like bonds and credit and all these other more interest rate sensitive securities become a little bit more attractive, because you get more yield, and suddenly, all right, well, it's a safer bet to invest in a bond that has a decent bond yield, as opposed to a stock where you're trying to get a dividend payment, but it's lower on the capital structure, all that good stuff. It's a big question. It's something that's always got people scratching their heads. But I think one thing that's really important to note, though, regardless of why whatever is driving valuations, it is possible for valuations, as measured by the PE ratios that we're talking about, it is possible for valuations to come down in a decided way without stocks going down, as long as earnings growth is outpacing stock prices, which is something that happened in 2021. Remember, we started this segment talking about how earnings growth is up 45%, and this is a year where the stock market was up, about 30%. 30% is an extraordinary number, but 45% earnings growth is, actually a much higher pace of growth. And so this is why valuations have come down a little bit in 2021. So it's possible that we could get a repeat of that next year, where earnings growth outpace stock price growth, and valuations come down as prices are rising.
Well, given what we're seeing in terms of some of the forecasts for the end of next year, it looks like that's what some people are banking on. Sam, good to see you. Thanks so much. Sam Rowe of Ticker.co. Thanks for being here. We'll talk to you soon, and Happy New Year. I know I saw more good swag there. It's a vest this time. Awesome. Thanks, Sam. All right, we're going to take a quick break. When we come back, it's time for 2022 predictions from Brian Sozzi. Keep it right here. It is the moment you've all been waiting for, at least the moment I've been waiting for. Brian Sozzi offering up some of his predictions for 2022. Take it away, Brian.
Yeah, and I'll add the caveat off the top here, Julie. I want to make these somewhat achievable predictions. I didn't want to come out here and make buffoonish calls. I'm not Nouriel Roubini. So first prediction here, at least 20% market correction next year. I think the market will have to adjust at some point to this new reality of the Fed hiking interest rates to control inflation. So at least 20% correction at some point in the year. Next up, home prices up another 10%. I think that is certainly doable this year. A very strong year for home sales, home prices. Next year, likely to be really see similar things because inventory remains very low. Next up, one we talked about earlier in the week, but I will reiterate it, new management at Kohl's. Why? Because it really needs it. The company is facing its second activist investor attack right now. It fended one off earlier in the year. Bottom line, the stock price has been absolute trash for the past 5 years under current management. They need to change it up. Next up, Coinbase and Robinhood shares end the year higher. Both of these stocks, IPOs of this year, have been under severe pressure this year. I think at some point next year, you will see investors start to step in here under the thesis that both of these companies are operating very strong platforms with solid moats around them. Next, I would say this is very achievable. Microsoft and Apple will end the year above $3 trillion market caps. Apple's knocking on that door right now, about $2.93 trillion. Microsoft at about $2.6 trillion. Theoretically, both can get there sometime in the first quarter after strong holiday seasons. Next up, Intel will buy Global Foundries. That rumor was making the rumor mill in the summer here. It makes sense to me. I've covered Intel extensively this year. I think Pat Gelsinger the CEO wants to make a big splash, wants to just increase capacity for Intel around the world. One way to do that is to pay up to buy Global Foundries, a fab maker. And last but not least, Julie, Warren Buffett, I think this year passes the CEO baton at Berkshire Hathaway. This year he signaled for the first time via our Yahoo Finance exclusive coverage that he's thinking that Greg Abel might be that successor to him as CEO. He's 91 years old. Again, there's no outward indications that he's slowing down, but still, at some point, you would think there has to be a baton switch atop Berkshire Hathaway, and maybe next year is it.
That's all? Why not 20 predictions, Saz? No, I'm just kidding. You're taking the blanket approach. I like this.
I did have 15, but I had to make it TV friendly.
As you know, I do not make predictions as a matter of Julie Hyman policy. However, the only quibble I would have with these, because they do seem quite achievable, is that if the market goes down 20%, that ain't just a correction, bud. That's a bear market. And I don't know if we're going to see another one of those so soon after 2020. But, could be.
Well, notice, the great way to make a prediction, Julie, is never really put a timeline on it. So I said at least 20% market correction. Didn't say what month, didn't say what week. It may happen at some point next year. So when it does happen, we can come back here and just say how amazing we were.
Well, as you and I know, timing the market is one of the most challenging things about setting strategy or trading the market, I'm sure you and I both have heard many, many times over the course of our careers. All right, take those to the bank, ladies and gentlemen. We are going to play them out once again on this day next year. All right, we are going to take a quick break. When we come back, we're going to take a look at Moderna, and not just its decline today, but of course, we are going to take a look at how it is done this year. Still one of the top performers, but down well off of its high. And speaking of highs, we're watching the fireworks and the various celebrations around the globe. This one from North Korea just moments ago.
Happy New Year's Eve, friends. I'm Brian Sozzi, minus a glass of champagne right now. And that right there next to me is Julie Hyman, also minus a glass of champagne for right now. Now, investors have a lot to pop bottles for. This morning, the S&P 500 is closing in on a 27% year-to-date gain. Bitcoin is still up 60% on the year. Despite a recent slide in trader fave, Apple has seen its stock rocket up 35% this year. That being said, stocks are mixed this morning, too slightly down. The Dow slightly in the red, NASDAQ in the red, and the S&P 500 slightly in the red. Now, here are a few other things we're watching for you at this moment. We continue to keep a close eye on cruise line stocks as the bad news keeps piling up for the struggling industry. The CDC is out with a new warning advising consumers to avoid taking cruises regardless of vaccination status. The warning follows several ships reporting a barrage of new COVID-19 cases. What is the better buy next year, crypto or gold? We'll check in with one analyst who makes the case for gold, even as the yellow metal closes in on its worst year of performance in 6 years. And it's New Year's Eve, and that means the wine is flowing for most from sun up to sundown. We'll check in with the CEO of winemaker Duckhorn, who has overseen a strong stock price since going public earlier in the year. Julie, over to you, over at the Wi-Fi Interactive.
Over to me, lacking that champagne. I don't know about sun up to sundown, at least not quite yet. Let's take a look at the major averages here today. As you said, we're really seeing little change here, which is not unusual here. As our Jared Blicker pointed out earlier, most of traders are not on their desks right now and won't be back really in any size until January 10th. So next week could be a slow one as well. You know, one thing that we haven't quite looked at yet in detail is the Russell 2000 on the year. We talked about the big gains that we have seen in the larger cap averages. The Russell's just been not performing to the same degree. It's up about 14% year to date, despite some calls for some small caps to come back. It hasn't quite materialized. Something else, as I'm looking around here on this market tour, is the semiconductor index year to date up 42%. Obviously, that has just been a monster outperformer here. And something else I wanted to talk about here as we go through is looking at the trending tickers on the Wi-Fi platform today. YahooFinance.com always has these trending tickers. And these are catching my eye today in part because there's not a lot of rhyme or reason. So we've got Alibaba, which is down about 1.7% today, up 42% year to date. Obviously, a lot of these Chinese ADRs have been top of mind this year, mostly for negative reads, although Alibaba is an outlier in that regard, with the shares higher on the year. Teva Pharmaceutical on this list yesterday, there was the news, that it had reached a settlement having to do with the opioid pandemic. And you see there the shares are down 16% year to date. You pointed out SoFi earlier, but then there's some other, the PIMCO Dynamic Income Fund. It's not too often that you get funds like this that are on the trending ticker list. Kiora Pharmaceuticals, Nutraban. I don't know what half of these things are, Brian Sozzi, which again, I think is reflective of this being the waning days of the year and some sort of more obscure names that tend to pop up on this list when not as many people are trading actively and looking at what's going on. So a bit of a more muted session today to cap off what's been another pretty extraordinary year in the markets.
Yeah, Nutraban. I think they make granola bars, Julie. Are you a big champagne person on New Year's Eve?
Yes, I am.
I think I'm gonna go. I think I'm going tequila today. That's just my personal fave.
I mean, why limit yourself?
The sky's the limit. The sky's the limit. When you're feeling good, just let it roll. All right, switching gears here. Say it ain't so. Usually cheap IKEA furniture made out of basically balsa wood is about to get much more expensive. Julie is back with those details next.
Your discount Swedish furniture is about to get more expensive, which reminds me, I have a bookshelf that I still have to put together. IKEA is planning to raise prices by about 9% on average. That's according to the Wall Street Journal. Inca Holding is the largest owner and operator of IKEA stores and said in a statement, IKEA continues to face significant transport and raw material constraints driving up costs with no anticipated break in the foreseeable future. Price hikes will vary depending on product and location. It's not just the NYPD that's interested in the Ford Mach-E electric vehicle. As Inside EVs reports, the Department of Homeland Security is also considering an order as laid out in the executive order from President Biden last week. The order, which instructed the federal government to buy only zero-emission vehicles by 2035, said DHS will begin field testing the Mach-E early next year. And a European bank mistakenly paid everyone twice on Christmas, not its own employees, but Spanish bank Santander deposited about $147 million into 75,000 accounts on December 25th. About 2,000 businesses running payroll through the bank were affected. Now Santander is trying to retrieve all of those payments. It's a job made more complicated by the fact that some of those deposits were made into accounts housed at other banks. Saz?
No, Julie, I better go check my Bank of America account real quick. We'll table that chat. Moderna has been a key player on the COVID-19 vaccine front all year long, but oddly, its stock price has plunged 35% in the past 3 months. Let's check with Oppenheimer senior biotech analyst Hartaj Singh, who covers Moderna. Hartaj, always nice to see you. Thanks for joining us. Perhaps you could break down for us what is happening with Moderna shares here.
Yeah, thank you, Brad. Thanks everyone for having me, and I apologize again. My connection is not optimal, phone connection. The thing with Moderna is really simple. It's been going on since the second quarter. Since the second quarter call, where people are looking at the forward estimates, of the stock and thinking about what they're going to do in revenues in 2022 and 2023, and when that tails off, or how much will the tail off be. Also, the new variants are causing concerns because vaccine efficacy is sort of going down, the prime boost, which is the 2-shot regimen, and then you give up a third shot, which is now called the booster. That's holding up, but that's causing concern to investors. And then finally, there's stuff like IP concerns, competition from Pfizer, where Pfizer seems to, and Biotech have kind of taken a step forward on the commercial side. So all of that is leading to, I would say, a lack of visibility in 2022 and 2023. And the pipeline is still not there to kind of support, the COVID-19 franchise. So I think because of that, the stock has been kind of range bound, right? So since it kind of has come down after the second quarter call, it's been range bound in that 250 to 350 range. But that's essentially what's been going on.
Hartaj, do you think the clock is ticking on Moderna to come out with the next thing on this platform? I know they've been developing a flu vaccine on the mRNA platform. How much time do you think investors will give them to start to roll out more products?
Julie, I think that's honestly, in some ways, going into 2022, the critical question, right? So we keep on looking at the pipeline. But, we have what I would call a bullish neutral holding, and that's, our rating on the stock. And we just kind of gently remind people, of course, we're not, we don't have a buy or outperformance, but we gently remind them, even as a neutral, that this is one of only 2 large-scale mRNA players out there, right? So yes, we are waiting for the pipeline. The second half of this coming year, 2022, we'll probably see some material catalysts, maybe earlier, but most likely in the second half, flu, cytomegalovirus. But there's a scarcity value that's attached to assets that really, there's nothing else like Moderna out there other than Biotech, right? So not from a strategic or an M&A perspective, it's that the platform that can be rolled out and the future revenues that, long-term shareholders, people who want to own it more than 1 or 2 years, can own, those people will support it. So yes, I agree with you. There is some pressure on the pipeline. But I do think that scarcity value of their platform, its scalability, and its uniqueness is something that long-term investors are supporting and holding firm by.
And Hartaj, you just wrote a note for looking out to next year, and you're seeing an extremely volatile environment for COVID-19 vaccine makers, but it looks like you're favoring Gilead. Why is that?
Gilead's remdesivir, which hardly ever gets talked about, is really the only drug that's actually working against all variants, right? And yes, its clinical results have not been, spectacular, but it saves the healthcare system tremendous amounts of money. It reduces the time that a patient spends in the hospital, by up to a third. And when it's $30,000, $40,000 per patient per visit into the hospital for COVID-19, that adds up over tens of thousands of people. So, they just had a phase 3 trial in earlier stage patients that was successful. So we expect remdesivir, use to continue, and they have a couple of critical oncology readouts coming out in January, February. If those work, I think this is really the stock to own, both from a COVID-19 perspective and a non-COVID-19 perspective. You kind of might get the best of both worlds with Gilead in the next few months.
And Hartaj, we also have not seen the end of new vaccines, right? Especially in the U.S. market. We could be seeing a Novavax vaccine here. You highlight Inovio in your note as well. Will we see as much upside for these new players? And conversely, will we also see maybe some damage for the existing players on the market once these new guys come out?
Right. So, Julie, look, here's the thing about new vaccines. And, biotech is still an idiosyncratic industry in the sense that we're 1/10, 1/15 the size of tech, right? So people are still just getting to learn it. Think about mRNA vaccines and Inovio. They have a DNA vaccine, which we believe, that platform is very analogous to mRNA. Going forward, you were just talking about electric cars, right? The Department of Health, the government looking into purchasing them. It's not just that the electric cars are more carbon neutral, it's that they're more flexible. There's a scalability to them in terms of manufacturing. There's an ease of manufacturing there compared to, gas-fired cars. It's the same thing in biotech. The mRNA vaccines, the DNA vaccines are very scalable. They're very flexible. You can get new vaccines to new variants within a few months. The older platforms, we don't cover Novavax, we don't cover the other companies. Those will struggle. They will still have a niche because, in a planet of 8 billion people, you need all types of platforms. But I do think the mRNA vaccines, that if Inovio's DNA vaccine is successful in its phase 3 trial in the first half of next year, those will really be the clear winners from a speed, scalability, and efficiency perspective, in infectious diseases.
All right, we'll leave it there. Oppenheimer Senior Biotech Analyst Hartaj Singh, always good to see you. Have a Happy New Year.
Happy New Year, everyone.
All right, we'll be right back with an outlook for gold in 2022. Stick around. Gold hasn't glittered in 2021. The yellow metal is closing in on its worst year of performance in 6 years as investors flock to stocks and crypto. But will gold brighten up a bit next year? George Milling-Stanley is State Street's head of gold strategy and joins us now. George, nice to see you this morning. Thanks for hopping on. Do you expect a rebound in gold next year?
Yes, I think that we're going to see better performance than we've seen in 2021. I think to put 2021 in perspective, it's important to remember that gold was coming off 2 banner years. The price went up 18% in 2019. It went up another 24% in 2020. Both of those figures are way ahead of the long-term average capital appreciation in the gold price, which is around 7.75%. So we were running way ahead of ourselves for obvious reasons. So something of a slowdown in 2021, I think, was to be expected. My sense is that as economies are starting to recover, we're starting to see a rebound in the all-important jewelry consumption, mostly in the emerging markets, and that is absolutely key to the health of the gold price going forward. It's typically more than half of each year's consumption. So I think that's going to be one of the kickers for 2022, Brian.
And George, I was also looking at fund flows in and out of the GLD ETF, which of course is the benchmark ETF for gold. And we have seen, if you look at sort of the moving average here, we've seen on balance this year some money come out of that GLD ETF. But I'm curious, as you talk to clients, consumers, what have you, how people view gold at this point in their portfolio, and if that view of the role that it plays has changed at all.
Okay, let's address the outflows first of all, Julie. You brought that up. We've lost about $10 billion to redemptions from GLD in 2021 so far. But that comes after a year in 2020 when we were up $15 billion. So we're still running pretty well if you take the 2 years as an average. As far as where investors see the gold in their portfolios, I think most people are still seeing it. They still believe that gold is offering them some protection against the unexpected, whether the unexpected is macroeconomic or geopolitical. There's still plenty of potential for the unexpected to keep cropping up. We haven't seen perhaps as much in 2021 as we did in the previous couple of years, which was one of the reasons why gold was a little quiet this year. But I'm still expecting to see uncertainties, especially around equity markets. We've seen equity markets closing the year by hitting new highs almost every day. That's wonderful news, but it's also something that makes me wake up at night worrying about how much longer that's going to continue. If we're going to see more uncertainty in equity markets and we're going to see continued low interest rates for the foreseeable future, there's no suggestion that the Fed's going to be in a hurry to raise rates. Then I think gold is probably going to do better next year than it has in the years so far.
George, perhaps you could settle this debate for us, and we have it a lot here. And do you think gold is competing with cryptocurrencies for investors?
Not really. There's a lot of discussion about this in the media, but I'm not hearing it in the real world of investors and the advisors to investors that I spend my time talking to. I think the two things have rather different characteristics, and that means that it's not really a competition. If you think about it, the contribution that cryptocurrencies make to portfolio performance is based entirely on returns. And as we know, returns can be positive, which is wonderful, and returns can also be negative, which isn't quite so good. And we've seen both of those from all of the cryptocurrencies in the short time they've been in existence. By contrast to that, gold's promise to investors historically has always been twofold. What we expect from gold is that it will, over time, it will improve returns, and that over time it will reduce risk, reduce volatility in the overall portfolio. Cryptos in the 13 years they've been around have actually increased volatility. Their volatility has been 8 or 9 times more than gold over that short sample time frame. It's all we've got, so that's what we have to judge on. So they've been adding to volatility. They have added to returns, but they've really only done a one-dimensional job. I think that cryptos have a future. There's no question, and that when their returns are good, then people, I think, will continue to buy them. But I don't think people are switching out of one asset and into the other. I think that, if you like, they're complementary rather than in competition to one another.
Right, as you say, it depends on what the motivation is, what they're holding them for. One of the motivations traditionally for people to hold gold is as an inflation hedge. And obviously we have seen inflation here in the US and around the globe tick up pretty significantly this year, even if it hasn't benefited gold, though to your point, over the 2 years, it looks different. So what happens next year as inflation is still predicted to increase, albeit perhaps at a lower rate? Will that be one of the things that draws people back to gold, perhaps?
I think it might. I think that, inflation is always, it has an odd impact on the gold market. If inflation seems to be going up, then people naturally turn to an asset like gold that has some real value and that has in the past offered some protection against sustained high inflation. But we've only had high inflation for 5 or 6 months. That is not, frankly, long enough in my time frame to call that sustained. I would look for at least a 12 months or even longer. Now, if we continue to see inflation figures around the 5 or 6% per year that we've been looking at for the past few months, especially now that those in authority have decided that it is no longer right to call that transitory, so they're looking for more longer-term inflation, then I think that gold is going to benefit from that. But there is always the fear that investors have that if inflation is too high or rising too fast, either one or both together, then the Fed is likely to move rapidly.
All right, George Milling Stanley, State Street's. Hey, all right, Rob, leave it there for right now, George. George Milling Stanley, State Street's head of gold strategy. Good to see you. We'll talk to you soon. All right, 2021 has been a record one for IPOs, but will the momentum continue into the new year? We'll chat one expert next.
Well, 2021 has been a record year for IPOs, for SPACs for that matter, as well. It has just been a blockbuster year, both in terms of the number and in terms of the money raised for IPOs. Our Dan Halley has been looking ahead to what might be the big buzzy names for 2022. Hi, Dan.
How's it going, Julie? That's right. We spoke to some of the experts at Renaissance Capital, and they were giving us some of the lowdown on what could be some of the biggest IPOs of 2022. And I want to start off with a company that you may not know about if you're not into autos, but VinFast. They are a Vietnamese automaker. They only recently started producing their own vehicles, gas-powered, but what they're doing in 2022 is launching their new electric cars. They're going to have the VF E35 and the VF E36. These are going to be launching in the US and Europe. That's the big deal here. In 2022 alone, they're going to launch 60 showrooms, and they'll have them hitting the streets by the end of this year. They're basically SUVs, and they showed them off in November at the LA Auto Show. That valuation for that company is looking at potentially $60 billion. So, it's going to be a little more modest than what we saw out of Rivian, but still playing into that whole EV explosion that we've seen in recent years. And then after that, I want to talk about following in the footsteps of automobiles, Mobileye. This is the company that Intel acquired for $15 billion back in 2018. We talk about it a lot when we talk about Intel's quarterly revenues. They basically produce the technology that helps drive self-driving vehicles, or helps self-driving vehicles see, hence the name Mobileye. And right now they're actually running a pilot in Paris where the workers at local retail stores are able to book rides for themselves using taxis that are powered by Mobileye's technology. So really interesting stuff. We're expected to see potentially $15 billion from that IPO. And next, obviously we talked about this all throughout 2021, I think starting in January or February, Reddit. Obviously, that was really what started the meme stock craze, Wall Street bets, everything having to do with AMC or GameStop, all originated from there and that particular subreddit. And really, when you look at Reddit, they've been around since 2005. They have 50 million daily active users, 100,000 different subreddits, and 50 billion monthly views. So a massive site. We're looking at a potential for $15 billion in valuation. And obviously, they generate revenue through both advertising and subscribers. So a big name there. And then after that, Flipkart, $38 billion potential valuation. They are backed by Walmart. They're basically going toe-to-toe with Amazon's Indian store. And they provide different things ranging from apparel to home goods, big washers, dryers, anything you can think of really. And they have 100,000 sellers, 100 million registered users. Obviously, India, a huge market that a lot of companies want to try to penetrate, and Flipkart being there already and being kind of the homegrown brand, big deal. And they're also investing heavily into grocery delivery and close time grocery delivery. And then finally, I want to hit on a company that you may not know of, Automation Everywhere, potential $7 billion IPO here. They essentially make the software for bots, basically the software that can help make mundane tasks like data entry easier for things like HR departments, customer service, anything along those lines. And they produce that type of software. So while it might not be as cool as an EV or as trendy as Reddit, still a big name there. Again, $7 billion potential IPO in 2022.
What a great rundown, Dan Halley. Thank you so much. And indeed, I had not heard of that last one, and really helps us set up there for 2022. Thanks so much. Happy New Year, Dan. Appreciate it.
Happy New Year.
Of course, the big question when we talk about all these IPOs is, what's going to be the demand? Obviously, we have seen big demand this year that has sort of waned as the year has gone on. Let's talk about that with Greg Martin, Rainmaker Securities CEO. He's joining us now. Greg, thanks for being here. So how are you thinking about that question? As I said, we have seen some of these IPOs roll over. A lot of the hot IPOs from this year are trading below their initial prices. What does that bode for 2022?
Well, thank you for having me, Julie. And, at Rainmaker, we manage one of the largest pre-IPO trading platforms, enabling buyers and sellers to transaction private companies. So we have a really interesting lens into what companies will go public and what the demand will look like and how they will perform. 2021 was really a tale of two cities. It was one of the biggest years ever in terms of number of listings, but it was a very, very poorly performing year where over 2/3 of IPOs actually traded below their IPO price. So the aftermarket trading performance was very poor. We've already seen 400 companies file for IPOs, for 2022 potentially, representing over 70 billion. So it is shaping up to be another large year of IPO volume. But I do think that there's some trepidation on the part of investors. Obviously, the performances of IPOs in 2021 is a factor, but there's a lot of potential headwinds in the market. We're all faced every day with the virus and what might happen next with the virus. Obviously, there's inflationary concerns. There's a question of whether interest rates will, start ticking up. And we've been very fortunate. We've had a very low interest rate environment for a long time, but we have some signaling that there might be some interest rate hikes coming. So there's a lot of potential headwinds in the market, but valuations are still strong. It was a very great year from a performance on the overall market indices perspective. Valuations are still strong. So even though IPOs haven't performed as well, I think that what will likely happen is that there will be more rationalized pricing of the IPOs in order to provide the typical premiums that IPO investors will look for. So I still expect a very strong year of demand for IPOs in 2022.
Greg, why do you think some of these buzzy IPOs of this year are underperforming? I'm looking right at Coinbase, right at Robinhood. I mean, these are significant platforms, yet the stocks have really gone straight down.
They were priced to perfection, I think. I think both of those companies hit the markets at a very good time. They were coming off tremendous growth quarters. Obviously, Robinhood was benefiting from the meme stock craze and a massive rise in installs, and really priced its IPO, at a very high point. Coinbase the same way. It was coming off a massive growth couple of quarters and priced it very high. Obviously, there were some factors, in terms of crypto kind of trading down since Coinbase has priced, and so I think the question there is, if you're the company, is it a bad thing that you raised money at a really high price, took less dilution? You got the money, you got less dilution. Is it really a bad thing that your price traded down? Obviously, it's not great for employee morale. It doesn't send a great halo effect, but the same thing happened to Facebook. Facebook priced many years ago at a very high price, traded down significantly, and look where they are now. I think those are both strong companies. I think that people who take a long-term view of those companies will end up doing well. But obviously, the near-term story for both of those companies is that they've traded down. Well, I think what will happen is companies will lose a little bit of power in terms of their ability to push their underwriters to get their IPO price up, because investors are just going to demand the type of IPO returns that they're used to. And so I do think that there's going to be some valuation shifts as these new companies come public in 2022.
Greg, just quickly here, from what you're seeing on your platform, what has liquidity been like? I mean, we saw a lot of liquidity at the beginning of the year, people getting stimulus checks, putting that to work in the market. What is happening now, and what does that mean for 2022?
Yeah, we're still seeing a pretty, significant flow of interest into the secondary space for these pre-IPO private companies. I mean, people want to be part of the companies that are growing, and a lot of these companies continue to stay private longer and longer. Companies like Stripe and ByteDance and others are attracting, multiple $100 billion valuations as a private company. So there's still a lot of liquidity, but clearly people are making bets in the private markets based on a future successful IPO. And so when the IPO markets are down, people are holding back, and I do think valuations are going to get affected. I mean, there was a really interesting snowflake effect, when Snowflake went public back last year, that everyone wanted to be in the private companies before they went public because they saw the massive increases in valuation from the last private rounds to the public offering and then beyond. And I do think that has, will stall a little bit. And so what I expect is there will be liquidity, but I think there'll be more rational valuations in 2022.
We shall see. Greg, thanks so much and Happy New Year to you. Greg Martin is the Rainmaker Securities CEO. Appreciate your time this morning.
Thank you. Happy New Year to you as well.
Thank you. You too. We're going to take a quick break and we'll be right back.
It's New Year's Eve, and you are probably a few glasses in already, and that's okay. It may have been another long year for you, just like many of us here. But if you are drinking some decoy wine, that may have helped the bottom line of our next guest. Alex Ryan is the chairman and CEO of winemaker The Duckhorn Portfolio. Alex, good to talk with you again. Thanks for hopping on. We were talking in our meeting this morning. You guys are one of the successful IPOs this year, and that hasn't been the case for many companies that have come public. What are you seeing in your business right now?
Oh, I appreciate that. Happy New Year. Yeah, we've got a long-term platform, right? Been doing this for 40 years. Came out with a really solid IPO price. We've been hitting our plan, and the investors have been liking that. And more importantly, the wines are resonating with our consumers worldwide. So we're in a really good spot. We plan on continuing that into the new year.
And I see you have some of the wines arrayed behind you, Alex, of course. And one of them looks like it's a sparkling option, very seasonally appropriate. Yeah, I know that we were looking at some of the figures, and I think it was something like 17% of all the wine sold in December is sparkling, which is different proportion than the rest of the year for obvious reasons. Right. How's that sparkling offering do for you, and what kinds of trends are you seeing in consumption this holiday season?
A couple things there. Holiday consumption has been really good, right? People, we've been taking share for many years now. People are really resonating with our brands. People are moving to luxury. Premiumization in the wine space continues as alive and well, as you know. So some exciting trends there. Sparkling wine takes a disproportionate amount of excitement in the fall, and then the celebratory seasons around graduations and early summer and June time. We're seeing a lot more people, and some younger people, getting into the world of sparkling. It's fun, it's exciting, it's mysterious. And so I think trends in sparkling, luxury sparkling, for domestic makers are going to continue as they are for us. And I think the whole portfolio, though, of luxury wine is going to continue. And again, like I said, we've been taking share for a significant amount of years now, and it's starting to pay some real nice dividends for our consumers domestically and worldwide.
Alex, I did some surfing around last night on the old interwebs, and there seems to be a lot more competition in lower priced wines. I mean, I saw some wine last night priced about $3. It took me by surprise. What are you seeing in that lower end of the market?
Lower in the market's a little more volatile, right? Everyone can't compete in luxury, so I appreciate that. It's a little more volatile in the lower price tiers. There's a trading up factor in our business, so I think that no matter how you get invited into the wine experience, if you will, the trade up factor, that exploratory factor of what does a better wine taste like is inherent in people's desires. So it's competitive. There's some great wines at those lower price tiers. And I think that for a lot of us, you'll want to explore higher price tiers as your income allows you to, and as you just grow and mature. So I think activity at all levels in the wine business is good for the business. As you know, as you pointed out earlier, we compete in that luxury segment, about $20, $25 and up, which is really the hot part of the market right now. But people have to get in where they can afford to get in. So I encourage people to try wine where they're comfortable and then explore their way up the chain.
Hey, Alex, what's been happening on the pricing front, and what's going to happen in 2022? That $25 bottle of wine, is it going to be a $28 bottle or a $30 bottle before 2022 is out?
I think it's okay to think that way and suspect that could happen. In our company, we're very, very methodical about how we look at price increases. We're a luxury branded product. We don't react to prices. We don't just raise prices willy-nilly. So we have a long-term viewpoint on pricing, and we're going to continue that plan and not be reaction to the short-term pressures that we're all kind of talking about in the media right now. Some other competitors might jump around prices a little bit, but your favorite luxury producer of wine should approach it a methodical look at pricing and not really spook the market. It's just not fair to the consumer. So I think you could see us taking modest price increases over the next couple of years, but not to the point where it's going to really turn people away from the Duckhorn portfolio.
Hey, Alex, real quick before I let you go, what does the CEO of Duckhorn drink? What's your go-to wine?
All right, that was a little bit of pressure there, but for lunch today, I'm going to be enjoying some of our Decoy Limited right now, the blue label, and a Cabernet Sauvignon, and a nice bowl of soup, and with my family, and get ready for a couple more glasses tonight with a safe and responsible New Year's Eve.
Sounds like Sounds like a plan to me. Great stuff. Alex Ryan, Chairman and CEO of Winemaker, the Duckhorn Portfolio. We'll talk to you in the new year.
Thank you. Good luck. Bye-bye.
All right, I want to get to Yahoo Finance's Brian Chung, who has a look back at some of his favorite moments from the morning show this year. Look at you, Brian Chung. Just really impressive, as always.
Well, you know, I got to tease our next show, Yahoo Finance Presents Brian and Zach's New Year's Stocking Eve. That's going to be coming up at 11. We'll have market retrospectives in tuxedos. What more could you ask? But I want to stick to the theme here of looking back on 2021 for the end of your show, the last one of 2021. And, you know, our viewers here at Yahoo Finance know that you don't have to wait until New Year's Day to see some fireworks, because if you watch the 9 to 11 show throughout the year, you'll see fireworks seemingly on an everyday or every week basis, at least. So our producers here have actually kindly asked me to show a little bit of a montage of what we call our friendly debates here on Yahoo Finance. Take a watch.
I don't think investors prepared for that inevitable hit. We're staring right down at this.
Oh, wait, inevitable. Inevitable is a little bit of strong word. It isn't inevitable. Okay.
Households are getting it from both ways. I think higher gas prices here also
to be fair,
higher product
Walmart
prices.
is not. Walmart is not. You mentioned Walmart
They
and
have
Target.
pushed through price increases.
They're not passing through the costs. That's
They
why
have
they took a
pushed
hit
through
on
price
margin.
increases. If these retail investors think it is now a crypto play, I mean, you could see a large move into the close.
I'm trying to put the. I would.
I'm
be
reading the
surprised.
tape.
How
Reading the
does that
tape,
work?
Gary.
No, they're not necessarily losing money. Why do you keep saying that they're losing money? It depends on when they got in. It depends on when they got in. If they got in early enough, they're not losing money.
I would suspect, Julie, a lot of these folks got in at the top.
I mean, we could talk about the way that we want the world to be, or we could, like, I'm serious. Like, we're talking about, I think we should be talking about the way the world is. How does the Fed think about things? What are the things that are happening? This theoretical argument about how the Fed should be doing this, how the Fed shouldn't be doing that, what the market should be, should there be volatility, should there not, like, who cares?
And, you know, some cameo appearances by myself alongside our former colleague, Miles Udlin. Now, we've kind of taken on different roles. I've kind of served as a referee in some cases. Miles was just simply hopping in and getting dirty with you guys as well. But look, these friendly debates always really make for some spirited conversation. And no one's really right or wrong in some of these complicated issues. But just really love that retrospective on 2021. And, of course, plenty more, I'm sure, to come in 2022, guys. Keep it friendly. Keep it friendly.
Yeah, well, I'll just
PG.
quickly.
Sometimes
corporate
Sas is
taxes
just
head
wrong.
higher, Julie. Corporate taxes going higher next year. Going to hit profits. Stocks are going down.
Sometimes Brian Sazzi's just wrong. That's you know, but it's okay. It's all right.
Aren't we all?
Yeah,
We're right sometimes, we're wrong sometimes.
I mean, listen. That is something, you know, we were talking earlier about lessons that we've learned in 2021. I'll just go ahead and say it. I've been wrong this year. It's happened. Okay, I'm willing to admit it. I think all of us have made some mistakes over the course of the past couple of years in terms of how we thought things were going to turn out. Did I think that New Year's Eve 2021, I was going to be sitting on my couch again? I did not. But here we are, guys. And I won't be sitting on my couch in a tuxedo like the ever classy Brian Chung here, but that's okay.
See, there we go. You guys can you guys virtually shake hands or something, or like I don't know. Yeah, the other direction.
Big inflation next year. Big inflation.
All right, we'll see if all of that is right. Brian Chung, thank you for delivering that special New Year's message and package to us. Viewers out there, we did not know that was coming, to be clear. And here we all are, our own branded champagnes going into 2022. That's what we'll be drinking tonight.
I got to give a shout out, Julie. We got to give a shout out to our team. I mean, the producers behind our show. I mean, it's been a challenging year. So much going on. I mean, they just do amazing work. Like, I don't know. I know we joke around, but I'm very lucky to be working with you all. You know, it's a hell of a team.
Cheers.
And that's how we end. Oh wow, look, he's even.
No, it's apple cider. Don't worry. Come on. For anyone watching here, you know,
this guy.
We're keeping it PG here. We're keeping it PG here.
Yes, I will echo Brian Sazzi's sentiments here. Thanking very much our team. A lot of appreciation for our small but mighty staff here at Yahoo Finance and what we churn out every single day. Happy New Year, everybody. Stay with Brian Chung for the next couple of hours in his tux.
Happy New Year's Eve, everybody. Welcome to Yahoo Finance's Stock and New Year's Eve with your favorite duo in the game, Zach Guzman and Brian Chung, here with you on this special day, the last trading session of 2021. Brian's got his champagne / apple cider, whatever's in there. He's got a white bow tie, which is a nice touch.
Yeah, you got the classy black going. You know, I was trying to make it a little twist here.
You know, we can't be perfectly matching to do this. You know, we've got to somehow differentiate ourselves. But we've got a big show, Brian, to wrap up the year, including, I guess, a closer look at some of our favorite business stories in 2021, a focus on DeFi, a lot going on to wrap up.
Yeah, and there's a reason why we're calling it our New Year's Stock and Eve special. You get it? Stocks, you know, because forget it. We're going to take some market retrospective as well, looking back on 2021, give you a little bit of a preview to 2022 as well as we wrap up this final trading day of the year. It's kind of crazy we still have a market trading day of the year. New York Stock Exchange not giving us any days off in 2021. I guess that's the theme for this year. But of course, we'll have everything and all of that and more and a little bit of fun as well here on Yahoo Finance.
Yeah, and some live look-ins at the celebrations around the world as well. Obviously, Australia, as always, kicks us off with some of the best shots early on in the day. And we'll walk you through the other ones as we see them throughout our hour here on Yahoo Finance Live. But first, I want to start at what we're seeing play out in the current session. Right now, we do have all three major indices in the red to wrap up the year, though still a 27% gain on the year for the S&P 500, the best returns that we've seen in a year since 2019. We'll see where we go into the close. Plus, of course, as always, we are keeping a close watch on those COVID cases here in the U.S., surging to a new daily record now north of 300,000 cases. We'll have the latest on that front. And as we said, the best stories from 2021. We want to leave you with a little bit of positivity to wrap up the year, looking back on some of the wildest things we saw play out, a closer look at those. But first here, as we said, I want to spotlight what we're seeing as hospitals continue to be a bit stretched when it comes to what they're seeing on the COVID front lines. And as she has been highlighting all that for us, I want to bring in Yahoo Finance's Anjali Kamlani to kick things off with a closer look at what we're seeing there. And Anjali, as we've been kind of discussing, you know, some of what we're hearing from medical experts is that these cases individually might sound less dramatic than what we saw in the Delta wave, but when you add them all up, still stressful for healthcare workers on the front lines.
That's absolutely right, Zach. And that's been really the concern that health experts have been sort of talking about. We've seen the rising cases, record-breaking numbers every single day this week, including yesterday with nearly 600,000 cases in a single day, pushing the weekly average for the daily counts to 355,000 per day. And those numbers, again, world-shattering records. And we, the US, make up a majority, once again, of new cases around the world. So that's really concerning. And of course, we know that the resulting effect is that hospitalizations will continue to rise. While, to your point, the stays might be shorter, the severity might be less, it still is a burden on health systems, which are seeing these cases continue to rise, though not at the same clip as cases. We do know that we have to wait and watch because, you know, the difference is about a 2-week period usually between when we see those cases rise and when hospitalizations surge. As it stands right now, we're seeing a lot of kids in hospitals, and in part because they're in the hospital for other reasons and COVID is being found, but a lot of them are unvaccinated, whether they're in that below 5 age range or older and part of families that are not getting vaccinated. Those are some of the reports coming out of what we're seeing and why we're seeing those numbers. Meanwhile, we do know that because of all of these hospitalizations, we're looking at what the treatments are out there. And we, of course, have been following that the monoclonal antibodies have not been as effective against Omicron. But right now, the NIH did update their treatment recommendations to sort of favor Pfizer's new pill. That's the at-home treatment option. It's a 5-day course of pills, followed by as well GlaxoSmithKline monoclonal antibody, the only one that is working really right now, as well as Gilead's remdesivir, the only fully approved treatment that's now on the market. Merck's pill, which if you recall was also authorized along with Pfizer, is also on that list, but really less favored, in basically an asterisk next to it, noting that it's only an option when other options are not available for, or not recommended for pregnant people, as well as only available for those 18 and up, whereas all those other treatments that I just showed you are available for those 12 and older. So really a mixed bag here when we go to that. But like I said, just a complete mixed picture, really concerning trends right now. And that's what we have our eye on as we enter the new year.
Yeah, unfortunate to still see. I mean, a lot of people were hoping 2021 was going to be the year that we were out of this, rolling over now into 2022, but hoping for much better there on all that. Anjali Kamlani bringing us the latest. Appreciate that. I want to bring on another voice here in the discussion, of course, as we're seeing this all play out in terms of what medical experts are saying. And for more on that, let's bring in Dr. Anthony Santella, University of New Haven Professor of Health Administration and Policy and COVID-19 Coordinator. And Doctor, appreciate you being here with us on New Year's Eve. When we look at this, I'm not sure where you want to start because there's a lot of different elements. Of course, the CDC has been continuing to change kind of their guidance around isolation. Now you also have them coming out and warning Americans about being on cruise lines too. It seems like there is a bit of mixed messaging since we were entering kind of the phase where the data seemed to be indicating that Omicron might not be as bad as feared. But what do you make of maybe what the messaging has become now?
First, thanks for having me. Happy New Year. I feel very underdressed compared to you all. But, there's a lot to be said about the way CDC has been messaging their health communications, their social marketing. It's confusing even to those of us that work in the field sometimes. But this is how science works. The scientific process shows us that we gather our data, we test our hypotheses, and what I tell you today may be different than what I tell you tomorrow. But the key about their revised guidelines is it's based on data. Now, they probably could have done a little bit better of job of showing that data that shows that the most levels of infectiousness happen in those first 3 days, so that they're pretty confident across the board that if people quarantine or isolate, depending on their circumstances, for the first 5 days and then mask up appropriately and carefully for the second 5 days, will prevent the spread of this virus and its variants. But now is the time to err on the side of caution, use those public health mitigation strategies that we know have worked. They've worked for centuries now in terms of getting vaccinated, getting boosted if eligible, wearing an appropriate mask, being physically distant, avoiding large indoor gatherings. Those things work.
Hey, Dr. Brian Chung here. We're trying to jazz it up because maybe a lot of people won't be able to have the same type of New Year's Eve festivities that they were planning on having. So maybe we'll just bring it to their homes on Yahoo Finance. But wanted to ask you on a serious note, how should be people approaching any sort of gathering specifically tonight, especially if it's a little bit too late to be going out to get a PCR test because you won't get the results until a few days later? How should people be approaching this with caution?
Right. So in public health, we call this harm reduction. It's about minimizing the amount of harm we put in, not only our own way, but those that we socialize with, that we live and we play and we observe faith with. And so if you're going to socialize tonight, if you have some rapid at-home tests, it's not a bad idea. They work best when people have symptoms. So if you're asymptomatic and just a worried well, it's probably not going to do much good. Mask up. If you're not eating or drinking, keep the mask on. If you can keep the windows open, if you live in a warm part of the country where you can take your gathering outside, limit limit who you're going to be around. Those are all just small things that we can do to keep ourselves healthy and really monitoring our own health. If you're just feeling a little crummy today or have the sniffles or a bit of congested, stay home. I know in a normal year, whatever that really is anymore, that might have not stopped us, but this is not the year to be playing around with that.
Yeah, and I guess, to kind of go back to the point of all the things that we've learned through the pandemic, a lot of those things have been true for a while in terms of best practices to stay safe. But when it comes to kind of why we were ever using any of these guidelines was to really, I think, initially reduce kind of the stress load on hospitals. And even though maybe, as we were discussing with Anjali there, even though kind of the mild reports are out there about Omicron and the people dealing with it, and hospital times may be coming down a bit relative to Delta, what are you seeing maybe now in terms of just, the chart's pretty staggering to show record cases now at this point, and we all know hospitalizations kind of lag the case count. So, how do you kind of stack up where hospitals are at right now and whether or not they're prepared for this?
Well, there's a few things to note here. One is, before we talk about hospitalizations, let's talk about our case counts. Our case counts are grossly underestimated, right? Think about all those folks out there who have taken those rapid antigen tests at home, and those tests never get reported, or largely don't get reported out there. So, just think about what people are posting on social media and other things, right? So those rapid antigen tests are not being really counted in our true case counts. So those are underestimates right now. In terms of hospitalizations, we use those terms mild, moderate, and severe, but mild for someone who is immune compromised or has multiple comorbidities can be moderate, severe, and sometimes even deadly. And so let's not, just say, oh, it's just mild, right? Because how someone experiences mild will vary tremendously. And our hospitals, they're at the brink of collapse. A conversation for another day is about the state of our US healthcare system, or lack thereof. But when you talk about a really fragmented system where these health professionals, doctors, nurses, respiratory therapists, aides have been working around the clock to curb this pandemic, there's only so much one can take. And so I worry about us kind of, assigning these terms like, well, the hospitalization count isn't as bad as we thought, or people are just having mild symptoms. But that can be, earth-shattering, even for someone who just has, a few mild conditions that may otherwise not really impact their quality of life.
Yeah, all important to think about too when we see kind of changing guidelines and isolation guidelines coming down too. We'll see. I'm sure a lot of that might be revisited in 2022, but we'll leave it there for now. Dr. Anthony Santella, appreciate you coming on here to chat with us. Happy New Year to you. Be safe out there. Going to take another pivot here back to the markets as we're taking a closer look, kind of, as we said, a down day to wrap up the year, but overall the strongest year for return since 2019, at least when you look at the S&P 500 there. And for more on what 2022 could hold, let's bring in Sam Stovall, CFRA Chief Investment Strategist here to wrap up 2021. Appreciate you coming on here to chat with us, Sam. I mean, when we're looking at it, the stories are laid out for what 2022 will hold when it comes to the Fed hiking an expected 3 times. When you look at maybe some of the biggest stories in 2021, though, inflation likely to carry over as well. What are you seeing maybe shape up for the year of investing in 2022?
Well, first off, early Happy New Year to you. I think that 2022 is going to be a good year that tends to follow a great year. We certainly have a high wall of worry that we're going to have to scale, as you mentioned, in terms of inflation concerns, what the Fed will be doing with interest rates, et cetera. It is the second year of a president's term in office. The sophomore slump and volatility tends to be 40% higher in that second year as compared with the other 3 years. And if the Fed does indeed start to raise short-term rates and longer-term rates tend to follow, well, then we could see a contraction in PE multiples, since we have a negative 0.5 correlation between the 10-year yield and S&P 500 PE ratios.
Hey, Sam, Brian Chung here. So I feel like one factor that was kind of thematic through 2021 was margins, especially with rising inflation. It seemed like a lot of companies had no issue still being able to preserve their margins despite these higher input costs. Now, as the Fed tightens next year, might that change things? And I know that's only maybe tangentially related to what you were talking about with PE, but when it comes to the big story for 2022, that seems like that could be a real big difference in the operating environment.
Sure, it could be. Certainly for those older, more value-oriented companies that do have higher interest expense, we could see some margin reduction along with increase in input costs, commodity costs, et cetera. The Wall Street is not really making a big bet that way. However, S&P Capital IQ is still pointing to about mid 13% margin for the S&P 500, actually slightly higher than what is anticipated for 2021. So maybe that's a lagging indicator based on consensus estimates, but it looks as if profit margins are likely to remain fairly healthy.
Yeah, we still do have a couple, I guess, headwinds there when you think about decelerating earnings per share growth. You've got, as you said, the sophomore slump for President Biden. A few different things. I mean, when you're looking at maybe where investors should be hiding out, maybe playing defensive next year, what is kind of maybe, I guess, the takeaways for best practices really be reshaping, reallocating heading into the new year?
Well, I guess the first question is if you think that we are heading into a 1970s kind of inflationary environment, which I don't, then you want to be leveraging the inflation hedges like energy, like materials, and you want to be staying away from the growth areas like consumer discretionary and technology. In a little shorter term, however, what we find is that in this most recent month, December, while utilities was the best performing sector and tech was among the worst performers, that's actually not out of the ordinary. December normally sees utilities as the best performer, tech as the worst performer. But what December gives, January takes away. And on average, tech ends up being the best performer in January by a 3-to-1 margin as compared with the second best sector. And utilities tend to decline in January. So near term, short term, I still think that we're in the seasonal sweet spot for the market where the cyclical and growth areas do well, at least until that sell in May period.
Sam, what do you see as the outlook on volatility broadly? Because what was interesting was that thematically also in 2021, we did see volatility decrease. Maybe the vaccine helped that, although the Omicron variant did reintroduce some of that volatility in November. Now, with the Fed also becoming an uncertainty in 2023 and possible new variants remaining a possible issue, do you see volatility as maybe only going to the upside next year, or do you think things might stay relatively calm?
No, I think that volatility is likely to increase and probably increase fairly dramatically. In 2021, it was basically an average year. The number of days in which the market was up or down by 1% was 55 versus the average of 51 since World War II. Also, the difference between the closing high and the closing low for the S&P 500 was 27 percentage points, which is essentially equal to the average since World War II. So I think that, when you come to volatility, an average year usually breaks out of that average mold in the coming year. And sophomore slumps, because the second and third quarter are traditionally down in terms of price for the S&P 500. And then we see among the two strongest quarters in the final quarter of next year, that could certainly add to the overall volatility.
Yeah, well, I mean, still the ups and downs this year did bring us 70 days of all-time highs on the S&P 500, only eclipsed by 1995. We'll see if 2022 has more to bring. Sam Stovall, CFRA, Chief Investment Strategist, Happy New Year to you.
Happy New Year.
On the other side of this break, we will talk about our favorite finance stories of the year, and keeping with the theme here. Now, GameStop is certainly going to be one of them. What is the other story that we're picking? We'll have that on the other side of this break. Let's take a look at some fireworks from that appears to be Taipei, Taiwan, ringing in 2022. That's the Taipei 101 building. Again, only about 12 hours out from New Year's here on the East Coast. We'll be right back.
we are just now a few hours, if you want to call it that, away from 2022, and we wanted to take a look back on 2021.
We want people to have access to the markets, and Robinhood stands for that.
Nobody, not in the physical world nor the digital world, had ever built a technology platform or brand fully centered around women's wants and needs.
All the fashion that you're wearing, kind of like the earrings I have on in the digital world, are not produced physically. So it becomes a very large ESG investment.
Oftentimes, revolutions that usually start with a lot of head scratching in the beginning. Then they just become the norm.
There's a population of people that have always been somewhat curious or interested in skateboarding, but never had the incentive, and them being stuck in one place was their incentive.
I should have smoked my whole career. I should have smoked when I was fighting. And because it put me in this different state of mind, I'm very relaxed. And the more relaxed you are, the better fighter you are. At least in my case, I am.
Plenty of market retrospective right there in those favorite clips that we had from 2021. A little bit of skateboarding, a little bit of market plumbing, and a little bit of weed smoking as well. But of course, we're going to kind of wrap up 2021 by talking about our favorite finance stories of the year. And I'll go first. I mean, this goes back to January, but I just think this is not only the biggest story of 2021, but could be the biggest story in the foreseeable future. It really was the meme explosion in late January when we saw GameStop shares get a burst from the degens on Wall Street bets. And, you know, you just have to kind of conclude here that despite all of the craziness, the fact that you saw some shorts go bust, Melvin Capital got clapped, as Liquidity would describe it, as Elon Musk joined in the tweet frenzy. Really, at the end of the day, the memers won, because remember that GameStop was a stock that was about $19 in the beginning of 2021. And right now it's at, about $154 a share. Now, it was as high as over $300. But of course, the people that bought and hodled, which there obviously are still a lot of them, seem to still stick to the thesis, which is that there really was no thesis. And I think that's an ongoing trend, that we have these sell-side analysts come on the show all the time with these recommendations and these projections for where future cash flow might be, and then you back into some sort of valuation model on that. That thesis for why to buy a stock is just as valid as someone who's on the internet and said, this is kind of funny, LOL. So I think that this is going to remain a story, especially with the power of retailers. Obviously, Robinhood getting into the mix. Vlad Tennant, we had that clip on earlier. He's very much part of the story for payment for order flow. People start to care about payment for order flow at all. Again, people got called to Congress. But again, at the end of the day, this shift towards retail trading is going to remain a theme in the years to come, Zach.
Yeah, one slight, I guess, caveat, if I could push back there too, Brian, is that, you know, and this is kind of what I think we learned here at Yahoo Finance when we saw coverage of the same story play out on maybe other networks, is kind of this idea of maybe Wall Street looking down on retail traders, right? And you go back to Roaring Kitty and kind of what he laid out in those initial YouTube clips, walking through his thesis, you know, digging into a lot of documents there, going through all the financial statements and highlighting the short squeeze that could potentially come from Melvin Capital and the like, that was kind of betting against GameStop. And what happened there when it flipped was pretty wild to see. And you could loop in AMC in the same kind of a breath there, and how it's still up more than 1,000% on the year. You know, we learned a lot about what retail traders know. We had a lot on the show too, kind of highlighting all the stuff that they've been able to pull off going up against the likes of some of these short sellers and some big names like Ken Griffin that we've highlighted too. And he would be the segue, Brian, to, I guess, my favorite story of 2021 too, which was Constitution DAO, and the idea of people coming together, very similar to what we saw with Wall Street Bets and GameStop, people coming together, raising more than $40 million to bid on one of the last remaining privately held copies of the U.S. Constitution. You add a little bit of democratizing finance to actual democracy here, and that's what you get. They, of course, lost. Constitution DAO lost, and a lot of media maybe said, you know, this is a failed experiment. People can't come together to make change. But if you look at the chart for what happened in terms of the token, the people token that people put their money into to bid on this, after they lost, it actually 10x'd. So you could put in $300 to this project and walk away with more than $3,000 if you were to immediately convert your people token to some other crypto there. So even though it was an L, I guess, in terms of what the group set out to do, I think it brought a lot of people into crypto, obviously media talking about it. I think we're going to see a lot more of that in 2022 here. as well as that theme carries on that all of us together, apes together strong, as they say, Brian.
As they say, I mean, I think the funniest part of that whole story was the grand unveil, because people didn't know that it was Ken Griffin after the Sotheby's auction was over, right? It was only the day after when the Wall Street Journal, I believe it was, reported that it was Ken Griffin. Everyone was like, you have got to be kidding me. The guy who was part of the GameStop story as well. And obviously there were just so many great memes that came from that. But of course, we'll see if maybe the short-term L means that there could be a bigger war at stake between Ken Griffin and maybe these other memers in the future. So, you know, the battle may have been lost, but the war far from over.
I think that's a good note to leave 2021 on, is everyone looking forward to more battles that they can win in 2022.
Against Ken Griffin.
We're going to take another quick break here on the show. When we return, the big story of 2021 will carry on the crypto theme here into a look back at some of the biggest busts, as well as maybe more optimistically, maybe the biggest boom set to come in 2022. We'll chat with one of the best DeFi explainers on YouTube. He joins us after this. Stay with us. Welcome back into Yahoo Finance Live on this New Year's Eve special. We're, of course, taking a look back at some of the biggest stories in 2021. And when it comes to crypto, as we highlighted some of the biggest booms, Dogecoin out there and some other coins as well. On the flip side, some of the biggest busts also have to be highlighted. And for more on that, I want to bring on Yahoo Finance's senior crypto reporter, David Hollerith, with a closer look at some of those. David.
Yeah, so as in years past, scams proved to be the biggest source of cryptocurrency-related crime this year, the biggest busts, according to Chainalysis in a paper from the National Bureau of Economic Research. Now, Chainalysis found that at least $7.7 billion worth of cryptocurrency has been taken from victims in crypto-related crime worldwide this year. So interestingly, that amount is less than 2019, but more than 2020. Now, the biggest change this year has been that most of the scams, or at least a growing majority, has come from rug pulls, which is a sort of a relatively new type of scam where people find a cryptocurrency project that offers a new token they invest in, and shortly after, the creators of the project exit with the users' funds. So this year, revenue from rug pulls increased by 36%. And obviously, probably the best well known is Squid Coin, which sort of occurred in October. So piggybacking off of the South Korean Netflix series Squid Game, scammers launched Squid Coin in October. After buying in, investors quickly discovered that they couldn't actually sell their tokens. Now, this came as a surprise, obviously, but the price actually climbed to $2,860 per token before it plummeted to zero, and the creators made off with the funds. So that's actually a run-of-the-mill scam, and in total, the creators got away with about $12 million from victims. But the largest scam has actually not come from the DeFi segment, but from centralized exchanges. So there was a centralized exchange in Turkey called Thodex, which was a similar rug pull scenario where the CEO of the exchange mysteriously disappeared, and he made off with about $2 billion of victims' funds. So, people talk about DeFi being a particularly hot and sort of crime sensitive area, but sort of what we're finding is that actually a lot of the scams are sort of happening across the board. It's just sort of what we've seen in the last year is that in DeFi, perhaps a newer area, there's a lot more newer types of crime happening.
Yeah, there's obviously scams to be had everywhere. Scammers are going to scam you, whether they're trying to do it in cash or crypto. Centralized, decentralized, always got to be on your toes out there. A good tip for 2022 as we move forward. David Hollerith bringing us the latest there. Appreciate that. Of course, as we're mentioning DeFi, it might be worth taking a closer look at what was the rise of DeFi in 2021. And total value locked, one measure that some people look at to see how much money is flowing into some of these protocols, up from just over 25 billion at the start of the year, close to quadrupling in 2021 to reach almost 100 billion, according to DeFi Pulse. And of course, we try and highlight some of those projects on this program, but not always do we have enough time to get into the nitty gritty. But one YouTuber who I've enjoyed some of the videos from, very happy to welcome him into the program here to spotlight kind of some of these biggest exploders in 2021 and some things to look forward to in 2022. On his channel, Donku R. Daniel Ramon joins us right now to chat more about DeFi. Appreciate you coming on, man. Happy New Year's Eve. Thanks for being here with us. Like I said, really good explainers and hands-on details that we can't really do here. But when you look back on the DeFi explosion in 2021, talk to me about what you saw, because it's been so much that you quit your job to be doing this full time now.
Yeah, first of all, thank you very much for the invitation. And as you said, right, every day something new is happening. We often say also in kind of this environment, in these communities, is that 1 week feels like a year, because if you just look away, new protocols are coming, new concepts are coming out there. And that was for me just also a crazy journey this year. As you said, right, I started my content creator journey this year, focusing on the topics of crypto and DeFi. And I now also decided to quit my job. And I think what is important, what I uncovered myself, is that often it seems very complex what's happening there, but the logic behind is very straightforward in terms of that there are clear processes. We can really look on the blockchain and see what's happening there. And that is so fascinating for me. And well, people ask me, because I did a flowchart on Twitter and tried to explain stuff, would you like to do a video about that? Maybe you can explain more. And I said, well, I can try. And now I'm here, right? After 6 months of really doing YouTube explainer videos about crypto and DeFi.
Yeah, you and me both, man. I mean, it's been a lot of explaining to do this year, and I guess both of us really latched onto a project earlier in the year, which is of course Terra, and kind of digging into what they're trying to solve, a decentralized stablecoin, but much more being built on that network. And we look at Do Kwon, the founder of Terraform Labs. He's been tweeting about some things to watch for in 2022. I'd be curious to get your take on maybe some of the themes he's been highlighting when it comes to kind of what Web3 decentralized, all these protocols might unlock when we look ahead. What are you keeping your eye on, I guess, for what to watch for next year?
So specifically about the Terra Luna ecosystem, I think there are a few protocols that are coming live. We've just seen one of the biggest probably DEX launches just a few days ago, Astroport. But next year, there are more protocols coming that really try to kind of get DeFi to the next level. I can maybe mention Prism Protocol, who is a protocol that tries to defrag assets. Like when we talk about a coin like Luna, but also Ethereum, there's a yield part to this, but also a principal part. And a protocol like Prism tries to then break it up. And then you can probably trade already with the future yield of this coin. And this is wild stuff that I'm really looking forward to uncarve. Then we have topics like Levana protocol that is basically an acronym for leverage any asset. So they're creating tokens that have leverage in themselves. So instead of buying then Luna, we can buy a token which is called 2x Luna, which is leverage in it. And that's what's fascinating for me really for DeFi, kind of this next level of what we can really do with the technology of crypto and blockchain.
Hey, it's Brian here. Wanted to ask about just kind of the semantics here, because I think the Jack Dorsey beef with Andreessen kind of highlighted the nuances around the term Web3. I mean, when it comes to crypto, DeFi, Web3, is it interchangeable between those languages, or are you seeing kind of more lines being drawn between what is one distinguishable from the other?
Yeah, good question. I think it's a very, very difficult topic, which we're all trying to still uncarve, right? I can tell you that myself, I'm trying to not say crypto that much anymore and really focus on DeFi and Web 3.0. Why? Because I see that crypto has often this narrative of speculative asset, right, that people can trade about. But crypto is way more in terms of DeFi, right? You can provide your assets, you can enable utility out there. And for me, Web 3.0 is now, if you take a look why it's called 3.0, right? So Web 1 was we can read in the internet. 2.0 is we can create, be it on social networks or so forth. And now the 3.0 comes from owning stuff. And that's where also NFT come in there. And it's sometimes for me also hard to understand why people really focus on maximalism of Bitcoin or so forth. I think we're really here seeing something new. This ownership in the internet is really something that will be probably really new to understand also in 2022. And for me, I think the biggest trend to also understand what can really bring to the table.
Yeah, I think you're hitting on a lot of key points too, because there's a lot of people who might have crypto, Coinbase very popular, and they might just own it and then let it sit there. But as we've kind of seen this year, there are a lot of things you can do to earn yields on a lot of what you might be holding in that wallet. In fact, Coinbase is earning the yield out there for you, basically, if you're just letting it sit there. But some of these things are complicated. So I would tell our viewers, look, if all this is flying over your head, you can follow him on YouTube and kind of get more of the nitty gritty. But I guess, what are you expecting to see? Are you expecting to see mainstream, people who never dipped a toe into crypto doing that down the road? Or do you think there's going to be something along the lines of a centralized institution that can maybe help walk them through some of these steps? Because it's not necessarily easy right now for mainstream.
Yeah. Great question. I think we will see that there will be more applications trying to simplify that, taking the benefit really of DeFi and bringing it to the people, but they don't really need to use it. So that's also how I basically found Terra Luna as an ecosystem, right? Their whole purpose is that they're able to mint different stablecoins, be it now, of course, the biggest one, the dollar called UST, but then you have already the euro out there. So what it makes, basically, it enables the mainstream to use in their day-to-day crypto, right? Because let's be honest, if I want to buy something in a grocery store here in Europe, I still need to use the euro, right? So I think that there will be more apps simplifying the usage then of this kind of stable coins or what it might be to also bring the yield opportunity to my mom, right? That's what I say to my parents, that they can use it, but I don't think that they will truly use it themselves because, as you said, it's so much to uncarve. I love it, right? So I think there's a lot to learn about finance, but I don't think that we can expect that everybody now sits down for hours and trying to really understand this. I'm looking forward to apps like PayPal on the blockchain, where, for example, with the power of Anchor protocol on the Terra blockchain, you automatically on your dollars earn 20% for sitting around. You go to the grocery store and then you just, want a hot dog, you pay for it, but the rest of the dollars that is sitting in your account is earning yield. I think that's the future that really crypto and DeFi can bring as a benefit to all of us.
All right, and again, you can check out Daniel's videos on YouTube under the channel name, Danku R. Thanks again, and Happy New Year to you.
Thank you very much. Happy New Year.
Coming up on the other side of this break, we're going way back in time for a little bit of market retrospective from the 1920s, including where you could have bought a tuxedo at that time. Yahoo Finance's Jared Blakely will look at a once beloved retailer on the other side of this break. We'll be right back. final day of our Then and Now series, so let's take a look back at a true fallen titan of the 1920s. Yahoo Finance's Jared Blickery joins us to discuss a distinctly American company that has seen better days, to
That's right.
really say the least here.
It's Sears and Roebuck, so no drum roll on this one. And by the way, this is the 5th and final installment of our Then and Now series for 2021. I have a feeling that we're going to have a lot more of these in the year and years to come. But back to Sears, ushering in the modern era of American consumerism, Sears and Roebuck got its start in the 19th century as a mail order firm. And by the early 20th century, it was a household name dominating the rural retail market with its huge catalog, selling everything from clothes and jewelry to entire homes. And those huge catalogs had a lot of other purposes besides ordering goods. Hint, hint. Now, on the Wi-Fi Interactive, I do have some numbers up here. At the close of 1922, Sears was reporting an annual revenue of more than $182 million, which broke down to around $4.88 per share. Now, Sears reported total assets for the year at well over $152 million. This was a drop compared to 1921, which the company at the time attributed to smaller inventories and a sharp reduction in accounts receivable. A lot of the language that they're using back then, pretty much applicable to today. And by the mid-1920s, Sears was making inroads in urban areas as well, opening up its first department store in Chicago in 1925. Now, I want to switch to a chart here, and we can see that Sears does not have an impressive price profile right now. It's trading at a whopping 2 cents, and that's because of a bankruptcy action. Now, here's a year-to-date view of what's going on, losing 91% year-to-date. And in the modern era, it has been a slow and steady decline for the once vaunted retailer. Billionaire investor Eddie Lampert famously took control of the company in 2013, but was not able to reverse its fortunes. Now, most of us know what has since become of Sears. The franchise's ownership company declared bankruptcy 3 years ago, and Sears survived the filing, but its decline has continued along with its sister company, Kmart. As of now, there are only 21 Sears stores open in the U.S. And before I go, I just want to thank our producer, Devin Burris, for putting all of this information together. And we have an article, she and I, coming out tomorrow, and it covers all of these companies that we've been covering this week, all 5 of them. So look out for that on yahoofinance.com tomorrow, guys.
Jared Blickery bringing us the latest there. It's been a great week of all those look backs as we celebrate the close of what I hope will be a next roaring 20s here in 2022. A lot more to look forward to. Jared Blickery, appreciate that. Going to take another quick break here on the show. When we return, though, can't discuss the new year without discussing wines, whether or not you partake in champagne as well. Much more coming up on that front right after this. Welcome back to Yahoo Finance Live as we continue to wind down 2021 and prepare for the new year. A lot of us are bound to have maybe a glass of champagne to toast to the new year. And, you know, we've talked a lot about having few reasons to really toast anything in 2022 and 2021, but we have seen the use of champagne really bounce back and raises new questions about whether or not investing in some of these wines might be the play out there. And for more on that, I want to bring on the CEO, one of the companies attached to just that idea. Colt Wines America's CEO, Atul Tiwari, joins us right now. Atul, thanks for coming on here to chat with us. Happy New Year's Eve. When we look at it, you know, supply and demand has been thrown off in basically every sector, wine no different. So talk to me about what you've seen in terms of pricing and the ability to even get these wines to people who want them.
Yes, Zach, thanks for having me on your show. It's been an interesting year for champagne. The sub-index, the champagne index with LiveX, is the top performer of all wine regions so far this year, with a 34% return to the end of November. And a number of factors are driving that, as you mentioned. There's less supply and more demand. And so it's a pretty simple equation through the pandemic. And then, of course, this year in 2021, we've seen some wild weather in the region of Champagne, which is causing a production decrease of about 50%. And so all of these factors are coming together to drive Champagne to new heights.
Well, that must be some pretty significant weather for that much of a reduction. Now, obviously, you said that that's kind of regional to, I think, not just the Champagne region, but Burgundy region as well. But what about in California, here in the United States market? How has output looked in that front?
Yes, actually, as you point out, we've seen some dramatic weather around the world with wildfires in California, floods in Germany, and of course the frosts and heavy rains in France. And in terms of California itself, there is some talk that some producers may not even be producing 2021 vintage because of all the smoke damage. So that also is decreasing supply. And we've seen some great performance from California this year, with a return in and around 19.5% to the end of November as well.
Let's talk about what you guys do here too, because it's pretty fascinating to see you guys grow the assets under management, if you want to call them that, $3 billion to $30 billion, if I'm reading that right. I mean, what are you seeing in terms of maybe people who had never invested in wine before turning to you guys and say, look, help me access maybe this alternative asset class that also tastes pretty good?
Right, actually, so those numbers aren't the Cult Wines numbers. Cult Wines is at about US $275 million in assets under management. I think what you're referencing is my former role as CEO of Vanguard in Canada. Those were bigger numbers.
That's right.
That said, you know, we are the leading provider of asset management services in the fine wine world. And we've got a 14-year track record of delivering great returns, and fine wine is a wonderful way to diversify your portfolio. Low correlations to equities, low volatility, and something called a low downside capture, which means that if equity markets go down dramatically, fine wine barely moves, and we saw that through a number of periods, including 2008, when the S&P 500 was down 38%. Fine wine was down less than 1%, so it's a wonderful diversifier.
A hedge, if you will. Okay, but it's not just the bottles that you can invest in, right? Because I'm hearing about these wine NFTs now. Could you kind of give us the skinny on exactly what that is?
Sure. Yeah, it's pretty exciting what's going on in the technological world globally, obviously, and it's no different in the world of fine wine. We're very excited about blockchain and NFTs for two reasons. One is in the past, there had been some issues around fraudulent bottles in the fine wine world. We've never experienced them ourselves, but it does happen. And so the blockchain and NFTs are going to help combat that, because we'll be able to put bottles straight from the producer onto the blockchain, and therefore, through its life, guarantee the authenticity, which is very exciting. Secondly, NFTs are going to provide producers and merchants a new way to distribute wine and reach an audience that previously may not have been engaged in wine. And so it's going to provide experiences for new people to the space. And for example, producers could create limited edition bottles and create NFTs around those. Cult Wines itself did an artwork in a barrel of Bordeaux that we put on the blockchain using an NFT and bid that out to potential investors a few months back. So we've started to dip our toe into it. We're seeing other producers around the world doing the same thing. And I think 2022 is going to be a pretty interesting space to watch with technology.
The next frontier of the eye-catching wine bottle label, if you will. But thanks so much for breaking all that down for us. Atul Tiwari, Cult Wines America's CEO. Happy New Year.
Thank you very much, and Happy New Year as well.
All right, well, as we get towards the new year here on the East Coast, want to call attention to a Twitter poll that we put up on our Yahoo Finance Twitter account, looking back on the big work-from-home stocks, some of which really got shellacked quite hard in 2021. We asked the question, which one of these four do you think is most likely to bounce back in 2022? We took a look at Pinterest, Zoom, Peloton, DocuSign, and about 30% of the 600 or so votes that we had gotten on this poll said DocuSign was going to be the one that was going to bounce back the most. And as a reminder, the stock is down over 30% year to date. Zoom came in second place. That stock has had an even rougher year when you consider that it's down about 44% year to date. So Zach, I mean, not all these stocks have had a good year, but again, little optimism perhaps into the next year.
I mean, the CEO of DocuSign was on our show as he saw his stock dropping that 30% right after they reported earnings. And he said he was buying it himself. So he put his money where his mouth was and saying, look, we're coming back, and we're coming back with a vengeance. I don't know what's going to happen for a lot of these names. I mean, the drops in some of them are pretty dramatic. If I were to pick Brian, which of course I don't even know if we're allowed to do, but it's New Year's Eve, so let's go ahead and play this game. We've seen a lot of Pinterest shares in. We talk about the bounce back in some of these names is supposed to happen already, right? When we were coming out of the pandemic, we went back into kind of lockdown mode, as it were, with the Omicron wave, and none of these stocks really caught any boost. So kind of not really any early indication that any of these are going to catch anything in 2022. So I would say maybe not where you want to put your money based off of the early data.
Yeah, actually, I'm going to play a little bit of diplomat here because I don't want to pick one stock, but I think we also have to acknowledge that even though, look, these four stocks had a rough go at it in 2021, the work from home trade compared to pre-pandemic levels is still remarkably higher, even when you control for how the stock market is doing better now than it even was prior to the pandemic. But, you look at DocuSign up 100% over the last 2-year period, Zoom up 177% over the last 2-year period. So, I think that they're all doing pretty fine in the span of things.
Yeah, unless you got in, I guess, at the peak and you've been riding it all the way down. It's been a tough year for a lot of us. It's been an even tougher year for those people. But of course, a lot to look forward to, Brian, when you think about maybe some of the other things that we've all wanted to get back to, including travel, the like there, cruise lines. We've talked about the CDC continuing to push people to maybe stay away from those. But, a lot of maybe getting back to normal for a lot of people to look forward to in 2022.
Yeah, absolutely. But a happy new year to all of our viewers here on Yahoo Finance as we continue to take a look at markets right now. Not too much going on right now. Well, actually, all three indexes are in the red, so I guess we didn't really do all that much over the last. We tried. We tried to do what we could over the last hour or so.
Tuxes on.
We put our tuxes on and look, red across the board. Just barely so, though, S&P 500. But again, happy new year to everyone over here in the United States, at least. And, we'll see you guys in 2022. Cheers.
Happy New Year, everybody. Thanks for watching.
Welcome to this Yahoo Finance special presentation of Retail Revolution. I'm Julie Hyman, host of our 9 to 11 a.m. programming here on Yahoo Finance Live. Over the next half hour, we're going to speak to executives and influencers who are on the front lines of what has been an exceptionally wild year in the stock market, particularly for retail investors. Join us as we explore how it all began from Reddit all the way to Wall Street. This is Retail Revolution. Now, we've got some stats that I want to share with you that have to do with some observations as I've been covering this throughout the year and kind of where we are now. As we know, this whole meme stock retail interest in the market really spiked earlier this year, but there has been some sustainability, even as we've seen some of these stocks be somewhat volatile. First of all, there's a basket of the 41 most favored stocks by retail investors. It's tracked by Bloomberg, and they've calculated that 9.21% of volume this year overall has been in these 41 stocks. It's waned over the course of the year, going closer to 5%, but still a substantial chunk of the overall volume. That's one of the things that's caught my eye. Secondly, we have seen an explosion in retail brokerage accounts. Fidelity, the retail brokerage giant, not just retail, but also institutional, but its retail accounts in particular were up 23% in the third quarter to nearly 31 million accounts. 44% of the new accounts that were opened by people ages 18 to 35. And a lot of these retail investors have now gotten into the options market as well. They're not just outright buying and selling stocks, they're active in options as well. Daily options volume up 35% year to date through November to a daily average of 39 million. About a quarter of that is retail. So let's dive right in with a company that has definitely gotten some attention from retail investors. It's a marijuana company based in Canada called Sundial Growers that has a cannabis business as well as an investment business. Zachary George, the CEO of Sundial Growers, joins me now. And Zachary, you guys, like a lot of the other so-called meme stocks, for lack of a better word, you caught the attention of retail investors really earlier this year. You saw a spike in your stock. Since then, there have been other sorts of spikes here and there as you've gotten the attention of retail investors. But let's take a step back, first of all, and talk about your business, right? So you guys are in the marijuana business. You operate in Canada. What are you looking for in terms of your growth trajectory going into 2022? What do you want investors to know?
Thanks, Julie. Thanks for having me on the show. So we're effectively, we should be looked at as a 3-year-old startup in the cannabis industry. We're a Canadian domiciled corporation with a NASDAQ listing, and the retail interest in Sundial and in our shares likely would not be there without that NASDAQ listing. It's a key feature we can talk about. But our business is integrated. So we have what is the largest pure indoor cultivation facility, which is located in Olds, Alberta. And in July of this year, we just acquired what is the largest individual retail network, which is a combination of both corporate and franchise locations. And we have about 113 locations across Canada today. And then the second pillar of our strategy away from our core cannabis operations is really focused on our investment activities. And we launched a joint venture with alternative investment partners in Calgary, focused on capital deployment into the cannabis sector more broadly. And we've built a credit portfolio with significant US exposure that is compliant and non-plant touching. That's over $300 million in size.
And Zach, the Canadian cannabis business has been pretty wild since the inception, right? There were a lot of hopes placed on it. There was somewhat of a rocky rollout in terms of regulation, in terms of getting stores open and getting the industry up and running initially. There's a lot of competition there. Where are we in terms of the life cycle, in terms of the stability of the industry in Canada?
I would say we're in the first or second inning of a true distress cycle. So you're absolutely right in terms of the factors you're referencing, but we saw a massive bubble emerge in the days running up to legalization. We're now 3 years into Canadian legalization, and this industry has been plagued by poor capital allocation, oversupply, both in terms of flower, as well as licensing itself. And when you combine that with a certain amount of regulatory dysfunction, which is very, very idiosyncratic to the Canadian industry, you sort of get what we have today, where there are many companies that are failing to reach profitability. And we see 2022 as a year that's going to be somewhat of a reckoning in the space, where you're going to see attrition, some consolidation, and quite a bit of bloodshed as well.
And speaking of idiosyncrasies, we have that here south of the border as well, in terms of obviously state by state, the rules differ. There are some hopes riding on national legalization, but that has not materialized. You talked about your investments in the US, but obviously there are regulatory hurdles for cross-border commerce as well. Are there plans, though, for you guys to get involved in a more concrete fashion in the US? What would need to change from a regulatory perspective?
So without a federally legal backdrop, we are not going to be engaged in any plant touching activities in the US. We're big believers in earning the right to take risk. And we are working hard every day to build what we believe could be a dominant business in the Canadian landscape. And if we're successful with that objective, we think that a lot of doors will open up. But for the time being, we're not chasing opportunities internationally on the operations side. We're really focused on building a solid and profitable, sustainable model in Canada. But the opportunity in terms of capital deployment was really too interesting to ignore. And so we've been able to invest in secured and structured credit on a compliant basis, where we're not engaged in plant touching activities, but we're able to partner with some of the highest quality operators in the US to help them fund their growth and other M&A aspirations.
So Zach, you guys report having 2.5 million individual shareholders. Now that is an incredible number. That's from back in July. Is that the latest data that you have? And why do you think that Sundial is one of the companies that caught retail investors' attention?
It's a great question, and we did disclose that in connection with our AGM. So that's the latest data we have. So I'd say it's about 2.5 million. Interestingly, there are over 1 million accounts with Robinhood specifically that hold Sundial shares. So the retail participation and really dominance in terms of our shareholder register is very real.
And how have you courted? I was just curious how have you courted them specifically as well, kind of since that happened? I mean, we looked at your stock chart, we saw that spike, we've seen the shares come down. Do you feel like you have to sort of catch the interest again? There are benefits, obviously, from a capital perspective to having the stock go up?
It's a great question, Julie. The way I would explain this is that, no, we did not seek this. We did not court this activity. I'm actually a CEO that's largely off the grid when it comes to various social media channels. So this has been a very unique experience, to say the least. But what I would say is, if you look at the life cycle and history of Sundial, we were in August 2019 IPO. The IPO process went very poorly. The business was focused internationally and had a significant cash burn rate requiring it to be restructured. And I was brought in 2020 to lead that restructuring. So I've been in the seat almost 2 years at this point. But in 2020, we had to take some aggressive measures, including orchestrating debt for equity swaps, and also raised a significant amount of equity capital. And that dilution, which was required in order to save the business, actually drove more liquidity. So the way that I think about this retail interest, number one, I think it's important to note that the support that we've had from our retail investors is absolutely an essential ingredient in the survival and success of the business thus far. It's enabled us to survive some less than ideal decision making, and we've pivoted, and our strategy has evolved significantly to this two-pillar strategy that I mentioned previously. But I think about it in terms of interest and access. And so if you look across the monthly reports, for example, I use Robinhood as an example because it's a great indication and barometer for retail interest. But you can see very clearly that when you look at the top 10 securities held within Robinhood counts, from time to time, there's been a reasonably strong presence of cannabis related equities. So you have a demographic, however you want to color that, that is enamored of cannabis generally. And so there you have the interest, which is also driven by both the volatility and trading liquidity of the shares themselves. And then access is also critical as well. And when you compare us to other companies, you see a lot of US MSOs, for example, that cannot access US listings. And so they are listed either on the CSE or the TSX, for example. We chose in early days prior to my arrival to list on NASDAQ. If we hadn't done that, our path and this story would be very different, and I probably wouldn't be here today. But on the backs of that interest, we were able to raise over $1 billion Canadian, which enabled us to create a debt-free balance sheet and build out a very attractive investment portfolio, support our operations, and we're still sitting on north of $500 million in cash. So very well positioned to take advantage of distress in the sector.
Yes, definitely. So really great to catch up with you, Zach. Hope to have you on again to talk about where you are, a month, 2 months, 3 months from now. Zach George is Sundial Growers CEO. Thanks again for being here, Zach.
Thanks,
Coming
Julie.
up next, thank you. Coming up next, no fee, no problem. In fact, no problem at all. How zero commission brokers helped spark the retail trading revolution. We'll be right back.
It sort of signifies the massive shift that we've seen in terms of who the investor is. The retail investor is very much loud and strong in this market.
It really was a momentous year. And you have to start with the meme trade.
These are really new investors to the market that have joined the market because of the frenzy we saw in January. 10 million new brokerage accounts were opened in the first half of this year.
Mish, what do you make of what's happened this year? I find it simply incredible and also encouraging at the same time.
For now, I've kept on accumulating shares, and I will be doing so in the future if I have any money left.
You've had a whole bunch of retail traders that have made a whole bunch of money over the past 2 weeks in GameStop and now AMC. Where do they go next?
Welcome back to our special presentation, Retail Revolution. Let's bring in Yahoo Finance's Jared Blickery, who watches all the charts and all the stats for us. And Jared, as we saw from those little sound bites we were showing before the break, you were definitely part of this ride along with us, watching all of this unfold this year. What are some of the things from the past year that really stand out to you?
Well, Miles stood out to me. He was in that video too. Good to see him. But I want to go to the Wi-Fi Interactive. What stands out to me is we all know what a meme stock is now because we kind of know it when we see it. It just pops out of the blue. We did try to define this early, and we borrowed some of these bullet points from Bloomberg, I believe. But this was your construction, Julie, towards the beginning of the year. So what makes a stock a meme or a meme stock? Well, first, low share price, and not all of this applies anymore because a lot of these stocks, they have high share prices now. Market cap under $10 billion, short float over 15%, consumer facing, familiar name. All of that's well and good, but I'm not sure it applies anymore because, like I said, a lot of these companies are pretty big. And if we go to our heat map here of our meme stocks, now this is, let me set this to market cap. And we're going to go to an intraday. There we go. And we can see, for instance, AMC is now a $12 billion stock. Let's see, GameStop is $10.5 billion. Hertz is an $11 billion stock. This is a company that went bankrupt in May of 2000. Let me just put a max chart on here. Let's see where this brings us. So they re-IPO, they relisted, looks like about midway through the year. But before that, it had been an absolute disaster. And guess what? Hertz is issuing a buyback notice for $2 billion. Kind of shows you where the market has gone. And of course, Liz Warren is pushing against that and everything. But this speaks as to the way a lot of these companies have simply changed the capital structure of their market, of their fundraising abilities. Now, you take a look at GameStop, for instance. This is max view. Let me just dial this back to a 2-year view. And let's remember, Wall Street Bets was something, this was a phenomenon, not a worldwide, not a US phenomenon, but it was a phenomenon last year. Roaring Kitty had a thesis on GameStop, and that thesis worked out. Now, did we expect this to go to, let's see, $350, $360 per share? Probably not. But I think another thing that stands out in these charts, I'm going to put a year-to-date candlestick chart on here, is just the incredible bouts of volatility. And there's been more than one. Right now, this is the late January, early February period. Here we have in March, here we have in June. And to a lesser extent, we've seen some rises here, but nothing of the magnitude of order that we saw before. Now, I want to bring this particular stock, this is GameStop, this chart back to a 3-month view, and we see some negative price action here. That is indeed the point where we're seeing this. Now, if I take this to a 1-month view and sort by performance, we can see a lot of these stocks under a tremendous amount of pressure. And then I switch to a year-to-date view. If you're in from the beginning of the year, now some of these stocks are dogs. They're down more than 90%, but a lot of these are winners. AMC up almost 1,000%, GameStop up over 600%, Julie.
Yeah, so it's definitely differentiated, which is quite interesting here as we arrive at this point in the year. Jared, stick around because let's talk about the vehicle by which people were getting into these stocks. And of course, there were a number of options, but one of them was Charles Schwab. Now, Schwab was among the first mainstream brokerage firms to drop its commission fee. That happened back of October of 2019. And then really we saw a lot of the other discount brokerage and online stock brokerages to follow suit. Joining us now is Jonathan Craig. He's head of investor services at Charles Schwab. Jonathan, thanks for being here. Jared's going to stick around as well. So talk to me about that point in time, right? Which obviously preceded all of this action that we had this year. But do you think that was a real turning point in the industry? And how did it pave the way for what happened in early 2021?
Sure. Well, first, thanks, Julie, for having me. It is such an exciting time, as you point out, for the retail investor. I do think in many ways, there were probably a couple of turning points. I think certainly the commission move we made in 2019, after which much of the rest of the industry followed, did remove a lot of cost friction from the equation. And probably not surprising, we have a 50-year history of reducing costs on behalf of investors. So this was the next logical decision. I think it was a couple other things. There's been so many digital innovations and other innovations that just make investing easier than ever. And then, of course, fractional trading has become a lot more prevalent. And I think it really probably is that combination of fractional trading, being able to buy a slice of an individual position, removing the cost friction almost entirely, and just digital innovations and mobile enhancements that collectively has really helped lead to the rise of the retail investor. And then, of course, the pandemic gave people a little bit more time to engage with the markets.
And Jonathan, with trillions of retail investor dollars under management, I expect that you have a ground floor view of what's going on in this space. And I've been asking this question to a number of guests in this theme, which is how sticky are these retail customers? Because some of them I would think are maybe just fly by night. They wanted a taste of the action. It wasn't for them, but are you seeing a significant number of new investors, new accounts in the space, maintaining not only their accounts, but also some of their investment activity as well?
Sure. Yeah. No, I'm glad you asked that question, because I think there's a lot of people I think have speculated that many folks who entered the market during the pandemic were maybe speculative short-term risk takers, and in our data, at least the clients who've come to Schwab, that's not really what we've seen. We did a really comprehensive study of individuals who became first-time investors during the pandemic, and we found a couple things. Maybe not surprisingly, most were younger. More than half were millennials or younger. They were actually, though, a mix of some were buy and hold investors, about 56% buy and hold, and 44% more trader-centric. They tended to be pretty optimistic, which is not surprising. Many of them opened accounts for pretty straightforward reasons. Some wanted a new source of income, some an emergency fund, and some were even thinking about retirement. And maybe finally they're a bit self-directed, as you might expect, but also not purely self-directed. I think from what we saw, many were looking for also help and advice just on their terms when they want it. So I would say in our experience, certainly we've attracted many younger clients. Over half of our new clients are less than 40. But they, generally speaking, do have a long-term view and are looking for help.
Jonathan, there was sort of this conventional wisdom that a lot of the money that poured in the market was coming straight from the government, right? People were getting their stimulus checks and they were opening a brokerage account. Have you really seen those openings slow down, though? Is that borne out by what you're seeing?
Well, I mean, if you look at our metrics, I think, as I said, over 1 million new accounts, even over the past several quarters. So it's not simply about government money coming to the market. I think it's a confluence of things, but we continue to see good numbers, strong numbers, certainly very elevated relative to pre-pandemic. Not the Q1 meme stock numbers, but that was, I think, a unique time. But again, our numbers remain elevated, and we do expect that to continue. I think largely because of the reasons I said, which is cost coming down materially, fractional capability, which is so important for first-time investors. And again, it's just never been easier to open an account and start investing. So, I think for us, what we think a lot about is how do we give those new investors the tools and the guidance and the insights to be successful over the long term. Investing, we certainly believe investing should be fun, but it's not a game. And I think we see the difference.
Well, hopefully these folks will do okay if we see some more rockiness in the market. Thank you so much for being here. Really appreciate it. Jonathan Craig is Charles Schwab, Head of Investor Services, and of course, our own Jared Blickery offering his perspective as well. Coming up next, speaking of perspective, we're going to get one from a stock market influencer. That's coming up next. Matt Kors will join us.
Moon Gang. Hello. We are getting into that holiday Christmas spirit. Things are going a little bit crazy in pre-market, and it has all to do with inflation. The consumer price index report just came out, and we're at high values. We are at high values. I'm talking, look at Snoop Dogg and then think higher.
That was stock market influencer Matt Kohrs starting his show last Friday on YouTube. Kohrs' subscribers have gone from about 10,000 before the meme stock retail revolution to more than 370,000 now. And Matt joins me now. Love that you were covering CPI. That's what we were covering too, of course, Matt. So we're same page. Maybe I'll begin to start my show that way also with the I like that. So this obviously you weren't just going through this as a spectator, you were in it in terms of the meme stock revolution. What has this year been like for you? I mean, you were just telling me during the break, you quit your job back in February to do this full time. So how did that happen? How did this catch fire?
Yeah, definitely, like we were a little bit talking about there, the definition of life changing. I mean, for me, before this, I was coding. I had that classic 9-to-5 job. And with it got to an opportunity that I had so much passion and interest of what was going on and tracking the story of, it started with GameStop, and then it started including AMC. And then from there, it's just become an entire additional beast of, like, we're talking about market manipulation. We're talking about market structure. It's just so cool to experience it firsthand. For me, I feel fortunate to be at the age that I am and so quickly find what I'm passionate about. But I mean, this stuff has just been nuts. I mean, it started off with the beginning of the year. People were cooped up still because of the pandemic. They heard about GameStop. It started with Roaring Kitty, Keith Gill, and then that started to go crazy. They took away the buy button. And then once again, similar to the veins of Occupy Wall Street, people started to ask like very legitimate and serious questions. And then from there, it started to remind people of 2008, 2009, where people, let's say in a general sense, there is that underlying feeling that people in Wall Street get away with a lot and no one's really like asking them the right questions. And I think this is just kind of a rebirth, and that's what led to the cultural wildfire that is now identified as the apes.
Right. I mean, and it feels like people wanted a piece, right? That they want a piece of the action. That was part of it. How sustainable do you think this is? How sustainable has it been through this year? And how much do you think it's going to continue?
So the sustainability of this group, I think, is actually immense. I mean, month over month, starting in February, people thought the apes were going to go away. I mean, that was commonly reported, but right here, a lot of people are still paying attention day in and day out. I mean, most recently, it was just reported, I think 182 high-level congressional staffers have not been properly reporting their personal stock trades. And it's millions of people across the globe who are continuing to dig and dig and dig. And in terms of sustainability for the group, fighting for market transparency and fairness, I find it very, very difficult to bet against that going away anytime soon. I think it is 100% here to stay.
Matt Kohrs, I wish I could talk to you for much longer. Unfortunately, we have to leave it there, but I want to have you back. Come on my show also in the mornings, and we can talk more about all of this. Matt Kohrs, stock market influencer, thanks for being here today. Really appreciate it.
Welcome into this Yahoo Finance special, The Future of Crypto. I'm Zach Guzman. Happy afternoon, everybody. From meme coins to the metaverse and everything in between, we're going to be discussing that and the way that crypto culture has dominated the conversation no matter who you're talking to in 2021. Over the next half hour, we're going to explore the massive changes that took place during the last 12 months, what brought a record level of institutional adoption to the space, and what to look ahead to in the year to come. And to kick things off, we want to start with the granddaddy of them all, Bitcoin setting a record high back in the spring, falling all the way back to break even on the year and climbing all the way back just last month to a new all-time high. But just talking about price doesn't even begin to scratch the surface on what we saw this year. And for more on everything going on under the hood, happy to welcome in our first guest. You know him well. Joining me now is entrepreneur and investor Anthony Pompliano. And Pomp, good to be chatting with you again here, man. I mean, just looking back on the year, it's wild as we get ready for 2022. I'm not sure if anything stands out to you as kind of the biggest Bitcoin and crypto story here. You got the Coinbase IPO, you got El Salvador's moves, you got regulators stepping up their game. I mean, what stood out to you as maybe the big moment for you this year?
Bitcoiners are right. I think that's the simple takeaway is you can cut it a bunch of different ways. The halving wasn't priced in. Bitcoin has served as an excellent, probably the best inflation hedge asset. You have a microsailor and MicroStrategy and the Bitcoin on balance sheet kind of bet playing out almost to perfection. You have the Bitcoin backed bonds being the best performing bonds. That continues to work. And you have a nation state, not only making it legal tender, but also going ahead and purchasing Bitcoin multiple times and kind of tweeting about it as they're doing it. And I think ultimately what people are waking up to is that Bitcoin's good for business, and also Bitcoiners have been right. I mean, we'll always be right in the future, but on a number of things over the last 18 months, Bitcoiners have been right. And I think that it's really opened people's eyes to, hey, maybe there's something here and I should start paying attention.
Yeah, Bitcoiners have been right in the fact that they've outperformed the market. Of course, you and I caught up at BTC Miami earlier this year in the summer, and you were right. I mean, you were talking about countries adding Bitcoin to the way that they would be operating. And of course, right after we had that conversation, El Salvador made the move to accept Bitcoin as a legal tender. Just want to play a little bit of what you said back there in the summer and then get your reaction on the other side. Take a listen.
We started with retail. We then moved in and we started to get financial institutions. Then we got corporations. There's one group of people left and they're coming. It's the countries and the central banks. And I think people think that's a 5 or 10 year type conversation. I think that's a 2021 conversation.
And it is a 2021 conversation. I mean, when we're talking about maybe the other pieces of that too, right? I guess maybe companies haven't added crypto to their balance sheet as quickly as a lot of people would have expected after we saw the moves. Of course, MicroStrategy out there has been doing that themselves. But I mean, what are you looking for, maybe the corporate front or more countries to add this and move in that direction, I guess, next year?
Yeah, Zach, I got to tell you, I cheated on the last time because I already knew it was happening. So that was an easy call. No, but in terms of what I expect to happen kind of moving forward, definitely we'll see more and more public companies doing it. Obviously, Lemonade just came out and said they put a very small amount of Bitcoin on their balance sheet. I think that there's some people doing it for marketing purposes. Some people are doing it for financial purposes, but we'll continue to see that trend go. What is really fascinating to me is if all of a sudden the El Salvador example, kind of the nation state adoption, these Bitcoin-backed bonds, if they end up issuing that, there's an oversubscription and it performs well, then you're going to see a lot of nation states, states within the United States, and also municipalities say, wait a second, maybe we should actually start looking at this, because as we've seen, pretty much all of the municipal debt that is held by investors right now, specifically in the United States and elsewhere, it's all negative yielding on a real return basis. Inflation's at 6.8%. It's pretty hard to not be losing money on purchasing power terms. And so if you can basically add a very small percentage of that bond into Bitcoin, and that can go ahead and change the return profile, I think that's going to be a big, big story. It's hard to see right now because there's basically only one or two examples of it. But over time, if Bitcoin can really infiltrate into the bond market, there's a world where Bitcoin ends up saving pension funds, Bitcoin ends up saving foundations, endowments, nation states, etc. And it's all because of the return profile is just very different than I think what people have seen with all of this debt that, frankly, right now is just trash and people are dropping it and realizing that if they buy it, they're guaranteed to lose money on a purchasing power basis when there's high inflation.
Yeah, we've talked so much about kind of the institutional investors coming on board here too, right? And obviously the bonds would be an interesting, I guess, build out of some of that in terms of ways to access investment opportunities in crypto. But when we're talking about that, we had Bitcoin futures linked ETFs. We did not have a Bitcoin spot ETF in 2021. I'm not sure if a lot of people were expecting that to come down the pike anyways. But when you continue to look out and see, I guess, how important those two things are when we're talking about what El Salvador is trying to do and really lean into Bitcoin and the Lightning Network to process transactions versus maybe institutional investors looking at it more as a digital asset. I mean, it seems like a lot of people have kind of had shifted away from it being a medium of exchange like El Salvador is trying to pursue. But I mean, which one to you, I guess, matters more, or is it just kind of two sides of the same coin, I guess?
Bitcoin's a lot of different things to a lot of different people. And I think that's part of the beauty of it. Look, if I was evaluating this and let's say that the store of value argument didn't really resonate with me, or I wasn't interested in that, or I said to myself, hey, I need to really find productive assets. I don't want to hold something that is equivalent to just gold or another type of store of value. There's a very strong argument that Bitcoin is actually the fastest growing payment technology in the world. Right? It's got over 150 million users. It's $1 trillion asset. It settles right now about 50% of Visa's transaction volume on chain on an annualized basis. And what we're watching is more and more people are deciding to use this thing. And whether it's on the base level, kind of layer one, or it is on the Lightning Network. The Lightning Network has gone absolutely parabolic in terms of nodes, et cetera. I think that you're watching the entire world realize, why the heck would I use a payment system that's slower, that's more expensive, and also is not resistant to censorship? So when you start to add this up, you may come to Bitcoin because you want censorship resistance. You may come to Bitcoin because you want the protection of the store of value and your purchasing power. Or you may come to Bitcoin because you literally want to be able to transact with anyone in the world instantaneously, completely for free, and do it with almost no issue in terms of the user experience. And I think that's what we're watching is, there's a lot of people talking about a lot of different technologies, but there's only one layer two that's on board at a country. It seems to be working out pretty well for them. So I think that's going to serve as a great model globally over the coming years.
Yeah, that is one thing that Bitcoin does have over the other cryptos. You and I have discussed before, I guess, kind of Bitcoin's dominance coming down a bit, ending the year at kind of a low point there. As we've seen, a lot of these other crypto projects start to gain some attention. ETH up more than 450% on the year to 66% for Bitcoin. Obviously, it's not all about price returns, but if you're an investor watching this, it might be. I mean, when you look out to 2022, I understand maybe we had some information around El Salvador the next day, but when you're looking at, what are the bold calls here that you're expecting to see in terms of Bitcoin's adoption, or maybe some big things that investors should take heed of if they're planning out and maybe considering dipping a toe or maybe taking a larger position here in Bitcoin? What do you see?
Yeah, I think it's really hard to kind of look at short term and even maybe some medium term price movements. A lot of what was previously true is changing, right? So if you look at something like Bitcoin, is it becoming more financialized because there's more asset managers, more folks on Wall Street, public companies, et cetera, holding it? They're going to go risk on and risk off, similar to how they do stocks. That's one argument. The other argument is Bitcoin doesn't care. It continues to produce block after block after block of transactions. What I do know is that as an investor who sits in a position like I do, where I have a long time horizon, there's simply two rules to follow. Follow the talent and follow the users. And what we're watching is there's immense talent rushing into this entire industry, right? Bitcoin is a big part of that story, probably the biggest part of that story. But there's a ton of things, whether it's equity or other technologies, that are all getting built out by tons and tons of talented people. And then on top of that, the users. We're just watching users flock and go there. And so if you go ask a young person today, do you have more money sitting in your legacy bank account or in a crypto account? There's a lot of people that are going to say they've got more money in the crypto account than in the bank account. Now, that doesn't mean they don't have a bank account. That doesn't mean that they're going to get rid of their bank account. It does mean, though, that this thing is here to stay. There will be coexistence. And the younger you are, the more likely you are to have a higher percent of your kind of net worth or your portfolio in these digital assets. And I think that's a key story, is that over time, that younger generation will become middle-aged and then eventually kind of the older generation. And so at some point, I always say that a Bitcoiner will be president, not because the president of the United States is all of a sudden going to go buy Bitcoin and kind of change their mind about economics or anything like that. It's just that some young person 40 years from now is going to have grown up with Bitcoin or cryptocurrencies as part of their daily life, as the default. And then they're going to become the president of the United States. And so a Bitcoiner will be president. It's just not going to happen the way that I think most people think. It's just that an entire generation grows up. And this is the default. This is the standard. Why would they use inferior technology in the legacy system when they can use superior technology to protect their purchasing power, transact, and also do a bunch of other stuff?
Yeah, and that a bunch of other stuff, I think, is a quickly growing piece of the offering here, and one that we've seen absolutely explode here in 2021, looking ahead to 2022. Hope to have you back, man. Great to have discussed all these things here today and also throughout the year, but Anthony Pompliano, appreciate you coming back on to kick us off today. Be well. Coming up, we're going to dig deeper into the other big discussion here in 2021. That was regulators taking a closer look at crypto. Yahoo Finance's Jennifer Schonberger is going to join us with the latest in terms of how DC is looking at the space right after this. Welcome back to this Yahoo Finance special presentation on the future of crypto. As we were just chatting, Bitcoin, obviously the biggest cryptocurrency out there, but not the one delivering the biggest returns on the year, at least thus far. For more on some of the best performers, though, I want to bring on Yahoo Finance's chart master, Jared Blickery, with his crypto hat on to take a look at some of the best movers on the year. Jared.
Well, let's take it off to the Wi-Fi Interactive here, where we are seeing Dogecoin. This is a limited basket here, but Dogecoin up over 3,000%. And there's a theme to this. And you're going to see Ethereum, Ether is up about 450%, Cardano up 650%. But you take a look at what's happened over the last month and kind of a reversal of fortunes. A lot of these coins that were not able to make relatively new recent highs are faltering. So we see Litecoin, that's down over 40%. So is NEO. And let's just pull up a chart of Litecoin. This goes back to the beginning of the year. And you can see we had this high in May. A lot of cryptocurrencies peaked in either April or May. Bitcoin peaked in April. And then in November, when Bitcoin was making a new high, Litecoin was making a much lower high. And you can see only holding on to gains of 22% year to date. So it's kind of a story, I think, Zach, of have and have nots. You can take a look at a lot of these charts. Here's NEO, very similar formation here. Cardano, Shiba Inu. Well, Cardano, it looks like it did peak in September as well. However, it's off of those those highs. So let me change this to an intraday view, and we'll go back to our market capitalization look, and we can see Bitcoin here. So Bitcoin up over 5% over the last 24 hours. This is a year-to-date chart. Now, I said Bitcoin peaked in April, and that was this peak here. It got to a relatively new high, but only a marginally higher high, and then it sold off. And Bitcoin, I've noticed, kind of like that. Lots of fake outs in trading. So a lot of people were hoping for 75,000. No, we topped out at about 63, 64,000. And then after a little bit of a shakeout here, or maybe a bit of a shakeout, coming down to 30,000, we rose to highs again, new highs. However, we have sold off from those highs. And I think the lesson here is, well, we know that Bitcoin and crypto is volatile. However, if coins are not making new highs with Bitcoin, I would be skeptical of their ability to retain their value. So big takeaway for me for this year is crypto has definitely gone mainstream again. We've seen this retail phenomenon before. However, now it has the institutional support, and I think that's what's really making the difference here. Now, let me dial up a Bitcoin chart over the last month, and we are seeing some negative price action. We're down almost 25%, still at the bottom end of the trading range here. Personally, I think Bitcoin's going to chop around. It needs to find a new base, a new trading range before launching higher. That could take months. And if it is the case that it actually takes months to find a new bottom and to lift off and to reach new highs, and maybe 12 months, so maybe a year. If that is the case, I do think that we're in for another wild year here, but I don't see new highs in the immediate horizon, Zach.
Well, we'll see. Obviously, a lot of people were looking at it touching that 200-day moving average just this week and bouncing off of it. So anytime we see that, buckle up. Jared Blickery bringing us the latest there. Appreciate that. Of course, as I said, regulators have been taking a much closer look this year when it comes to crypto as the space has exploded and increasingly setting their targets on stable coins, traditionally one of the more quiet pieces of the crypto market, as their name intends, meant to stay pretty stable, but raising a lot of questions about the risks to the traditional financial system. And for more on that, I want to bring on Yahoo Finance's Jennifer Schonberger, who is always tracking that for us with talks in DC. And Jennifer, you and I have suffered through, I guess would be the right way to use it, the questions lobbied at crypto executives this year in congressional testimony. I mean, we've learned a lot about, I guess, the incremental steps that they're taking to rein this industry in.
Hi, Zach. Indeed, one of the biggest questions facing cryptocurrencies for the new year will be how Washington regulates them. This year saw officials in Washington sketching out new guidelines and recommendations for how to regulate stable coins, and they have tasked Congress with coming up with a brand new regulatory framework. The new year could bring new proposals from lawmakers. The chairman of the Senate Banking Committee, Senator Sherrod Brown, says the committee is seriously looking at new rules for stablecoins.
I am certainly looking seriously. My staff on the Banking Housing Committee is looking seriously at that. We're consulting with the regulators. I know that SEC and the Fed, especially SEC and also the Fed and Treasury, are in this space already looking to write rules and regulations around this. They may recommend that Congress take action too. I think from some private conversations they might. I'm ready and willing to do that. I'm not yet able to do that in the sense of knowing specifically how to do that in which direction. I mean, I know the general direction, but I don't know the specifics yet.
As both parties sift through how to regulate stablecoins, the ranking member on the Senate Banking Committee, Senator Pat Toomey, has put forth some principles on stablecoins to serve as a guideline for future legislation. Toomey does not think that stablecoin issuance should be limited to insured depository institutions, noting that stablecoin issuers have different business models than traditional banks, and that requiring all stablecoin issuers to become banks would stifle innovation. Toomey underscores that all stablecoin issuers would be required to adopt clear redemption policies and disclosure requirements of their reserve backings. This after the Biden administration has recommended that only banks be the ones allowed to issue stablecoins. The Federal Reserve Chairman Jay Powell thinks that stablecoins can be useful, but says they need to be properly regulated.
I, of course, would support the the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated. And right now they aren't. And they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist. And you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections.
Investors are also awaiting a paper from the Federal Reserve that could offer clues as to whether they would pursue a central bank digital currency, something that China is already pursuing. At the same time, the Federal Reserve, along with other major financial regulatory agencies, have sketched out a to-do list of what regulations they should pursue for the crypto space. That so-called crypto sprint, as they call it, will focus on oversight of how banks could store crypto assets safely, handling exchanging customers' fiat currency for cryptocurrencies, settling and executing trades, looking at loans backed by crypto assets, and issuing stablecoins, and of course, tax services. Lane Reddig, a former core developer of the cryptocurrency Ethereum, says that new regulations could actually push cryptocurrency prices higher. So these new regulations could create more clarity if we get some next year in the new year. Back to you.
Jennifer Schonberger there for us. Appreciate that. Coming up, the leading edge of crypto. We're going to chat with a leading NFT investor and expert with us, Megan Casper from Magnetic Capital, joining me right after this. Stay with us. Welcome back to this Yahoo Finance special, The Future of Crypto. As we've been discussing, 2021 has been a banner year with the explosion of NFTs, providing a huge boost to Ethereum and prices there, activity on that chain as well. And for more on that, I want to bring on an expert in the area of NFTs. Megan Casper, Magnetic Capital Director, joins us here, as well as a member of the DAO, Red DAO. And Megan, appreciate you coming back on. You're sporting the NFT earrings here, of course, which kind of just goes to show you are indeed an expert in the NFT area. As we've discussed, it's been an explosion in terms of NFTs, wearable NFTs even. But let's back up and talk about Ethereum too, because as we discussed this year, you had some lofty goals, obviously based on a lot of upgrades to that network. You saw a potential chance to hit 8,000 to 10,000 as those upgrades were I guess, pushed back a bit. So maybe we'll wait a little bit for that. But talk to me about where you see Ethereum going in the short term here.
Well, we did anticipate to see a market cap for Ethereum hitting around $1 trillion, which would put the price point for Ethereum between 8 to 10,000. And that was based on technical analysis and 2 Ethereum network upgrade conditions that were set to trigger over the course of this year, before the end of this year. One of them did, and that was EIP 1559. And that's drastically decreased the gas prices on Ethereum, but it's also burned over 1,100 Ethereum, which is equivalent to about $5 billion. So that's been great for the network, but the one other network upgrade that we anticipated to see is the transition from proof of work to proof of stake, and that's called Ethereum 2.0. And in November, the Ethereum Foundation did an announcement that they'll push that network upgrade to about June 2022. So there's a good outlook next year for Ethereum. But Ethereum did still outperform Bitcoin this year by over 350%. So, it's keeping it the second largest crypto out of all the market cap, the highest market caps for all the cryptocurrencies. And I still foresee there being greater upside potential and Ethereum being a more superior asset to invest in than Bitcoin.
Yeah, it's been interesting. It's been interesting to watch that play out this year, especially as we talked about the explosion of NFTs and options there to kind of reduce some of the loads on Ethereum. We've seen Polygon really take off when it comes to maybe people transacting. Also, these other chains popping up, Avalanche and Solana, to kind of also build out capabilities there in the NFT space. When it comes to, I guess, how investors should look at NFTs, though, I mean, you've obviously been investing in specific projects, but even backing up, if people watching this if they don't even know the specifics or the granular projects themselves, there's still a way to invest around that, right? I mean, Ethereum might still have the most activity, but there are other chains out there that are gaining some now too.
Yeah, there are layer 1 alternatives like Solana Solana and Near. I would say Near is a good layer 1 alternative for Ethereum, but the alternatives still don't have the same ecosystem. Ethereum has the strongest ecosystem. There is more DeFi, total locked value in DeFi, about 96 billion on Ethereum. The NFT sales for this year were over 12 billion on Ethereum. No other chain has anywhere near that amount for NFT sales. Also, all the top NFT collections, like the collections that Red DAO also invest in, Axie, CryptoPunks, Bored Ape Yacht Club, Artifacts. Here, one of the Artifact drops that recently happened a few weeks ago.
Yeah.
And so these were all on Ethereum, and even the metaverse platform, Sandbox, Decentraland, Somnispace, everything is happening on Ethereum. And that's why really there's the most upside potential there in the ecosystem, but not to say that, we can't discredit the other, the alternatives. These are still good, ecosystems to pay attention to. And then I think for 2022, the layer 2 Ethereum solutions like Polygon, pretty much every startup company that I speak to, they're all building on Polygon. So I think that speaks volumes to what the possibilities are for the growth in that ecosystem as well.
Well, if people watching this are new to crypto, they might be kind of blown away by the fact that you're wearing virtual earrings and also those NFTs we just showed on the screen there, CloneX. Obviously, you own them through Red DAO. And when we talk about maybe what's important there is Nike just acquired the company behind them, right? Artifact, that pushed those out. And it's, we've seen Facebook this year change their name to Metaverse, so much attention being placed on that. What makes projects like those stand out? And CloneX and I was looking at the prices and some of these 40 ETH, right? I mean, we're talking about tens of thousands of dollars behind those things, but they're not just art anymore. Talk to me about where that space is going.
Well, CloneX, Artifact did the drop with CloneX, and they also did a collaboration with the artist Murakami. So some of these clones have Murakami DNA in them. The drop itself, people could mint if they had prior items from Artifact for around 0.05 ETH. up to 3 Ethereum. And now the floor prices for these clones and the virals have several multiples, up to 4 and 5x. So the project itself has done very well, and it's very nascent. The announcement of Nike acquiring Artifact happened on Monday, but there's a lot of utility that's going to come out of these clones. The functionality that they're offering. If you own a clone, you can have a space pod airdrop. So it's a really cool augmented world that your clone can live in. And I think that we'll see play to earn and where to earn models come out of clones from Artifact, and just greater utility beyond what you can do with any of the other existing NFTs today.
Megan Casper there, a member at Red DAO and Magnetic Capital Director. Appreciate you coming on here to chat with us, sporting the NFTs once again and explaining a bit more of what's going on there in the NFT space. It was a wild ride here, a short ride for the future of crypto, covering everything from Bitcoin to the bleeding edge of NFTs. Appreciate you viewing this with us, taking the time to watch here on Yahoo Finance Live. That's going to do it for me, Zach Guzman, signing off. Thanks again, and stay tuned for much more here on Yahoo Finance Live.
And insight from meme mania to Omicron overload, investors navigated it all, sending the major benchmarks to new records in 2021. But as we close out the year, we'll ask our analysts what 2022 has in store for the bulls and the bears. Breaking news on the timeline for emergency use authorization of the Novavax vaccine. That as daily case totals continue to shatter records and mute New Year's Eve celebrations for much of the world, we ask a medical professional the one question on everyone's mind as they ring in the new year: when can we kiss this virus goodbye? And while there are still some celebrations around the world to bring in the new year, many airline passengers have nothing to cheer about as thousands of flight cancellations continue to put a damper on holiday plans. We'll ask which airlines are navigating the New Year's nightmare the best and which are fueling the fiasco. A very happy New Year's Eve to all of you watching. Thanks for spending some time with us. I'm Karina Mitchell along with my co-anchor Jared Blickery on this final trading day of the year. And what a year it has been, Jared. The S&P up 27% year to date. The Dow up about 18% since January. What a ride.
Yes, what a ride it's been. And I'm looking at the Wi-Fi Interactive. Fortunately, not a lot going on. In fact, if anything were going on today, it would probably be to the downside. We see the Dow up 5 basis points. So is the S&P 500, and the NASDAQ down not even 0.2%. And just checking out the sector action, kind of random today that I've been noticing. Real estate is in the top spot. By the way, the #2 sector of the year, having its best year ever, up over 40%. Materials, industrials, and staples are each up more than 0.3%, and communication services and tech, those mega cap sectors, those are the ones in the red there, Karina. But we want to get more on the markets today. And for that, we're going to bring in Rich Sega. He is a global chief investment strategist at Conning, which is an institutional asset manager. And Rich, just got to start out by asking you, what are you making of this year, 2021, and what are you looking ahead to in 2022?
Well, Happy New Year, everybody. Thanks, Jared. I hope everybody's ready for a pretty good 2022. Maybe not great like this year. This year was a transition year from an absolutely devastating 2020. So it's hard to replicate that. But I think the building blocks are in place for a pretty good market, so long as some of the risks that are out there don't come to fruition.
And sir, what does inflation look like to you next year? When does it start to moderate? And what does the growth picture look like? Because we've had 3 years of double-digit growth on the S&P. And then if growth does slow, where are the opportunities we should be looking at, perhaps outside of the U.S.?
Right. Well, first on the inflation question, you got to think about this in the way that Gretzky used to think about the puck, where it's going and not where it is. I think we're peaking in inflation now, and we have to think about what's going to happen in the next couple of quarters. I think there are a number of potentially at least disinflationary, if not deflationary forces that we're going to see. One of them is supply chain repair. We're hearing a lot about the backup of container ships and things that are caught in transit. One thing about the economy and the production side of the economy is when demand outstrips supply, production does what it usually does. It ramps up and finds ways to do it. If the economy and the people that act in it are allowed to exercise their innovative urges, and hopefully we won't have regulatory impediments to that. The currency relative strength is another thing that I think will help moderate the effect of inflation. We have inflation. It's real. We're not going back to 2019 levels. So transitory doesn't mean a reverse. It just means that the changes in the efficiencies in the economy that cause prices to rise, unless they keep changing, they're likely to level off. So I think inflation moderates into the next couple of quarters. And the third factor is a big one. And I think that's China. China is slowing, and in their strategy of trying to keep their economy going both internally and with exports, mostly to the US, means that their currency will adjust and we'll have cheaper prices on products from China. So there's another moderating force on inflation. So I've been in the transitory camp. Oh, I'm sorry, go ahead.
No, go ahead, please finish your thought.
I've just been on the transitory camp, with transitory means that it will cure itself without policy intervention. And that's one of the risks, is that we have an overwrought policy intervention on this coming soon. But hopefully we won't get that, and I think we'll be pretty good going into 2022.
I just want to further touch on China and ask your opinion on China tech. What are you interested in that space at all next year, or are these regulatory concerns that Beijing keeps throwing out going to sort of, be a wrench in that?
That is definitely a concern, and more broadly than just the Beijing's intervention in the tech markets. The clients that we typically at Conning manage for are regulated in many ways, essentially insurance companies and pension funds, and we're always concerned about the regulatory environment. So anytime there's impending action by regulators and policymakers that will affect the sector differentially, we are concerned about that, and we have to watch it pretty closely. Certainly the Chinese tech sector is one of them.
And we got time for one more here. Given your investment thesis, you say growth is going to continue to stay strong but moderate next year. How does that fit into your expectation for Fed rate hikes? Market's pricing in 3, the Fed is pricing, but at least has indicated on their summary of economic projections, indicating 2. What do you think is going to happen?
Well, certainly the way it looks again right now that we're facing inflation and we're going to see action on the part of the Fed. I think if they're prudent about it, and Jay Powell has been very measured and prudent, I think, in his actions so far, assuming it gets reconfirmed by the Senate, we will have early moves. The QE, ending QE, I don't think matters one way or the other, but the rate hikes would. And I think 3 and 4 are probably on the high side. If inflation moderates the way I expect it to, I don't expect to see even 3 hikes this year.
All right, we will have to leave it there. Rich Sega, Global Chief Investment Strategist at Conning, an institutional asset manager. Thank you so much for your time today, and Happy New Year's to you. I hope it is healthy and safe for you. We are going to take a quick break, but on the other side of it, a new announcement from Novavax about the timeline for its vaccine in the U.S. Stay with us.
Welcome back. Some breaking news on the COVID front. Novavax has now submitted its final data package to the U.S. That would be the FDA, and that is in anticipation of being able to obtain an EUA or an emergency use authorization for its coronavirus vaccine. And they have expected to, they expect to submit a request for this EUA within the next month. For all of this and more, we want to bring in Yahoo Finance's Anjali Khemlani. And Anj, we're seeing the stock up on the news. Moderna's up about 2%. What are the details here?
That's right, Jared. We know that Novavax has been really edging towards getting their submissions by the end of the year, telling us numerous times that the end of the year was their target. They did not file the actual emergency use authorization, which is what many had hoped and what CEO Stanley Erck had mentioned a couple of times. But it seemed like as we got closer to the end of the year, it was really just making sure that all the boxes were checked. And this is that final one in order to be able to get the go-ahead from the FDA to file that emergency use authorization. He previously told us that we should expect this. Listen.
We've got just a ton of activity going on the regulatory side, and we're working with the FDA to hopefully get our filings in to them before the end of this calendar year. we'll be filing within the next few days.
So as you can hear, they made it to the end of the year. However, they have to still wait about 30 days before they can actually submit the official emergency use authorization. The CEO has also said that Q1 is the target for ramping up production. And that's in part to do with the filing today. That's really some of the manufacturing details and controls. That's the data that was remaining to be submitted. So hopefully we'll hear from them, within the first quarter of the year for that actual emergency use authorization. Meanwhile, looking to the rest of the country, we know that there is a lot going on with cases spiking. Another new record set by the U.S., nearly 600,000 cases in a single day, moving up that weekly average to 355,000 cases in a single day on average. And that is another world record. The U.S. now accounts for really a majority of cases in the world once again, unfortunately. And that's prompting a lot of things to happen. So firstly, we know that New York State has said that there are vaccine mandates for private employers and mask mandates for indoor use is going to be in effect until February. And that's really in time with what we've heard some experts say could be the peak of the current surge. Meanwhile, we also know that the FDA is poised to look at Pfizer's vaccine for adolescents. That's the 12 to 15 range, for boosters. That's going to be the next thing on the docket next week. So stay tuned for that. As well as globally, we're looking at what is happening with this Omicron waves. And new positive news from South Africa that they are in fact seeing the decline in cases and probably the tail end of this Omicron wave for them. So that's where things stand right now. Back to you.
Yeah, no, Anj, stick with us here because I want to get more color on the situation by bringing in Dr. Howard Foreman. He is the Yale Professor of Radiology and Public Health and co-host of the Heart and Veritas Project. Doctor, thank you for joining us today. You've been listening to Anjali tell us about the rising COVID cases and the response by various agencies and governments around the world, most notably, at least with respect to me, New York State, extending the mask and vaccine requirements, mandates to the end of the month. We see a lot of banks in the city here giving employees another week or two to kind of give them a little bit of leeway before coming into the office. What are you making of the situation right now?
Look, I think people foretold this over a month ago, but it almost seemed impossible to imagine that you could have yet another variant, another wave coming here that would be worse, at least from an infectiousness point of view, than any prior wave. And this has met up to those expectations, even as people didn't believe it. Just today, just in the last 15 minutes, Florida announced 76,000 more cases as of yesterday, because they report with a one-day lag that breaks a record for any state. And undoubtedly, New York will break that record today. So we're just seeing records that used to be large numbers for the entire country coming out of single states. It is paralyzing the workforce. People, even under the best of circumstances, are isolating for several days and not rejoining either their family or their workplace. And what we're seeing in the hospitals right now is a large surge of patients, because even though every bit of evidence is that Omicron is milder in terms of its impact on individuals, likely including both vaccinated as well as unvaccinated individuals, what we are seeing is that as a percent of that, even if it's smaller, it still means a lot of people are coming into the hospital and requiring care.
Dr. Foreman, I want to talk about that. You said you mentioned about Omicron and the fact that some people didn't believe that this could happen, and it has. I want to talk about that in context of the vaccines, noting this Novavax news. A recent report out from Politico also pointed out that because of the delays, we have to recall Novavax was supposed to really file earlier this year and has been delayed. The Biden administration now concerned about the effect or the impact of broad use of boosters, not just here in the U.S., but globally, and what that means for the vaccine equity problem globally as well. And it seems to me it's a bit of a pivot away from when we were first rolling out boosters, when we heard them regularly say we can boost as well as provide, distribute equally to the world. It seems like they've pivoted a bit away from that. Are you concerned that maybe this is a little bit too late, this recognition and the impact that it might have on globally vaccinations and then, for that matter, variants?
Yes, and look, we all know that there is a global shortage of supply of vaccines and vaccination programs for that matter, and that there are large swaths of the world that are under-vaccinated who absolutely want vaccines. In the United States, we're in the opposite situation where anybody who wants a vaccine, anybody who wants a booster is able to get a vaccine, get a booster. During the summer, it was somewhat reasonable to say, why do we need to be giving boosters when we know the vaccines are doing a very effective job at preventing severe disease and hospitalizations and death? Right now, we're in a situation where transmissibility is so high, and we know that the boosters actually do reduce that they have come back into sort of vogue as a policy piece, as one additional tool that we have to reduce spread. And so we've been emphasizing that and encouraging that. My own personal experience in the emergency room right now is that the only patients that I'm seeing with severe breakthrough COVID are either very elderly people who are overdue for a booster or individuals who are immune compromised. Other than that, the vaccines continue to hold up very well. The entry of Novavax, or for that matter, any other vaccine into the global armamentarium available, is a good thing, and we should be encouraging it. Even if we don't use it in big numbers here, it will come into play as being effective for our global effort against COVID.
Doctor, thank you so much for being here and your time today. Following up on that, since the vaccines do work very well, wondering if you can weigh in. The CDC just announced that even if people are vaccinated, they shouldn't be getting on any cruise ships right now. And I'm wondering, do you agree with that? And why in particular cruise ships? Why not then airplanes or trains?
Yeah, so cruise ships are not just vessels for transmission, but they're sort of petri dishes, as we say, because people stay in them and then continue to interact with one another. So it's not just that I might get infected on an airplane, but when you're on a cruise ship, I might get infected and then infect 7 other people with something that's as transmissible as this is. So I can easily understand why cruise ships fit into a different category. It is not clear to me at this point whether we're seeing substantial disease on cruise ships. I know that there have been some hospitalizations of some cruise passengers. For the most part, it's been asymptomatic and mild infections. And I would presume that the majority of the individuals on these cruise ships are confirmed as vaccinated, although I realize that's not necessarily a requirement for the cruise ships. But cruise ships are very different. It's not just about transportation. It's about living with other people. And therefore, the transmissibility issue becomes very important.
And we're going to have to leave it there. We really appreciate your time and your explanations, breaking it all down for us. Dr. Howard Foreman, Yale Professor of Radiology and Public Health and co-host of the Health and Veritas podcast. Coming up after the break, a conversation with the C-suite of the NASDAQ and also the Northern Trust Wealth Management Company. After this.
Welcome back to Yahoo Finance. Well, let's take a look back at our Yahoo Finance's All Market Summit for a conversation on investing with purpose with Northern Trust Wealth Management CIO Katie Nixon and NASDAQ CFO Ann Dennison. Take a listen.
Well, it's been such an interesting journey for ESG over the last, really, I would say 24 months. We've always had sort of this bubbling up of interest across our investor base for wanting to learn more about ESG. So we've been having these conversations for quite a long time. But it's been really recently in the last couple of years that we've seen those conversations translate into portfolio action. And I guess I can draw it to two things that have happened. Clearly, the pandemic really laid bare some of the big issues that we're dealing with from an S perspective. So the social unrest and the income inequality that we all experienced and saw over the last couple of years has really, I think, been a wake-up call for investors that they really have the power to really focus on that and potentially drive some change. Also, in the last couple of years, we've had some pretty extreme climate events, and I think that has also laid bare the need to focus on the E of the ESG. And then finally, I'll say that what we've seen across the families that we work with is really a desire to build a bridge between the generations. And what we've found is that the ESG conversation can really help build that bridge. So clients are using and families are using the conversation to try to engage the next generation into the important conversation about values and about the responsibility that comes with wealth.
Speaking of building bridges through ESG, and you took over as NASDAQ CFO earlier this year, so it's only been, I guess, just several months since you've taken over this position. And in that very short time, you've already revitalized NASDAQ's ESG reporting. How are you approaching ESG at the NASDAQ today?
Yeah, sure. So I think for us, what the most important thing is it's not a separate thing. So we're making, ESG as part of our overall strategy as an organization. And so when I think about it, there's two pieces for NASDAQ. One is on the corporate side. We think about, our sustainability and how we report it to investors and stakeholders. And then the commercial side, where we look for, solutions to help clients solve problems. But on the corporate side, it's a journey, right? We're maturing, we're improving our statistics, we're also improving the data underpinning all of the reporting that we do. And so as CFO, part of my duty is to make sure that we're disclosing, the right things and also expanding those things, but also that, investors can rely on it and that it's, standard and they can think about it across industries.
And talking about disclosing the right thing or the key metrics, I guess what's key when discussing this or communicating your ESG vision to investors?
Yeah, for what's key for us is really the transparency and, understanding, obviously, maybe not just investors, but more broadly, what all of our stakeholders want to hear from us. And so, we're engaging with our investors, our employees, our suppliers, the community, and understanding, 100% of the conversations that we have with investors has some element of ESG as part of that, the discussion, whether it's the corporate strategy or the commercial strategy, and really taking what we hear from all of our stakeholders, investors being a big, part of that group, and making sure we're listening, we're hearing, and that we're, adjusting our disclosures so that they can, evaluate us in a way that they want to. And so we have, a new org structure around the reporting that sits, within the CFO or the finance world, the head of corporate ESG. But we have a lot to continue to do to keep executing and giving investors what they need.
So, Katie, there certainly is more of an interest in ESG, yet we're still seeing this gap between investors showing interest and then, of course, those taking action. Why do you think this is, and what do you think is needed in order to close that gap?
So I think Anne actually hit on some of the key issues here, and one of them is measurement. We're still, she used the word journey. I love that word because we're still on a journey here and figuring out how to collect consistent data, how to measure success. And I think, investing is a quantitative business. So without having those quantitative anchors, it can be really difficult, I think, for many investors to make that leap of faith into a full ESG solution. So that's been an impediment, sort of the lack of consistent definition, the lack of consistent data, the lack of being able to really measure success. But we're really seeing that evolve over time and improve over time. And so I do think that as an impediment will lessen and lessen over time. And then it comes down to really deciding how investors want to implement an ESG strategy. And they can do everything from a passive strategy to full-on integration to SRI and impact investing. So it's a more complicated conversation that requires a little bit more sort of self-discovery than a typical investment conversation has. And that just takes time. So we do think with the improvement of data and the evolution of time, we'll see many more sort of words turn into action on the ESG front. And we're already seeing that today, Shauna. We're seeing a lot of investors really want to put their money where their mouth is on the public equity side, on the private equity side, really develop strong family mission statements, family value statements to really intentionally align their investments with their family values.
Welcome back. Well, if you're traveling today or this weekend, you may be facing some delays or even cancellation. The latest stats are in for Friday today. Total cancellations in or out of the United States, 1,391. And as for delays, 6,415. Here to break it all down for us is Jonathan Ruth, the Moody's Senior Vice President. And Jonathan, despite these troubling statistics, we're still seeing TSA numbers in terms of total passengers lap those of 2019 in some days. And so the demand still seems to be there.
You're right, Jared. There is tremendous pent-up demand, and we expect that to continue. So as you said, TSA volumes in the U.S., 80+% of 2019 levels. It's just a strong indicator of how pent up is demand. And we think that's going to continue. And Omicron, the headlines, over 1,000 cancellations a day, big number. We don't know how many of those people being screened don't ultimately get on, on an aircraft and make their trip. But we do consider this to be a temporary issue for the airlines, which, they will work through as we all face weather events and, infection rate trends.
And Jonathan, I want to ask you just some more statistics. JetBlue cancels about 17% of its flights as of yesterday, Allegiant nearly 20%, United Airlines about 9%. Are there certain airlines that are weathering this fiasco a little bit better? Not sure if we hear you there. Just wondering if some of these airlines are weathering these sort of delays and cancellations better than other airlines are.
All right, it seems that we do have some issues here. So we're going to take a quick break and we're going to be right back after this.
Welcome back to Yahoo Finance. Well, this year saw an unprecedented number of cyber attacks in the U.S., but our next guest says there's still more to come. Here to tell us what to expect and how businesses and individuals should prepare themselves is Tony Anscombe, ESET Chief Cyber Threat Officer. Tony, thanks so much for joining us today. I want to start off with a fascinating statistic. Ransomware attacks obviously hit hard in the U.S. this year, and one of the biggest culprits, you say, was Revel. How much did they make away with?
Well, you have to understand that ransomware is a business as a service. So when one of these gangs say they made $200 to $500 million, and I think the number they put on it was around $500 million, that means the actual payments from corporations and organizations paying the ransom was probably near $1 billion or even more, because you have a reseller channel and then the service provider. So this is a split revenue stream.
And Tony, I want to get your take on a particular cyber threat that's attacking Apache servers. It's been called, and I have a quote here from a former Obama official, this is one of the worst vulnerabilities in the history of vulnerabilities. It's called Log4j. And it popped up on my radar only because we had a guest who was saying virtually the same thing, that this is unprecedented in scope. It has such widespread deployment right now. It's going to take small businesses and large businesses thousands and thousands of person hours in order to correct. This seems like a perfect candidate for ransomware. I'm just wondering what your threat level assessment of it is.
Well, this was definitely a critical issue because this is a small piece of code that's open source code, so it's freely usable and freely available code that then other companies have used in their products or services. So then you see this one small piece of code that has a vulnerability in it affecting thousands of products or services that other companies may use. And in fact, in a lot of instances, companies may not even realize that they have this piece of code in use in their organization because it's not a product of its own nature. So companies have had to scan all their services and their software to actually find out if this software is in use within their organization. And that takes time, and it takes a long time then to go through each individual piece of software to mitigate the issue, i.e. patch it or turn it off or find other ways around securing it.
And Tony, what are some of the biggest threats that have been posed right now, especially during the holidays for business and individuals as well, that they need to be aware of?
Well, actually, that was probably one of the biggest ones over the holidays, because that happened just before the holidays broke. So that's a huge issue. But if we look forward going into the 2022, I suspect we're going to see lots more regulation. And while that's not specifically the threat, I think it means cyber criminals will adapt. They won't want to actually see their revenue stream disappear. So they're going to adapt their attacks and go in other directions. And actually that causes businesses then to look at other places in their networks and their systems of how they need to protect them. And it's an unknown of where cyber criminals might go next.
And could you expand on some of the regulation that you expect coming down the pike, specifically the Securities and Exchange Commission? We have Gary Gensler as a chair there. He's been pretty heavy-handed in certain areas like crypto regulation. I'm just wondering what you expect on the cybersecurity front.
Well, you've already got some regulation in there. So the SEC already requires material cybersecurity incidents to be reported. But you've also got going through legislation, you've got the Ransomware Reporting or Disclosure Act. You've already got the FDIC made a statement in December of increased reporting requirements for financial institutions. So you've got lots of legislation coming down. The legislation at the moment is about disclosure. Say the burglar's already left the house and you have to disclose it to somebody. I suspect in 2022, you're going to see that move somehow, that the regulation or the disclosure might have to be during the incident. So that in effect, you're calling the police while the burglar's in the building, as opposed to once he's left the building. And I suspect that will put a lot more emphasis on cybersecurity for a lot of companies, because reputation damage of a cyber incident is incredibly hard to recover from.
All right, we will have to leave it there, Tony Anscombe. Lots of social media scams as well that people need to be on the lookout for. Happy New Year to you. Thank you for joining us today. We're going to take a quick break and we'll be right back. Stay with us.
Welcome back. Time now for part 2 of our conversation regarding the cancellations in the airline industry. We want to welcome back into the stream now. I think we've solved our tech problems here. Jonathan Root Moody's Senior Vice President. Jonathan, welcome back here. And I think where we were leaving off before, we were talking about JetBlue. They were cutting roughly 1,280 flights through mid-January, but they're letting their customers change and cancel their tickets for free. What are these airline cancellations, and what kinds of effects are these having on customers right now?
So, customers that can't get to their destination, obviously it's, very impactful. However, I think time has shown that, the customer's not going to leave the airline. They're going to remain a customer. We are very tied to hubs, as an example. If you live near a hub, that's your main airline, and you have a bad experience today, I'm pretty sure you're going to try the airlines, that airline the next time. Jared, the other question that Karina had asked about which airlines are more or less exposed, presently, and I was going to say that geography and network are the two factors that can influence the extent of exposure at this stage. Looking at geography, it's really about weather. And, weather is a problem, has been a problem forever for the airlines. And that is the greatest impediment to steady operations at any given time. And then network, if you look at the big three as an example, with the, cross-ocean routes, given what's happening right now with Omicron and how governments react to that, that is, placing, additional pressure relative to a purely domestic carrier. But I think importantly, Omicron, does not discriminate, and, every carrier is exposed because of, the variant and the virus at this stage.
Jonathan, despite Omicron, there is such pent-up demand. We've seen millions of passengers. That's why we're sort of in this snafu. So many people want to travel. I just want to ask you, when do you think business travel will revive? And then what are you thinking about as far as revenue that we see next year?
Sure. So, business travel, when offices open, we do believe and expect that, business travel will return. Through the middle of 2021, domestic business travel was beginning to recover. I think an important statistic, which maybe is overlooked, is that small and medium businesses account for more than 50% of business travel. The focus typically is on the large corporates, but those companies, those folks have been traveling, and they started to last summer, and that's going to pick up. What's key, though, is when offices of large companies open, we do expect that business travelers will get back, on the road and to the air, importantly in the air. And that will be helpful. With respect to, trajectory and recovery, when the pandemic started, we had put out there that we thought by the end of 23, there would be a fulsome or substantial recovery relative to 2019. I think it's also important to just remind everyone, it is still very difficult, very challenging to accurately forecast what will happen, 2 weeks out, 2 months out, or for the year. But we did roll up a projection for the rated airlines when we published our outlook for the industry back on December 6th. Mm-hmm. We decided to stay with our positive outlook. And that's based on our belief that when the ability to travel is there, people are going to travel. And leisure, we've seen it in the US. If you look at Canada as an example, in the month of December, Canadian travel has returned to about 60%, 65% of 2019 level. Most of that's likely domestic. And we just think that for long-haul international travel and corporate travel, when the ability to travel is there with minimal restrictions, that the passengers are going to come, they're going to book, and they're going to get on the aircraft and go to where they need to go.
And we have to leave it there, but appreciate you stopping by here. Jonathan Root, Moody's Senior Vice President. Well, coming up next, well, actually right here in this edition of Yahoo Finance Presents, we sit down with Etsy CEO Josh Silverman and break down the state of small businesses. Let's take a listen.
Yeah, I mean, not just us, but our sellers, right? So you're right. We work all year to make sure that our sellers are fully prepared, that the Etsy website is delivering what people expect. And I think we're at a moment where circumstance is meeting preparedness. So we gave our outlook at the end of the third quarter just a few weeks ago, and it was robust. It was really strong for the fourth quarter. In fact, we said that, comparing this fourth quarter to 2019, so pre-pandemic, at the midpoint of guidance, we'd grow 143% year over year. So we're obviously incredibly pleased by that. We think this is a moment when our sellers, when small businesses really have a chance to step up and to shine and to show what they can do.
What are they doing? What are some of the top trends you're seeing on the platform?
Yeah, so we are seeing a big return to entertaining. Maybe not a big surprise, but people are really excited to be in person again this season. So you're seeing things like tablescapes really selling really well. So that's things like place settings. We're seeing barware and things like that. You're going to be together with your family. Let's have a drink. That's doing really well. The big colors this year, bold and bright colors are in. People are really wanting to celebrate, and they're wanting to go bold.
I could certainly use a couple gin and tonics there, Josh. It's been a heck of a year. When you talk to your sellers, I imagine they're facing a couple challenges. There's the inflation challenge, and if you're a small business owner, I imagine you're having a tough time hiring workers. What are you hearing from them?
Yeah, I mean, there's no doubt that there's a lot of challenges, and I certainly think it's important to acknowledge those across the whole economy. There's healthcare challenges, there's social justice challenges, there's economic challenges. There's a lot going on in the world. A lot of people laid people off during the pandemic, and they're having a hard time attracting workers back again. 2/3 of Etsy sellers said that their sales stayed the same or grew through the pandemic. So actually our sellers on average, and of course every seller is a little different, but on average, our sellers have actually been growing and hiring and thriving, because this is a moment when I think they've had a chance to shine, when so many trends over the past decade have been in favor of the mega corporations. And I think it's a welcome change to see small businesses have some tailwinds where they get a chance to really step up and show what they can do. And they have, and buyers have liked what they've seen from Etsy sellers. And so they're coming back again and again and again. And we're incredibly excited by that. In terms of what challenges we're hearing from Etsy sellers, we've been encouraging them to stock up early. So they started supplying themselves in August and September. So actually our survey data says they are less concerned about supply chain challenges this year than they were last year. And in terms of inflation, we've been checking that. We've been doing basket of goods analyses, and we've seen very little price inflation so far this year. We'll see how that plays out, obviously, as their input prices rise, but so far we're not seeing it on our marketplace in a significant way.
Are small business owners, just staying on that, are small business owners eating these costs these higher costs that they're seeing?
Yeah, it's a good question. So it's reasonable to expect that we will see their input prices go up. And so they're going to have a choice, one of two things. They're either going to pass those prices along to consumer and raise their prices and sustain their margins. And I think some of them are going to choose to do that. And that's a very sensible thing for them to do. Others might choose to eat some of the cost themselves, have lower margins, but maybe be more competitively priced relative to the market, and therefore see more volume. So I think both of those strategies are going to make sense. I think we'll probably see both play out on the Etsy marketplace.
You've been listening to an interview with the Etsy CEO, Josh Silverman. We want to get a quick check of the markets here. We have kind of an uneventful day, but that's just fine. Dow's up 15 basis points. S&P 500 just barely positive there. The NASDAQ is the laggard of the day, down 26 basis points. Also not shown, the Russell 2000 is up about 13 basis points. Leading sector is real estate, and the biggest laggards are communication services and tech. Coming up after this, we have another hour of trading with yours truly and Karina Mitchell.
Eyeing the finish line, pretty smooth sailing on Wall Street today. No big moves in thin volume as investors look to close out a stellar year. The S&P set to finish up about 27%. But is there still room to run? We'll check in with our markets analyst. Tax tip, before you know it, Uncle Sam will come a-knocking. And if you jumped on the crypto bandwagon this year, you'll need to know how your filing may look different. Our guest CPA tells you what you need to keep in mind. Plus, a change in policy at DoorDash is making some employees very unhappy. We'll break down why they're feeling frustrated. Welcome back to Yahoo Finance. I'm Karina Mitchell, along with my co-anchor Jared Blickery. Alexis Christoforous is off. It is the final trading day of the week, the month, and the year. And investors don't have a lot to be frustrated about today. The major averages all delivering stellar returns year to date. Want to check the benchmarks right now. However, the Dow is up 62 points. S&P has been fluctuating between gains and losses. No big moves here, up 2 points, and the NASDAQ is lower by 41 points. Sector-wise, real estate is one of the leading sectors, and then communications and tech are laggards. And Jared, I know that you have been watching the markets and have a little bit of a review, starting with the NASDAQ 100 winners and losers. You say Lucid and Moderna are some of the winners, and Peloton and Pinduoduo laggards.
Yes, and there are huge disparities between some of the winners and losers. Fortunately, most are winners. And let's take a look at the Wi-Fi Interactive. First thing we'll notice, this is a year-to-date view of the NASDAQ 100, is the mega caps really outperforming. You have Tesla, Alphabet, Microsoft, NVIDIA, each up more than 50%, and some of those much more than that. Alphabet up 66%, NVIDIA up 126%. Apple kind of in the lower end of the pack, but as the biggest technology, as the biggest public company on earth, approaching $3 trillion in value. It's truly astounding, the revenue growth of this company, that it's been able to sustain up 33, 34% for 1 year for companies of these sizes. Simply incredible. Standout, Amazon only up about 3%, mostly a sideways year for the retailer. And then Facebook, still putting in gains of 25% or so, not bad. Now, if we sort by performance on an equal weighted basis, as you said, Karina, Lucid, the number one stock here, 287% year to date. But you'll notice didn't even reach the highs recently here, and been able to hold on to a lot of these gains. But I think one of the themes is a lot of these stocks simply peaked earlier in the year, and they're kind of coasting on those gains ever since. Now, to the downside, Peloton, the big example here, that is from the upper left to the lower right, the opposite of what you want to see if you're a bull, down 76%, really kind of a disaster year for them. And then followed by Pinduoduo, that is a Chinese story. That chart looks very similar. They're down 67%. Finally, Zoom, down 45%, having a rough go of it. You take a look at what they've done over 2 years, and maintaining some gains though, but well off some of those highs, Karina.
And then also taking a look at the S&P 500, Devon Energy, one of the big winners there, along with Moderna and Penn and Las Vegas Sands are the laggards.
Exactly. And kind of interesting that the energy sector is taking a number of the top spots here. So you'll notice Devon Energy, that's up 178% in the upper left. Marathon, that is up 150% roughly. And then Diamondback Energy, that is up 122%. And let's take a 1 year view. Energy is the best performing sector of the year in the S&P 500, by the way, and it's actually having its best year ever. I think it's up 43% right there. And to the downside, these gambling stocks really got knocked down. Penn, that's down 40%, Penn National Gaming, and then also Las Vegas Sands, that's down 37%. But kind of a disparity between the winners and losers. This kind of flips it on its head when you take a month-to-date view, because on a monthly basis in December, a lot of the stocks that are up the most in the S&P 500 among this group right here are those that got beat down the most. So we take a look at Lamb Weston Holdings. This is a stock that's been in a downtrend since mid-year, and pretty firmly still in that downtrend, on this time frame, but getting a nice pop in the month of December. But you can see still mired in the lower half of its range. Looks like I got keyed off something. There we go. Citrix Systems is another one that's down 21%. And it's actually the same picture for all of these stocks on the top line here, except for Fortinet. Fortinet is one of those stocks. It's up 143% on the year and has been able to add to those gains in December. But just kind of exemplifying the difficult month it has been, because a lot of the things that worked at other points in the year kind of got flipped on its head during this month.
And then, Jared, also you took a look at crypto and SPACs. Crypto is so volatile. Forget about day to day. I couldn't keep track minute to minute sometimes. What are your findings there?
Let's take a look at the Wi-Fi Interactive again. We can see Bitcoin holding on to some healthy gains of 59%, but it's really the other the other members of this group that stand out. So in the number one place, we have Polygon. That is up 14,000% over the trailing year. Solana, we talk a lot about that on this show. We've interviewed the founder, and we can see that's up over 11,000% this year. Dogecoin, even that's up about 2,900%, and you can see still well off its highs, but maintaining one of the top spots on this list. To the downside, not too many losers here. We have Polkadot, that's down 4%, and then Bitcoin's V, that's down 25% over the year. But for the most part, a lot of these names are familiar. A few are not. Hex is a new one that's up 1,800%, at least in terms of being on my radar this year. And here's another one that's somewhat new to me, Crypto.com, up 860% this year. And by the way, when they announced they were buying the Staples Center, that was pretty much the top in Bitcoin. So interesting to see that correlation right there.
You know, it was interesting to see the return on Ethereum as well. If you invested $1,000 at the beginning of the year, you would now have about $5,500. So, you know, some big gains if you have the stomach for it. We're going to stay on the markets and bring in our next guest, Ed Potowski, Chapwood Investment Managing Partner. Ed, thanks so much for being here today. I want to move the ball forward a little bit. You know, we've had such strong growth in equities as well. The S&P has had such a stellar year. It's going to be up 27% year to date and 3 years of double-digit growth. What do you see happening in the equity space next year? Is it a different story?
Yeah, it's definitely going to be a different story. I mean, 2022, I think you're going to see a high probability that we could be down 20%. And going into the third quarter, we could be down 10% plus. So I just see a very different year. You don't see a lot of positive things on the horizon as to why this market's going to go higher. And if you don't see those and you see a really overvalued market, right now the market is 31% overvalued, and 44% of our earnings growth comes from outside the United States. So even if the United States is clicking on all cylinders, which it isn't, but even if it was, you have to look at the rest of the world, and the rest of the world is really slow, and that's going to impact the earnings for the S&P 500 companies. And I just don't see another positive year. I just don't. I'm sorry about that.
Well, you don't have to apologize to us here. We're looking for some answers, and I'm really glad you're here because most of the analysts we have here kind of have the consensus opinion that there's going to be growth into next year. It's going to moderate. The Fed is going to hike once or twice, maybe 3 times. Everything's going to be okay. But if in fact you're not expecting the indices or if you're expecting the indices to roll over, are you in fact expecting growth to roll over? And what's happening with the Fed in this situation?
Yes, I definitely believe that we're going to see the 10-year Treasury rise because inflationary pressures are so great that we have to see the Treasury or the Fed come in and reduce the amount of liquidity into the market. That's going to push interest rates higher. And when the 10-year Treasury goes towards 2%, which I believe will happen, that's going to put pressure on the valuation of stocks. It's going to make the acceptable PE ratio even lower on stocks, which is going to increase the amount of selling into the market. So I just believe that we're going to see the Fed increase or tighten interest rates, and we're going to start to see a real sell-off in the market. And I believe it's going to start, in the first quarter to the second quarter, and then we could actually see a recession in the third quarter.
I just want to turn your attention to, the dollar. Do you think that we see the peak soon because it's been so resilient all year?
Yeah, I'm not really sure about the dollar. I mean, it's really difficult to figure out who's going to race to the bottom quicker. And, the United States would love to have a low dollar because it would make our exports look more attractive to others. But then there's the other side to it, that it makes it more difficult for us to buy goods from outside the U.S. So I'm not really sure what's going to happen to the dollar.
Well, I'm reading through your notes here, and this you have some comments on Tesla. This is always going to catch my eye. Might become one of the greatest shorts of all time. There have been people who said that before, and there's some graveyards filled with those short sellers. What makes this time different?
Well, I think that a lot of the growth has happened in Tesla. And again, I'll get a lot of negative emails on this from the Tesla lovers, but there's a tremendous amount of hype still in Tesla. And even though you have, sales and earnings coming in, the PEs are so great that it's going to be really difficult for them to make enough to justify the lofty PE. And as you get Rivian into the picture, and Lucid and NIO and others, and then you start to have GM and Ford and others come in, you're going to start to see a lot more competition. And people are going to start to realize that Tesla might not be the greatest electric company, in the world down the road, especially when they start looking at the pricing that GM and Ford are going to come out with. And you're going to start to probably see a lot of the luster come off of the Tesla trade. And I believe that that's going to then catapult itself and start to see a negative downward move on Tesla.
And Ed, we saw energy and real estate really soar this year. We thought it would be the reopening trade. We thought we would see airlines do really well, but tech again coming out on top. Is this the same story next year?
I believe you're going to see tech of all the categories. Tech and energy are going to do really well, and that's partially because the COVID pandemic is going to disappear, and you're going to start to see Las Vegas Sands, which you talked about a little while ago, not doing very well. I think Las Vegas Sands and Carnival Cruise and some of these airline stocks are going to do very, very well next year relative to the rest of the market. So I think that that's going to be the real trade. Real estate is still very, very pricey at this point. So I don't know how much more is left in real estate because it's really gotten ahead of itself. But definitely tech in certain categories is going to do well. And I wouldn't be surprised to see Zoom start to pick up quite a bit as well.
Yes, definitely, especially if we're going to be staying at home a little bit more if this Omicron thing doesn't go away soon. We'll have to leave it there. Ed Batowski, Chapwood Investments Managing Partner, thank you so much for your time and wishing you a very happy new year. We're going to take a quick break, but on the other side of it, as COVID cases hit new highs, so are the number of people that are getting tested. And we speak to one mobile provider to see how they're coping with surging demand.
As Omicron infections surge, demand for testing is through the roof. DocGo is a leader in mobile testing, and they say they have tripled their COVID testing in the last week. And we have the CEO and co-founder of DocGo on right now, Stan Vashovsky. And Stan, thank you for joining us here today. Just from your boots on the ground perspective, what has it been like over the last few weeks with respect to Omicron?
Hi, Jared. It's been quite challenging. We have a lot of people in the field, about 3,700 people representing 11 different states. Our staff are getting infected, they're getting sick. The work environments are challenging, but nevertheless, we show up every single day. We're here to serve our communities and places that contract us. And we're privileged to help out at time of need, and we'll continue to come to work every single day and test as many people as we possibly can.
Stan, do you think that we are testing enough? However, I know, obviously your staff are working so hard and probably around the clock to get things done. But in this country, are we testing enough? Because we sort of lag behind other countries, particularly when it comes to free test kits being made available.
Karina, I'm seeing every municipality do the absolute best they can. The testing volume has skyrocketed over the last few weeks. Everyone is taking this extremely serious. Everyone's trying to put out as many resources as possible. We're asking labs to work 24/7. The rapid kits are coming in on a continuous basis. I'm not seeing anyone cutting back due to budget pressures or anything of such sort. Everyone is trying to get as much resources out there as possible to test as many people out there as possible. We're doing our best. Our competitors are doing our best. The municipalities that we work for are absolutely doing their best. But the volumes are staggering. I mean, they're absolutely tremendous. People want to get tested. We understand why. Omicron is extremely contagious, and we're trying to keep up with the demand to the best of our ability.
And I want to ask you really quickly. I just want to ask you really quickly, how long is it taking you to process these tests? How quickly are people getting their results back? And then how many of the tests are actually sequenced to figure out whether it is Omicron or Delta that people may be afflicted with?
Well, if it pertains to a rapid test results are coming back very quickly, anywhere from 20 to 30 minutes. Our customers get a text message with a link. They click on the link, they authenticate, and they get their results very quickly. If it's a PCR lab-based test, that takes a little longer. We're fortunate enough to work with labs throughout the country. We're able to balance load the results quite well. Results can come in anywhere from 24 hours to 3 to 4 days. It really all depends on the lab that we're using. Everyone is trying, just their absolute best to keep up with the volume and get those test results to people as quickly as possible. So if they are positive, they can take the necessary precautions.
And given that all this incredible demand that we've been talking about, what is your company doing to address that growth? Has it altered your growth trajectory, and what are those plans in general?
Yeah, I mean, demand is much higher than what we've expected. Prior to Omicron, we've seen COVID cases on a decline, and then all of a sudden they spike. So as a company, we have received a boost from all this testing. It's not just testing; it's vaccination demands that have also gone through the roof. So we are staffing up. We're launching in more states. We're now licensed in 48 states to perform the work that we do. And we currently have 36, almost 3,700 employees. We're hiring, training, and putting out new employees in the field every single day. So we're trying to keep up with the demand. It's definitely been a tailwind for the company, and our goal is to keep doing our absolute best to meet demand.
It's been such a tight labor market, and you say you are staffing up. How easy has it been to recruit staff and retain them?
We work with recruiting agencies throughout the entire country. We have over 30 recruiters in-house at the company itself. We're very active on social media. We have a lot of differentiating components to our compensation package that I think make it very attractive for people to come work for DocGo. So when you put all that together, we do quite well. We're able to recruit a fair amount of medical professionals on a weekly basis. We try to onboard them as quickly as we possibly can. And once they're ready, we put them in the field to do as many tests as they can possibly do.
And we got time for one more here. In the middle of the year, you announced a partnership with NYC Health and hospitals, and this was an outreach program to help people who are underserved in the medical community, specifically homeless people and homeless people without shelter. Can you address some of the goings-on in this program since it's been launched?
Sure. I mean, one of the best municipalities we work with is New York City. I've never seen any municipality that try to do more for its population than here in New York. And one of the programs that we do is testing and provide various other types of medical services for the homeless population. We work in various different manners, either on mobile units, inside shelters, you name it, we'll go out and get them tested, get people tested. So we work with the homeless population in the shelters. We're privileged to work with that agency. Where we, on a daily basis, test different residents in the shelters, and then at the same time, if they test positive, there are now homeless shelters that are dedicated to COVID positive patients. We provide various medical services in those shelters as well. So New York City is doing everything they possibly can to help fight this pandemic, help fight Omicron. Get in front of it, and we're very privileged to work with such a fine agency.
We have to leave it there, but I really appreciate you stopping by. Stan Waszowski, DocGo, CEO and co-founder. Coming up next, we have a conversation with former GE CEO Jeff Immelt.
Welcome back to Yahoo Finance. Well, it is the final day of 2021, and we're taking a look back at Yahoo Finance's own market summit. And in this interview, we sit down with former GE CEO Jeff Immelt for a discussion on COVID and leadership. Take a look.
I think I wrote the book really for two reasons. One is that the GE story is a complicated story. And I think when you have a complicated story, you have to tell it fully and completely. And I didn't feel like that was happening in the context of GE. We won in our markets. We experienced globalization and digitalization, but the market cap didn't grow, and all of us carry that as a burden as we go forward. But I want to tell the story, a complicated story, more completely. I also think in this generation, all leadership is crisis leadership. And from 9/11 through the financial crisis and COVID and Fukushima, my team and I experienced lots of volatility, and I thought some of the storytelling and some of the lessons would be valuable to other leaders. So those are really the two reasons why I wrote the book.
So let's bring it to present day then, Jeff, and talk about the crisis that has unfolded over the last 18 months. The pandemic crisis, of course, that has challenged so many companies. And I wonder, given your experience, have you looked across the landscape and seen particular leaders that you think have navigated this period of time especially well? And what do you think have been the hallmarks of strong leadership during this time?
Yeah, look, I think, Julie, good leaders have to absorb, and they have to absorb fear. And the important thing, when I look at some of the old colleagues that I knew in the airline industry or oil and gas industry, they took a punch right in the nose. But the best leaders kind of kept focus on the future. They communicated with their team and have been able to navigate from one side to the other fairly well. I also think that in a crisis, you have to hold two truths. You have to know that things can always get worse. And at the same time, you have to have a vision that there is going to be a future that you need to invest in. And I would say to a certain extent, as we face COVID, people might have pulled back too much in the context of capacity and investment. And as a result, some industries weren't ready for the economy as it turned back on. So I think those are the two things, absorbing fear and holding two truths, that I have to think that leaders have to navigate over this crisis. In terms of, look, again, it's an out of favor sector, but some of my old business colleagues are in the oil and gas sector. Oil was negative $30 a barrel a year ago. And now, it's at highs again. And having gone through that kind of volatility, I think some of them have done a really good job.
Yeah, we've got new highs, I think, just today for a lot of those oil prices. Also, we have seen sort of the role of leaders change, the role of CEOs change. That was sort of starting to happen during your tenure at GE, but I think it's happened even more over the past year and a half, with a lot of CEOs taking new measures to take care of their employees, for example. And also, as we have seen COVID sort of become politicized, we've seen more CEOs sort of step out in front of that. What do you make of that change? What do you think the role of the CEO is in this day and age?
Yeah, look, when I first became CEO, let's say in 2001, CEOs were private citizens and not much was asked or demanded of them. By the time I retired in 2017, it was a more public job. And I think in many ways between 2017 and 2021, it's become an even more challenged job. You have to, for the first time in a generation, the leaders have to navigate inflation. There's tremendous volatility in the global markets. They're expected to take a stand on social issues. There's an incredible need for improvement in diversity and equity. There's big problems to be solved in climate. Globalization used to be a good thing. Now, if you use the phrase globalization, you're considered to be an enemy of your country. So these are all the complexities that CEOs have to understand and have to navigate. Look, at the end of the day, nothing matters if you don't run your company and run it well. But at the same time, you have to have a sixth sense for what's going on around you and pick your spots in terms of when to engage. Policy now equals politics. It used to be that you could advocate for a policy. You can't do that today without really taking on a political stand. So I think it's important for CEOs to pick their spots when you think about all the things that are going on today.
So do you think, on balance, that it is a positive change that the job has seemingly become more complex than ever? And what then, not just what do CEOs need to do, but what kind of people need to be chosen as CEOs?
So I think I'm not judgmental about what's positive and what's negative. I think caring about what's going on in the world is always a good thing. I think being associated with solving problems is something companies can do, and that's a good thing. If you think about things like climate change, sure, there's a big public policy aspect that's essential, but at the same time, it's not going to be solved. It's not going to be resolved unless the private sector gets dramatically involved and is a positive force for change. So I think those are things that are important for companies. I think truth equals facts plus context. It used to be you didn't have to worry about context. You didn't have to worry about how you or your company fit with the world. Now, if you don't really understand the world, you can't lead, right? You can't, if you don't understand, kind of the overall fit and what's going on around you, you can't lead. So I think that's a real change in terms of the types of people that can do the job. And, is it good or bad? I think that depends on whether or not we actually solve the problems. If we get ahead in the environment, if we make healthcare more affordable, if we can recruit good teams, then it's tremendously positive. But if we still have the same problems 5 or 10 years from now, then different models will continue to evolve.
Welcome back. Time now for a check of the energy market, and what a year it's been. XLE, the S&P 500 energy sector ETF, having its best year ever. But I want to start with the crude oil market because WTI crude futures for February settlement just closed at $75.21 per barrel. And this is our commodities heat map. And a lot of the names at the bottom are energy names. And we're going to see how that has changed, an opposite look, once we take a year-to-date look. And here you see WTI crude oil futures up 57, almost 58%. Now, recently, I'm going to put a 2-month candlestick chart up for us here. We just got off a 7-day winning streak, so we snapped that. But we're having the best month in crude, and actually, I guess we just closed it since February. So crude oil has had an incredible run this year. And in fact, if we put a year-to-date look on our heat map, you look at that top row, most of these names at the top are energy. So what I'm circling here, RB equals F, that's RBOB gasoline futures. They're up over 60%. Heating oil, HO equals F, that's up almost the same amount, almost 60%. Crude oil, and that is WTI, that's up 58%. Brent up 55. Natural gas up 44. So really been an incredible year for energy. And I'd be remiss if we didn't check out our energy heat map itself. And these are energy companies, and doesn't seem to want to cooperate on the year-to-date look or a 1 year. So I will just close by saying again that the XLE energy sector, the best performing sector of the year and its best year ever. So we want to shift gears a little bit and talk about crypto and potential tax implications, because we got $2.1 trillion worth of crypto assets held right now. And for that, we want to bring in Dan Geltrude. He is a CPA at Geltrude and Company. And Dan, thank you for joining us here today. With all this crypto wealth that has exploded in this year, we know the IRS wants to take their share. So how is this going to play out?
The IRS certainly wants their share. They want their share of everything. So let's keep this in mind. When you think about cryptocurrency from a tax standpoint, you really have to look at it more like it's a stock, like it's an investment, as opposed to it's a currency. And the reason for that is because it is taxed like it's a stock. So let's break that down for a moment. Every time there's a transaction of crypto, it triggers a taxable event. Now, you may not owe tax. You may transact in cryptocurrency and actually produce a loss. But you still have to keep in mind that whatever you do related to crypto has a tax implication. Now, how do you figure this stuff out? Well, it's no different than when you have a stock. When you purchase a stock, it has a basis. And it's that basis that determines whether there's going to be tax or not. Meaning, if you sell it or transact in it above the basis, there's a gain. And if it's below the basis, then there's a loss. So that is basically the ground rules on taxing cryptocurrencies.
And then I want to ask you, sir, crypto tax gifts have been booming. They're up 580% year over year. How does that affect liability?
I'm sorry, crypto what?
Crypto tax gifts that people make before the end of the year. Yeah, they're soaring, they're booming, they're up 580%. So just wondering, how does that affect tax liability?
Sure. So what happens there is when someone gifts crypto, it is similar to gifting a stock. So whatever the giftor paid for the crypto, that basis, remember, the key is the basis, what you paid for it, that basis gets transferred to the person who is receiving the gift. Now, that person takes on the basis of whoever gave it to them. And now, anytime they're transacting in crypto, it could potentially create the same thing. A tax gain or a tax loss. Now, the reason why people will have a tendency to gift crypto is because they believe crypto has an enormous upside. And that's the whole point. So you're gifting it so that you're not going to have that tax gain taxable to you, and you pass it along to someone else who presumably is going to hold it for a while.
And is there anything investors in crypto should be thinking about at this time of the year, as opposed to April 14th or April 15th? Any kind of snags that could come about just because we have all these new reporting requirements? People aren't used to reporting their crypto holdings or their crypto profits or losses. What should people be keeping in mind as we head into the new year?
Well, the one thing that you have to make sure of is that you are tracking, again, that keyword basis. So my suggestion to everyone is to make sure that you have an app that will track all of these crypto transactions. Why? Because when you get to the point of having to file your tax return, you need to know what happened with your crypto. Because again, every crypto transaction produces a tax event. So if you do not track your basis in your crypto, you want to know what happens? You're going to end up paying a lot of money on April 15th because it becomes all taxable if you don't know the basis. So my message to everyone related to crypto is make sure you are tracking that basis unless you want to have a really big surprise for your cryptocurrency transactions come April.
I like that. Know your basis. And I'm sorry, go ahead, Karina.
Sorry, just only a couple of seconds left. I just wanted to ask you, how much more closely is the IRS focusing on crypto earnings at this point?
They're looking very closely at crypto these days. That's why on the first page of your tax return, right at the top, they ask the question, do you have cryptocurrency? Did you transact in cryptocurrency? It's a yes or no. So those tax returns get segregated right there. Who has crypto and who doesn't? For purpose, ultimately, of being audited down the line. A lot of people try to get away with not reporting crypto transactions. The IRS doesn't like that. So yes, there's a lot of skepticism and critical looking at cryptocurrency.
That's right. Never underreport and never don't report. Thank you for those wise words. And coming back here, Dan Geltrude, CPA at Geltrude and Company. Coming up after the break, we have part 2 of our interview with former General Electric CEO Jeff Immelt. After this.
Welcome back to Yahoo Finance. It is now time for the second part of our look back at the Yahoo Finance's All Market Summit with former GE CEO Jeff Immelt. Take a listen.
I've always believed that climate change was real. I've always believed that this is a pivot that has to take place. We built a big wind turbine business. We built a big grid business that was very positive, and we financed lots of projects in the clean tech space. I guess, Julie, we believed in natural gas, that natural gas would be a key pivot for the world as it pertains to how we get to a cleaner world, how we actually achieve the standards that we need to achieve. I believe that legacy industries had to be cleaned up in order for us to make progress. To a certain extent, I still personally believe in those things today, even though there's lots of people that will disagree with me. In other words, I believe in renewables, but I believe without nuclear power and natural gas and some of the other things in the mix, that this transition is not going to be as successful as we all want it to be. So I understand the question. I think we had a very strong belief that there would be a transition, and I still hold many of those beliefs today.
Gotcha. You also mentioned globalization, and I do want to ask about China as well, because you have extensive experience in terms of business interests in China. The Biden administration has continued to take somewhat of a hard line toward China. So how should business leaders be thinking about their relationships there, both with corporations that are based there as well as the Chinese regulators and authorities?
Yeah, look, to a certain extent, we always have to follow the lead of the government, and the relationship with China is more complicated and negative today than at any time, certainly in my business career. But it's going to be the biggest market or the second biggest market in almost everything that's important. If you want to solve some of the biggest problems like climate change, China has to be our partner. Can you imagine the two biggest economies in the world not having some kind of economic relationship? So look, I advise business leaders not to pull back right now. In fact, if anything, if I were back in the seat of running a big public company or a multinational company, I'd be investing more in China now, not less, just because, electric vehicles, clean tech, AI, I could go down the list. Many of the futures of the industries we care a lot about are going to be determined both in the US, but also in China. And the Chinese influence in Europe and Africa and Latin America is not going to go away. So my belief is for engagement. I think it's important. I know it's really hard right now and very controversial, but I wouldn't pull back. I'd keep focused on building the right kind of Chinese context inside your company.
And Jeff, speaking of the future of various industries, that was a passion of yours at GE, and now you're looking at that sort of more full-time, right? You're at a venture capital firm. And when we spoke in advance of this conversation, you said you could talk about how much of Silicon Valley is magical and how much is BS. And I can't really put it better than that. So, talk to us about your experience coming from a big traditional company. Yeah.
Yeah, Julie, I wanted to work with innovation and I wanted to work with entrepreneurs. I convinced my wife to move to California so that we could kind of see it up close. I love what I'm doing with respect to the venture firm I work with now. I'd say to all my colleagues from legacy businesses, there's an infinite amount of money. The talent is flocking, to the startup world, and the innovation is real, whether it's artificial intelligence, automation, I could go down the list. So to a certain extent, all of us need to be as paranoid as possible. I think what's yet to be determined, Julie, is what does the culture of the future really look like? So much of it still in Silicon Valley is economic. It's stock options. It's every company being worth a lot. But I think the staying power of legacy companies, the ability to do hard things like jet engines and things like that, is kind of what we bring. And I think the future is going to be some mashup of the talent and innovation and technology with cultures that can recruit and train and build teams over the long term and through cycles. One of the things that makes Microsoft such a great company today, one of the things that makes Satya, such a great leader, is their stock price was flat for 12 years, right? So from 2001 to, let's say, 2015, everybody who was at Microsoft had to be there because they loved the company. And I still believe there's some element of that that's critical for building competitiveness in the future that isn't always captured in Silicon Valley, isn't always captured with all the startup craze.
And that was former GE CEO Jeff Immelt speaking to us as part of our All Market Summit. We're going to take a quick break, but on the other side of it, some DoorDash workers are unhappy with a mandatory policy the company is re-implementing. Ahead, find out what's behind the winter of their discontent.
Welcome back. Starting in just a few days, all DoorDash employees, including workers at all levels, including the CEO, will be required to deliver at least one order each month. It's part of the company's We Dash program that was created back when the company was founded in 2013. And joining us for more on this on Yahoo Finances is Yahoo Finances' Danny Romero on how some DoorDash employees are receiving this. And Danny, I guess even the CEO is kind of competing with these employees for some of their business now.
Well, Jared, let's just say it's been a little bit of a mixed reaction from DoorDash delivery drivers as well as these corporate employees. And like you said, this is a mandatory initiative that requires all employees to deliver at least one order once a month. And for those that are unable to participate, they can work in a chat support for customers or with merchants instead. And the whole goal of this program is to allow employees to really get a firsthand experience of working with its customers, also understanding its operations. However, some corporate employees, including a well-paid engineer, have fired back and expressed their frustration on about this reinstated program through an online anonymous social media platform called Blind. One employee wrote, "I didn't sign up for this. There was nothing in the offer letter / job description about this." And his post created over 1,800 comments. And some of those comments included employees siding with the company's value to reinstate the program. Now, despite all the criticism, DoorDash will continue its plan to bring back this program. They sent us this statement that reads in part, "The sentiment of the employee on Blind is not a reflection of the employee base at large. This is a valued program we've had since the company's inception." And on the flip side, I spoke with some DoorDash delivery drivers who also had a lot of mixed reaction about this. Take a listen.
It is a good idea, and let them do it for free. Cut their salary back. Matter of fact, cut their salary back and have them go out there and do those orders for free, because that's exactly where we're at.
Meanwhile, other DoorDash delivery drivers say that delivering one order really doesn't give these employees that full experience. Take a listen.
So they might be lucky and get that one order and be okay. But what about the other orders that we have to struggle on a daily basis, where we have to wait nearly half an hour, 45 minutes at a restaurant? We call customer service for help. We don't get any extra for waiting. We try to get a hold of the customer who lives in an apartment but does not answer the door or doesn't answer the phone so we can get the code to get in. With one order, they're not going to feel the pain that we feel on a daily basis.
And you can hear it right there from that DoorDash delivery driver who really believes delivering that one order will not give these employees that full experience. Jared, Karina?
And Danny, so many businesses in the service sector are dealing with dire labor shortages. What are you hearing from workers about any leverage they now have to sort of seek better pay?
Yeah, Karina, you're absolutely right. You know, the service industry is really under a lot of pressure and facing these labor shortages. And the pandemic really didn't help, especially for these gig workers who've had to make deliveries in unsafe weather conditions. But many gig economies, especially delivery service ones, workers have little to no power to really negotiate on their pay. And some delivery drivers I spoke with also have fired back on how customers have really become accustomed to instant gratification because of technology, which has really hindered their work environment. Take a listen.
America is becoming real lazy. Like, I'm not understanding it, but I can't be a slave to the system. I can't afford it.
You know, this highlights some of the pressure that these workers are really under in. But I will say this, some California DoorDash delivery drivers have protested actually in front of DoorDash's CEO's home in San Francisco, demanding for higher pay as well as tip transparency. But according to DoorDash, base pay is calculated based on estimated time, distance, and desirability of an order. Jared, Karina?
Yeah, we thank you for that report. And we got to send it off to the next hour of trading, where we have Adam Shapiro standing by for this third straight day by his lonesome, but he has it handled. Coming up after this.
The last hour of the last trading session of the year, and while it appears to be one in which we will close, we'll be mixed perhaps. Don't want to say we're going to close down just yet with an hour to go. But 2021 will go down in the history books as a big year for most stocks, with indices in the positive. And in the case of the S&P 500, we're looking at a gain of around 27+%. We will break down the numbers, and then at the closing bell, Jared has the 2021 year-end breakdown for everybody when it's in the history books. A new year brings new policies and new government funding to rebuild the nation's energy infrastructure. The new year also brings Heliogen, a private player in the energy sector, to the public markets as it completes its SPAC merger today. The CEO will join us for the outlook in the energy sector in just a few minutes. And finally, Rick Newman has the last Bidenomics for 2021. And here's a hint. The economy is booming, but for a lot of people, it doesn't feel that way. He will help us sort out fact from fiction. I'm Adam Shapiro. Get ready to pop the champagne, but not just yet. Let's take a look at where the markets are lining up in the last hour of trading. And as you know, those last 20 minutes are the most crucial. But the Dow right now in positive territory on this last trading session of 2021, up about 58 points. The S&P 500 barely positive, up about 3 points. NASDAQ still negative, off about 33 points. Want to take one other look, too, at Apple. This was the year Apple could have hit a $3 trillion market cap. Right now, shares of Apple, they're falling. Doesn't look like 2021 will be the 3T mark for Apple, but there's still 2022 to go. One other thing I want to pay attention to, and it's going to help us bring in our next guest. When you look at the sector performance this year, clearly all the sectors are in the green, but when you look at real estate, it's the big winner. The real estate sector up over 44% this year. I share that with you because our next guest, David Grumhouse, president and CIO at Duff & Phelps Investment Management, says that inflation is their key concern, but one of the places to look for protection, REITs, real estate. So it's good to have you here. And is that going to hold true, do you think, in 2022?
Yeah, we feel pretty good about REITs coming into 2022. As you mentioned, obviously it's been a big winner in the sector this year, up 45%. And we really think that that's been driven in part by this inflation trade. But we don't think it's done yet. We think you're going to continue to see good performance from the REITs. Obviously, as we get the economic recovery, assuming we continue to move past COVID, we think the REITs are going to continue to perform. You're going to see a real uptick in cash flow and dividends in 2022. And we think that will continue to propel the sector even higher.
When you bring up the cash flow and the dividends that REITs are going to be paying investors, will the loss of government support for people who have got payments to help make their rent payments during the pandemic, will the loss of that funding and the fact that rents are going up, will that have any impact on that cash flow that is so positive right now?
We don't think so. I mean, obviously, when you're talking about the REITs, you're talking about a very broad sector here. These aren't your parents' REITs, which are, the sectors now, 14 different subsectors. And so some of the sectors will continue to have some impact from the effects of COVID, maybe things like urban office, parts of the retail sector. But we think many of the sectors, will continue to really thrive, whether you're looking at self-storage or cell towers or, industrial, those types of sectors will continue to do well. And I think when you think about REITs and you think about this inflation phase, one of the big benefits that REITs enjoy is the fact that these are built assets. So the inflation is not going to impact them as much. And anything, it makes the existing assets even more valuable because there's going to be less competition and less building that's out there. So we continue to feel pretty good about where the sector is and think it will continue to be a big winner in 2022.
Tell me too about GLI. Are we talking about gender lending initiatives and investing?
No, that's global listed infrastructure. So another area that we're pretty focused on. And when we talk about global listed infrastructure, you're really talking about 4 different sectors. You're talking about utilities, you're talking about midstream energy, you're talking about communications, and you're talking about transportation. And this is a sector that's generally underperformed this year, and a big part of that has been the utilities. In obviously a market that's gone pretty much straight up. Utilities have been more defensive and have been a play that maybe the market has not been as focused on. You have seen utilities have a really nice December. as the market got a little bit more scared about COVID. But we do think that this is an area that will continue to do well. We remain very high on midstream energy, and we think the setup, midstream energy's had a great year this year, but it's also pulled back some in the back half of the year, and has not. But we think the setup continues to be really good. We remain very constructive on energy prices, whether it's oil and natural gas, and we think that will continue to propel the sector. Other areas of global listed infrastructure, especially some of the stuff over in Europe and Asia, the airports and the toll roads and things of that nature, they really haven't seen that recovery trade that we've seen here in the US. And one of the themes that we like for next year is a catch up in Europe. Europe has not had the same benefit, it has not had the same recovery trade that the US has had. And I think that that's been a combination of, one, the Europeans did not get nearly the amount of direct support during the pandemic that the US did. So whereas we were getting checks and getting money, the Europeans did not get that. And so the consumer spending in their recovery has been much lower. We also think that the ECB will have a lot more flexibility on interest rates than the Fed does. We think the Fed is going to, and has clearly telegraphed that they're going to be in a period of tightening. And we think that that will ultimately benefit Europe, especially towards the back half of the year versus the US.
David, I'm going to let you pick one or the other in this final question for you. Are you more concerned about gridlock and what might emerge with the BBB in 2022 as we go forward? Or we have a guest coming on in this hour that just went public, Heliogen. And I know that you think that there's great secular growth in the renewable energy area. So which would you like to tackle for us? Because a lot of investors are wondering about the future.
We remain very bullish on renewable energy and clean energy. It's an area we've been focused on. We launched a strategy over a year ago in that sector, and we think it will do well. Clearly, 2021 has been a difficult year for renewable energy and for clean energy. I think that that's largely a function of the fact that it had such gains in 2020. It's had to settle in a little bit, but we think what people are missing on this is the long-term secular growth story that really exists here with clean energy. People jumped into it thinking that this is a 2-3 year transition. This is not a 2 or 3 year transition. This is a multi-decade transition, and we're going to continue to see lots of capital and lots of growth in this area. It's very much similar to what we saw. You might have just compared to what we saw in tech, 25 years ago. And so we really like the long-term secular growth story. Certainly getting the Build Back Better bill would be helpful for clean energy. But what I would say is, that component of the Build Back Better bill, if it doesn't get done through Congress, I think, or through the Build Back Better bill, I think what you'll see is it gets done in pieces through different areas, because I think there's pretty universal view that we've got to continue to do stuff to help with climate. And I think that will, we'll see that play out, and maybe it doesn't play out in the next 3 months, but we're pretty confident it'll play out during 22 and long beyond 22 as well.
David Grumhouse, President and CIO at Duff & Phelps Investment Management. Thank you for joining us on this New Year's Eve, and a happy, healthy New Year to you and all the team. When we come back, we're going to be talking about health, the nation's health, and the latest on COVID-19. Hey, just want to let the tech crew know the IFB is going out. I think you cued me. Just want to let you know, too, that there are records you do not want to break, and those would be COVID infection records. But there is news about new treatment recommendations regarding COVID. Angelique Amlani, what's the latest?
Unfortunately, Adam, new records, not the ones you want to break. As you mentioned, in the U.S., we have now set a world record for another day of daily cases, more than 580,000 cases in a single day, already passing that 500,000 mark and nearing that 1 million. Some experts saying we could quite possibly already be there, considering the volume of at-home tests and the delays in turnaround time. So really quite striking over there. And the U.S. really taking a large portion of the global cases, surpassing 2 million in a week now for the U.S. alone. Meanwhile, we know that hospitalizations continue to increase, while maybe not as severe or as much as in previous variants, in previous waves. We are seeing that increase, especially for children. They are either showing up with COVID, or COVID is being found while they're in the hospital. Meanwhile, some other news, good news on the vaccine front. Novavax has now finally filed all of their data to the FDA. They do have to wait an additional 30-day period before being able to file fully for that emergency use authorization. CEO Stanley Erck previously telling us that the package that was submitted to the FDA largely mimics what they have sent to Europe as well. We know that this vaccine, while not authorized in the Western world, does have, based on Serum Institute of India data, some emergency use authorizations around the globe. So a lot of things going on there as it stands right now. Still waiting and watching to see how this Omicron variant continues to affect the U.S. Back to you.
Angelique, stick around. We're going to bring into the discussion Dr. Calvin Sun, the Monsoon Diaries founder and CEO, also clinical assistant professor and attending physician in emergency medicine in New York City. It's good to have you here. They say that this might be peak COVID. And when I say they, different prognosticators on different networks. But is this peak COVID? And what, if it's not, what does peak COVID mean, and what would that look like?
What do you define a peak on top of a peak on top of a peak? It's the peakest of peaks. And think about what I had said on this program about a month ago. Don't panic. There should be concern. And I'm sticking to that. I mean, it's hugely concerning. But in the hospital, at least in New York City, the hospitalization rates have stayed the same, and it's been a month. It's kind of mirroring that of what we are encouragingly seeing from South Africa. And the only difference between now and last March, when we had hospitalizations through the roof and people were dying in the waiting rooms, even, is that we're mostly fully vaccinated.
Yeah, Dr. Sun, I want to follow up on that, because I know that to that point that I'm just made, there are people who are also starting to think of this as the start of COVID being endemic, just because it is less severe and more virulent. But some other experts believe that lurking in the background is still that threat of a vaccine, of a virus that really fully escapes vaccines. What are you thinking about that now?
I mean, I'm not one to make predictions. I'm not a gambling person, I'm a gambling man, but the idea is that it's encouraging that it's less severe. I mean, we don't know if it's because of the baseline of most of us being fully vaccinated in New York City, at least 80%, which is why hospitalizations are so low. Maybe it's because we're comparing to that. If it weren't for the vaccines, maybe it'd be way worse. I mean, South Africa, the population was younger, so they were more likely to get out of hospitalization or avoid that entirely if they got sick with COVID. We don't know is it because of that particular baseline. That only time can tell. But it is encouraging that if it becomes endemic, you're going to need boosters like we do for the flu, for typhoid, for tetanus, for polio. We wanted to avoid that. Now the concern is if it infects most likely an immunocompromised, unvaccinated person, that creates a new variant that makes a virus that can escape the vaccine antibodies or become actually deadly, like Delta. And so therefore, we want to vaccinate as many people as possible to lower the risk of a virus playing around with someone's DNA who's unvaccinated without any antibodies bothering that virus to create a new variant.
We hear you brought up boosters, and there are now stories about people who are sneaking to get their fourth shot of an mRNA vaccine. Is that something that could be counterproductive? Is there a risk getting too many injections of the same vaccine?
I mean, drink too much water and that becomes dangerous. Too much of anything is dangerous. Israel's doing a fourth booster right now, and there has been no reports of it being dangerous. We've had patients accidentally get more than one dose. You know, those vials, they contain 10 doses. Sometimes people get more than one. Some people, I think in New Zealand, somebody went around and got like all of them, tried to collect all the infinity stones of different vaccines, and they're all still alive. There's no safety really concern. It's just, why would you? Like, why would you do that unless you absolutely needed it? So I wouldn't get a fourth one if your third one was a week ago. But if enough time has passed where the antibodies have waned and you want to increase, a refresher, that dose you get on the fourth run is exactly the same dose you got on the first time and the second time and the third time. There's not a new formulation. So if you did fine the first time and the second time, you probably will do fine the third and fourth time. It's just the timing of it. Don't drink too much water all at once. Don't drink too much Coke all at once. It's about spreading that out, because the longer you wait in between doses, the better protection that you have. But the irony is, if you wait too long, then you get infected with COVID. So it's that personal decision based on your risk tolerance and exposure that only you can answer when to get your fourth one, if you have to get one.
Absolutely. Absolutely. To that point, there's some recent studies about the T-cell protection that's coming from these vaccines. But I want to pivot to the NIH new treatment guidelines out favoring Pfizer's at-home pill, as well as one of the monoclonal antibodies that remains somewhat effective against Omicron. So I just want to know, from your standpoint, this change in treatment helpful at all, especially with the burden on the hospitals? And do you think it will come in time in the middle of the wave?
I mean, it's the eternal battle between prevention and treatment. Like, why do we have to get to this point where we need to get to treat with monoclonal antibodies when you can, which can cost a lot of money, as opposed to a free vaccine that generates antibodies against the virus? So Paxlovid is very encouraging. From the data, there's a preference for it. I haven't seen it in prime time. There's so few of it has arrived in New York. I haven't really used it in the emergency room, let alone being able to order it or prescribe it yet. So I can't really comment on something that I haven't used yet or see if it works in prime time. But the data is encouraging. I just wish we didn't have to get to this point, to be more preventive than get to a point of like trying to put out a fire. I wish we didn't have had a fire in the first place, especially if the end-all be-all result is creating antibodies for this vaccine, whether it's monoclonal antibodies that cost a lot of money or free antibodies that you can get with the vaccine.
When you bring up those stones, I just want to remind you it was Thanos who said that fun isn't something one considers when balancing the universe. But this discussion does put a smile on my face. Dr. Sun, all the best to you and a happy new year to you and the team. When we come back, we're going to take a look back at Decrypt. All right, less than 40 minutes in the trading session on this last day of the year. We want to talk about crypto because a lot of investors have made a lot of money. As 2021 wraps up, we will take a look back now at the Yahoo Finance Decrypt special. In this interview, Yahoo Finance's Zach Guzman actually sat down with FTX CEO Sam Bankman-Fried to discuss the expanding world of crypto. And here's what they talked about.
So there's some user growth, but that's not the biggest immediate goal of it. We are really coming from behind on a name recognition perspective. We've been around for about 2.5 years. It's a lot less long than the other major players in the crypto exchange business. We don't have tens of millions of users. We certainly don't have 100 million users. And what this means is that when sort of someone is looking to get involved in the crypto ecosystem for the first time, especially 6 months ago, there's a good chance they hadn't even heard of FTX. And what that means is that if we just buy a lot of Google ads, I don't know, there's sort of like, crypto company you've never heard of runs an ad on Google or Facebook. It's not very compelling. You probably assume it's basically just a scam. And sort of more generally, the sort of brand that you need to engage with consumers, we didn't have. And so rather than, just try to mass acquire a ton of retail users with advertisements that probably wouldn't have worked, what we've really been focusing on is trying to communicate to the country and the world like who we are as a company. And, I think that means something that's punchier, something that's more compelling, and something that says more about us than, we can usually fit in an advertisement. That's really been the goal of a lot of the partnerships that we've been forming. And I think we've had really, really striking success with that. Witness the fact that you felt compelled to ask about it here, right? It's sort of like one example of just the reach that I think that those have had.
Yeah, and it's not just the ads. I mean, it's also the capabilities you've been adding. As I said, kind of recently, adding on NFT capabilities here as well. What's been kind of the early takeaway in what person that is drawing in crypto versus maybe the people who came along first in the Bitcoin and ETH wave back in 2017?
There are similarities, and in particular, there are similarities to the people who have been here for a while. NFTs have had an absolute explosion in usage over the last 6 months, but it is still predominantly driven in most places by the crypto industry rather than by newcomers. There is some excitement from newcomers, and there's a huge amount of excitement from partners to build out new products involving NFTs, which I think could be really, really exciting. But I don't think that it has yet caused millions of people who had never touched crypto before to engage, at least not with FTX. I think the biggest engagement that we've been getting at the beginning is from existing users of crypto, whether or not they're FTX users. I think that's going to change over time, but I think what that's going to take is NFTs starting to get integrated into other systems in people's lives, whether they're tickets, in-game items, or other things.
I guess the one similarity too between all this is the ability to make a lot of money, and that's really what draws people into crypto. I think if you're not in it, there is one project that you've been a pretty early backer of, Solana. I know you've been talking to them, and obviously they've got a lot going on in Lisbon this week. When you look at that, though, it's up almost 12,000% over the last year. And when we talk about projects like that in terms of efficiencies of scale and speed, a lot of people point to whether or not that might take away from potential upside in Ethereum. I mean, how do you look at maybe how that battle plays out over the long term? Obviously, in the short term, when everything else is in a bull market, everything's going up, that's one thing. But does it maybe cap the long-term upside from some of the other competitors to Solana and then also to Ethereum?
It's a good question. And, there's always going to be both collaborative and competitive forces between different crypto projects. We see this with us and a lot of other exchanges. And we always try and play the collaborative card when we can. I think what I would say is that what I see as the biggest upside of Solana is, the potential ability to scale to a point where it can service an absolutely enormous number of users and an amount of information transactions. If you think about what does a mass scale application business or something like that, look like? You're talking about hundreds of millions to billions of users. You're talking about millions of transactions per second. You're talking about billions to trillions of dollars. That millions of transactions per second, it really is a requirement of almost any mass scale system. So I think that Solana is one of the few currently existing public blockchains that has a really plausible roadmap to scale to millions of transactions per second at fractions of a penny per transaction, which is the scale that you need for this. I think that is not where a lot of other blockchains have been focusing, including Ethereum. I think what that means is that to the extent that the goal of a blockchain is to service 1 billion users, absolutely, I think that there are competitive instincts there. I think you could imagine collaborative instincts to the extent that other blockchains are focusing on a more concentrated, smaller type of usage.
The other interesting thing too, I guess, in the run-up, as you've pointed out, there's been a lot of institutional interest in the project. And I guess that's one thing that might change in terms of the speed at which institutional investors are going deeper and deeper into the crypto space. It took a long time for them to dip a toe into Bitcoin, maybe a little bit shorter to dip into ETH, but now as you see that interest from institutional investors shape up, how big of a driver is that, not just for Solana, but for some of these other projects as well, in what we could see in how quickly these projects do pop?
So mark to today, if you look at sort of all of history up to today, frankly, actual institutional adoption and inflows themselves have not driven very much. Now, the anticipation of them has, but the inflows themselves have not yet materialized. You talk to most major institutions, they will tell you they're getting into crypto, and they will tell you that it is not happening tomorrow. It's going to take, a year for many of these places, sometimes multiple years. The amount of work that a compliance department has to do to get acquainted with the cryptocurrency ecosystem, to become comfortable with it, is fairly significant in a lot of these players. So it has not been driven by the actual inflows themselves, although the anticipation of those has been a huge factor. All of that being said, the world is speeding up. It's speeding up in every way, and it's going to be speeding up in these ways as well. And so I think the sort of timeframes that we imagine transformations happening on, both in terms of what technology can accomplish, the adoption it can get, and the institutional support it can get, I think every year those timeframes shorten a little bit, and we see things turning over faster and faster and getting adopted faster and faster.
All right, 27 minutes to the end of the closing day of the trading session, to the closing bell. When you take a look at oil, we saw WTI hit over $76 a barrel. Right now, it closed, I think, today around $75 a barrel. One day does not a trend make. But let's talk about what 2022 looks like, especially when we're talking about the energy market. We're going to do that with a friend of the program, Bob Iacchino, Path Trading Partners co-founder and chief market strategist. Also, the stock think tank portfolio manager. I get tongue-tied with all of these, accomplishments of yours. Help us. That is a really cool tat, by the way. I don't think I've ever seen your tattoo before.
This one? Yeah, it's this one. I can't see what I'm looking at here. It's pretty much the whole. So.
That looks like it was painful, but we have to talk energy and oil, or my producers will hit me over the head virtually. Where are we headed in 2022? I keep hearing about, crude oil at $100 a barrel. Is that realistic?
I think it may be. Here's the thing, Adam. When you're talking about crude oil, you're talking about the market that was the most volatile market prior to the advent of cryptocurrencies, as you guys have been covering through a lot of today. So crude oil's volatility is a given, and I think people sometimes forget it, staring at the volatility that we get in crypto assets. Crude oil itself, when you talk about where it's going in 2022, it may not be the same place as where it's finishing in 2022. I think $95 is a realistic target. That's the target that I have for sometime in the second quarter of 2022. And it's much about the sort of drop off of concern for COVID by the general populace. I know it seems like it's crushing us right now, but you're not seeing that data come out in the demand numbers. Also, the fact that crude oil's seasonality, which you need to pay attention to if you're trading commodities in general, and crude oil and natural gas as well, specifically, the seasonal trends are important in commodities, and crude oil's weakness from the winter has ended already. The seasonality of crude oil, the weakness that we get in the winter months, tends to end right around the first or second week of December as people drive out to visit family for the holidays and the demand sort of spikes. Then it goes a little bit sideways to about the second week of February, and then you get a seasonal tailwind as people move into the summer months. So there's a lot going forward. On top of that, if I'm rambling on, let me know. On top of that, you have the depression in the U.S. oil producing market, whether that be from fiscal responsibility, administrative policy. I believe it's quite a bit of both. You're not going to get the U.S. marginal producing to add into the supply, so we have to rely on OPEC, and that's unreliable.
So let me interrupt, because I want to break down. One of the techniques I use to make sure I hear something is to repeat what I think you just said. When I get it wrong, as I often do, correct me. Demand is not the player, perhaps, that we think in the price of oil, and yet we should be looking in what kind of time frame from demand, because as we approach the spring, then we're going to have the transition into the summer blends, and of course we're going to have demand going up as people might be driving. So that's one thing I want to make sure that is that what you're saying. But the other thing, what happens is the dollar perhaps begins to strengthen in value with interest rates going up next year. Does that have a pressure effect on the price of crude and push it down?
So the dollar's inverse relationship to crude oil and quite frankly, most commodities, since they're priced in dollars, a stronger dollar tends to lower the price of commodities globally. You do see times, this year specifically was one of them, the dollar was up anywhere from 7 to 8%, depending on which currency you're comparing it to, yet crude oil was up as well, copper was up as well. So the dollar's inverse relationship to commodities is something that we consider all else equal. It's the determining factor on a day-to-day basis. All else is not equal. Demand was a little bit higher than people expected as people began to travel again, as economies globally reopened. Now some of them are shutting down again, but they're shutting down sort of in line with that seasonal weakness we see anyway. When they reopen again, I think you'll see a surge in demand. So to a certain degree, that is what I'm saying, but I think the demand, wherever people think that sort of median demand is likely to be higher.
What happened to the shale revolution in the United States? I mean, we were talking for many years, boasting about our country's ability to extract oil from shale and then export that product. What is going on there? Is the price not sufficient to encourage people to begin doing that again?
Shale can make money, and this is a very general statement, at about $55 a barrel. We're currently at about 77 last time I checked, 75, somewhere in that range. So they should be producing. There's two factors, in my opinion, as to what happened with shale. Number one is the change in administrations from what we'll call a drill baby drill to a conversion to a more green energy has caused the industry to sort of pull back a little bit, to be less aggressive. The second, I think the more important thing, is that they got killed when crude oil prices fell. I mean, they really got hurt. And trying to get investment, trying to get capital to produce new wells and develop new sites has been extremely hard, number one, and it's been less desirable, number two. A lot of these companies that are still involved in places like the Permian that is still profitable are not spending like drunken sailors as they did perhaps in 2013, 2014, 2015.
Hey, Bob, last question for you. What's going on with nat gas? Coming into the winter, we were getting the predictions of, spiraling prices, spiking to new highs because of a colder than expected winter. There are some silver linings perhaps to climate change. It's been pretty warm in New York. Are we seeing those predictions come true, or are we going to get a pass on this?
Well, it's really been warm globally. Again, natural gas is the most driven by the seasonal factors of really all the commodities. So it's been unseasonably warm globally also, even though we're seeing an easing of the sort of small time energy crisis we had in the EU and the UK. That's likely to rear its head again, but the Nord Stream pipeline is filled with gas and ready to be shipped. So that weakness is kind of playing out. Also, we're getting to the end of the tailwind for that as well, although we're about to see some of the coldest weeks in Chicago. That's likely to head your way after that. So we're going to see a short-term spike in natural gas, but it's probably the last sort of gasp. The supplies are still anywhere from 5 to 7% above the 5-year average. We are still in surplus for natural gas.
Can I just tell you, there is nothing worse than standing on Michigan Avenue in January or February, those coldest days in Chicago, when the wind is coming off Lake Michigan. It is just bitter cold. You've been there.
There is nothing worse. I couldn't agree more.
I have experienced it. All right. You have a happy and healthy new year. Thank you for joining us, Bob Iacchino, Path Trading Partner, co-founder and chief market strategist. When we come back, we're going to keep talking about energy, but green energy, and a company that is trading publicly now, Heliogen. The founder and CEO is going to join us to talk about the future and how you can get in on it. I'm going to say the newest player. They are not new. They've been around for a couple of years now. But the newest player in the public markets when it comes to clean energy production and future growth, Heliogen, started trading publicly today. And we're going to talk about them in the context of their stock being up 44% that became public via SPAC. And we want to welcome into the stream right now, their founder and CEO, Bill Gross. Congratulations on that. We were talking, by the way, everybody, Bill and I, during the commercial break, and he was commenting about the discussion we had with Bob Iacchino just a few minutes ago regarding nat gas. I want you to finish what you were saying, because you're a clean energy play, and some people don't consider nat gas necessarily clean. So what was the point you were making to me in the commercial break?
Well, there is a huge energy transition going on right now. Think of the Industrial Revolution, the digital revolution, and now the renewable revolution. This is probably the biggest of all of them. And all of the customers that we're selling to, they're the heavy decarbonization challenging companies. The mining companies, the steel companies, cement companies, they use 36% of the world's energy and make 36% of the world's emissions. And they burn fossil fuels and they burn natural gas. So when natural gas goes up, it makes them even more interested in switching to renewable energy, because they can lock in prices now for 20 years. They can make their own energy from the sun to replace burning fossil fuels. They can reduce their CO2 emissions. It's just win, win, win. And I think that's the wind at our backs right now that's propelling us.
So let's talk about what your company does. And when you point out that 3/4 of carbon emissions come from non-electricity sectors, manufacturing of glass and cement, plastics, how does Heliogen help clean the world, but also provide the necessary energy input for those kinds of manufacturers?
I think people don't realize how all the materials in our life, the materials in our iPhone, the materials in our cars, our homes, our roads, all come from energy. The energy that is input into those comes from fossil fuels. We can replace that. So how do we do that? We concentrate sunlight with thousands of AI and computer-controlled mirrors to a very, very high temperature, over 1,000 degrees centigrade, almost 2,000 degrees Fahrenheit. We then take that thermal energy and deliver it to these customers who need that energy to make the materials that we live with. And by replacing the burning of stuff with the concentrating of sunlight, we can do it completely carbon-free. That is why this is so big right now. All these companies have made commitments to reduce their carbon emissions. Some say 30% by 2030 or 40% by 2040. Well, after they make those commitments, they look for a way to do it, and then they reach out to us because we're the solution for not burning fossil fuels to achieve that.
This is a Luddite beginner's question for you, but we have very cool video we're showing. I want to ask the tech team to run that video that shows the mirrors that reflect the sun onto the tower, which controls, is it nitrogen or is it some other kind? Is it helium that you heat to an incredible degree? And then how do you turn that now heated element into energy? And the other part of that question is, do I have to set one of these things up next to my manufacturing plant, or do you generate electricity that you can then send to these facilities?
So the mirrors are concentrating the sun's rays from hundreds of acres to that single spot at the top of the tower. At that point, we make very, very hot air or hot rocks or hot sand. That's so we can store that energy in basically a thermos, a large tank. We store that energy so we can produce energy at night, because all of our customers run 24/7. Big problem with renewable energy is it's intermittent. We solve that intermittency problem by having storage. But then to give the customer the heat, the way you asked, we have a heat exchanger that then takes the thermal energy that we've stored and delivers it directly to their industrial process. So we locate these facilities right on their premises. We call it behind the meter. It's right on their location. Or we can make green hydrogen with this energy. And once you make green hydrogen, you can transport it. And that's really exciting for the future, be able to make energy where the sun is good and transport it to where the sun isn't. Very exciting for the future.
The emission from hydrogen, if I'm correct me if I'm wrong, it's water. So
yes.
What I'm thinking, though, looking at what you're doing, if I'm a manufacturer, this is going to be a boom for places like Arizona, desert climates, or is the kind of thing you could put in upstate New York?
We can put this anywhere, but of course, it's more cost effective where the sun is stronger. So we're focused on the Southwest United States and Western Mexico. We're very focused on Australia, which has a huge amount of sunshine and a huge amount of land and is really excited about exporting green hydrogen. And also Chile. Chile has the best sunshine on Earth. But eventually we'll move to South Africa, North Africa, Middle East, and even to New York. As we work our way to places with lower and lower sunshine, the cost goes up ever so slightly. But we have so much land available, millions of square miles available where the sunshine is incredible and the energy demand is high.
The Marilyn McCoo in the fifth dimension, Let the Sun Shine, and you are capturing it and making that a hit again. Bill Gross, the founder and CEO of Heliogen, all the best to you in the coming year, and congratulations on becoming a public company, one of the milestones of 2021. Wishing you the best in the new year. When we come back, we're going to get set up for the closing bell, the last trading session of 2021. All right, 8 minutes till we end 2021's trading year. Jared Blickery, how are we setting up?
Well, we're setting up to end the year on a slight down note, and I want to take a look at the Wi-Fi Interactive. By the way, this was somewhat expected, albeit we are in the midst of the Santa Claus Rally, which extends to the two first trading days of the following year. That would be Monday and Tuesday of next week. The last day of the year tends to be bearish, and that has been the case, the average and the median over the prior 20 years. So par for the course right here, but we're not looking at major losses. And I do want to take a look inside the market. NASDAQ 100 looking a little bit bearish now, especially the mega caps. Facebook down 2%, Tesla and Amazon each down 1%, but not seeing a whole lot of dark red or dark green, meaning we don't have too many outliers here. Here's a sector action today. We got staples, industrials, materials. Those are the big outperformers to the downside. Communication services, talking about that Facebook loss, that's part of that. And then tech and healthcare. So kind of an arbitrary mix, it seems, to end the week. But here's a 5-day look. And we're going to do a whole year retrospective after the bell. But here's what happened this week. Real estate and utilities, kind of the top two sectors here, looking a little bit defensive. Real estate, though, the second best performing sector of the year in the S&P 500, also set for, let me see, I think this is going to be the best year ever for real estate. That is correct. Also, utilities a player here, staples, so a little bit defensive this week to the downside, or excuse me, utilities and staples looking a little bit defensive to the downside. Communication services, that is down 0.4%. Tech, not too far behind, but it is in the green. So as we finish the year here, I do want to take one final look at the travel sector. This is a 5-day price action. I'm going to dial this down to a 1-day. You can see the cruise lines still under pressure, as they have been all week. Carnival Cruise Lines, that's down 1.7%. Norwegian off a little bit more than 1%. Airlines, kind of a mixed picture. We got American Airlines down 0.5%, Southwest Airlines up 0.2%. And then the hotels, Hyatt up 1%, coming off that record high that we were talking about the other day. Hilton also coming off a record high from earlier in the week. That's up 0.7%. All in all, been an eventful year, and we're going to recap everything after the bell here, guys.
And make it official once it's in the history books. It will be in the history books in less than 6 minutes. So let's take a break, and then when we come back, we'll meet our panelists on this final trading session of 2021, and we'll go to the closing bell. Okay, we are in the final lap of the trading session, final day of 2021. And to help us make heads and tails of what we've witnessed this year, we're going to be steered by Nancy Dowd, Ameriprise Financial Private Wealth Advisor, and Terry Sawchuk Wealth Founder. Good to have both of you here. Nancy, let me start with you real quick before we get to the closing bell. In a year where we've watched the S&P 500 go up 27, not sure where it's going to settle, but up 27%. As a financial advisor dealing with lay people like us, what's the benchmark we should use to measure whether our advisors have steered us well this year? Should we use the S&P 500 as the benchmark, or is there something else we should consider?
Well, the benchmark has to do with how one is allocated. If you're 100% correlated to the S&P, then you should be performing just as well as the S&P. But if you're in a balanced portfolio, it's very unlikely that you will do exactly what the S&P did. because you will have other parts of your portfolio that correlates to other segments, such as Barclays or perhaps the Dow or NASDAQ. So it really has to do with how one is allocated. But I think it's going to continue, and we'll have a pretty good beginning of the year. And the best advice I could provide would be to take some money off the table, take some money and run. It's been a tremendous year, 2021, and this is a good time to take some profits and capture it so that it can't be taken away from you.
I'm going to use your quote, take the money and run. And when we come back after the closing bell, I'm going to throw that to Terry. Is it time to take the money and run? My favorite quote, which I butcher all the time, is that nobody ever became poor taking their profits too soon. But Terry, I'm going to set you up with that after the bell. So let's take a look at where we're setting up on this last trading session of 2021. And there you see it. You got the Dow now off about 48 points. The S&P 500 is probably going to settle down about 11, 12 points. And we've got the NASDAQ is going to be off roughly 93 points. But something to keep in mind, the sector performance this year, Jared just hit upon this. Going into the day, we were all green across the board in the sectors. For the year, everybody is up. One of the least performing sectors was consumer staples, up 15%. Utilities up this year about 50%. But then you look at real estate, that sector was up 44%. Been an incredible year. Energy up 48%. So those two sectors leading the way. All right, put it in the history books. Here's the closing bell. All right, there she blows. That's the end of 2021. So long. See you tomorrow. Hello, 2022. How are the wife and kids? We look forward to catching up with you. Let's see where we are going to settle today on these markets. The indices are going to go down. The Dow is going to be off less than a 0.25%, but still off about 60 points. S&P 500 will settle down about 12, 13 points. NASDAQ will settle down roughly 96 points, a little more than 0.5%. So let me get back to the guests and talk about what we were just saying. Take the money and run. Terry? We're still up. I mean, that almost 27.5% on the S&P 500, it does seem like a good time to take money off the table. Would that be a mistake?
I think it might right now. And now this is interesting because I do think the market's got momentum, and I think it's going to shift next year. But, the trend following guys will tell you got to let your winners run. And there's probably still some room to go. There's really no imminent danger. I think there's a lot going on in 2022 that we'll get to eventually that is going to be maybe a little on the uglier side. But for now, I think you let the winners run.
Getting back to you, Nancy, when we talk about the winners, who do you think, what sectors perhaps in 2022 will be the winners? Where are we going to be running?
Well, to answer your question, I think the technology will still continue to do very well. Real estate will still continue to do well, maybe not as stellar as 2021. The healthcare sector, as long as the pandemic is ongoing, and we've had 2 variants this year, so who knows what next year will bring, that will continue. But I'd have to say that maybe not get out of the market, but certainly rebalance. Most sectors, most client portfolios have done so well that many of the risk profiles have drifted significantly. And it's time to get back to the right balance that we started out with. I think that's the prudent way to go. And certainly that works much better in the long term, even if there isn't.
Terry, as we take a look, and I am going to ask you a question, by the way. I see the big M behind you, so I know what you're going to be doing tonight. But before I ask for your predictions, I've got to get your predictions for 2022. When you talk about there will be a pullback, you alluded to that when I asked you about taking money off the table. You can never time the market. How do I protect myself, though, if I'm anticipating the pullback? What kind of balance portfolio would I want to be looking at? Because a lot of us are just terrified of putting any money into bonds.
Yeah, so we don't really hold much in the way of bonds. So here's the thing. I think, I don't agree with the statement that the market can't be timed. I mean, you're never going to catch the absolute top or the absolute bottom, but there are absolutely systems that you can use that will help you sidestep the major declines. And one of the issues that you run into is if you go back to early 2020 during the COVID crisis, when it first hit the markets, or go even back to 08, 09, everything correlates to one. So in the beginning, it's the stocks, but then when the problem becomes larger and you get margin calls and other things and a cascade of leverage that comes, crashing down, the bonds get sold off too. And so I think you have to have a mechanism to avoid all that and go to cash or treasuries. That's really what's going to help you hold up in these really, these bigger downturns.
The downturns are what make all of us kind of nervous. And Nancy, having a balanced portfolio protects you. But is this going to be the kind of downturn when we do get the correction that, most of us have lived through those once in a lifetime events now 3 times in just the last 20 years? Or is it going to be the 10% to 20%, or are we going to have a 4th once in a lifetime event, do you think?
Of course, it's hard to predict. If I knew that, it would be very, very easy. I don't agree that we can predict the market. I think there is truly a methodology. There is a method to the madness, but in the end, it's still madness because almost anything could happen tomorrow, and that could change everything that we're talking about. So my feeling is we always have to be prepared no matter what. And prepared means that we are allocated properly for the time frame and the appetite for risk that we are willing to take. So how balanced that is, it's going to be different for each individual.
But when you talk about the homeowners insurance, Nancy, that investors need to have, not necessarily on their house, but in case their portfolios start to burn down. If I were your client and I'm very nervous because I'm the droopy dog with the umbrella over my head all the time, how would you advise the risk averse who I'm seeing these gains this year and it's like, give me my money and I want to go home. The money's not going to do anything though. How do you convince me, you still need to grow it?
Well, anything that you're going to spend in the next 2 to 3 years has no business being in the market at all. Any short-term funds that are going to be withdrawn or used for any purpose at all really should not be in anything fluctuating. It's your later and much later money that is okay to have fully invested because no matter what happens, whether it's a 10% correction or a 20% recession or anything, it does fully come back eventually. So as long as you have the time, then it's okay. But if you're short term, you should not be in it in the first place.
Terry, I'm going to give you the final word on this, and then I'm going to get your thoughts on kickoff at 7:30. I think it's 7:30. When you talk about risk appetite in 2022, do people still have appetite for risk, or is it truly going to be the kinds of people who like to pick stock and the average investor has had enough?
I think, believe it or not, it's central banks all over again. We're going to have one of these inflection points. And I think the markets, there's just a lot of evidence, Adam, to suggest that the markets are at the risk of a pretty significant drawdown. And the question is going to be, again, will the Fed step in or the central banks step in and fire the bazookas? This has been going on since really the year 2000, and the central banks without fail have come in and done this. However, we're getting to the place where it's harder for them to do that. And so 2022 could actually be the year where they kind of step away from trying to drive asset prices up. And if that's the case, your balanced portfolio is not going to help you, in my opinion.
Terry, and then a thought about the game tonight. $9 trillion on the balance sheet. Is that also $9 trillion the spread that you're expecting with the Orange Bowl tonight? Anything you want to say to your fellow fans? Our director's son is a student at Michigan.
All I'm going to say is Happy New Year and go blue.
Nancy, I got to let you get in on this because I'm not sure what school you went to. You don't have anything behind you, but any final thoughts? University of Connecticut.
Absolutely, yes.
All right, both of you, have a wonderful new year, and thank you for joining us. Nancy Dowd, Ameriprise Financial Private Wealth Manager Advisor, and Terry Sawchuk Wealth Founder. Jared Blickery, University of Miami, Jared?
I went to Florida International, so go Golden Panthers. However, I guess I would vote for, I would root for University of Michigan just because they're the other UM, of course, next to University of Miami. Let's go straight to the Wi-Fi Interactive. We want to do our year-end recap for 2021, and I got some stats to share here. Really interesting. I'll go through the majors first. Let's start with the S&P 500, up almost 27% year to date. By the way, the NASDAQ 100 also up 27%, not shown. What we do have is a NASDAQ composite, a little bit less here. That's about 21% for the year. Finally, the Dow is a really big laggard here. If you can call almost 19% year to date a laggard, pretty impressive. Russell 2000, not a major index, the minor index, came in with total returns of 13.5%. Now, I just want to point out, these were not the best indices, best performing indices around the world. The CAC 40 up nearly 29%. And finally, the Tel Aviv market, doesn't want to cooperate here, but there we go, up 31%. So that is actually the big winner. Now, I want to delve into our heat maps here. This is going to be the S&P 500 top winners and losers. So let's see here. Yeah, we got top winners and losers. And not surprisingly, Lucid Motors, up 280%, tops the list, not only for the S&P 500, and this is a SPAC, so I need to get on the right screen here. There we go. This is looking more like what I was expecting. Energy names are dominating the S&P 500 biggest winners and losers. We got the top 10 and the bottom 10 right here. Devon Energy up over 178%. We have Marathon Petroleum, that's up over, or Marathon Oil, that's up over 146%. That's the year-to-date total there. And we also have FANG, that is Diamondback Energy, that's up 123%. XLE, the S&P 500 energy sector ETF, just had its best year ever, up over 40%. Some other names at the top, we got Ford Motors, Bed Bath and Body Works, that's up over 132%. NVIDIA, somewhat of a laggard here among the top 10, but really impressive performance of 125%. But let's cover those names to the downside because we got a couple gambling names filling out the bottom three. Penn, that would be Penn National Gaming, that is down nearly 40%. And then Las Vegas Sands, down 37%, so not the best year for these particular gaming names. We also have Global Payments, that's off over 37. Activision Blizzard, that's down over 28, and the list goes on. I do want to go to the NASDAQ 100. A little bit of confusion on my part before because the top winner here, and not the S&P 500, is Lucid Motors, up 280%. That is followed by Moderna, up 143%. But something you'll notice about a lot of these names, they are well off their highs. These numbers could be substantially higher had we taken them or had the year close at their peak, but it didn't. So we'll look at the trends here at the top. Couple of names that are pretty big here. NVIDIA, that became a mega cap stock this year, more than doubling in price, up over 125%. Also Applied Materials rounding out some of the top movers here, that is up 82%. It's the downside which really catches investors' attention here. Peloton knocking off 75%, 76% of its value this year. Pretty tough story right there. China stocks are represented by Pinduoduo. That's down 67% this year. And by the way, I don't even think that's the worst fare in that particular cohort. And then finally, rounding out the dark red here, we got Zoom down 45%. But if we were to go down the list even further, Splunk, DocuSign, the software names really took it on the chin in the final months of the year. At least some of them did, having a rough go of it. But overall, you take a look at what the trends have been this year. It's been one of winners and losers. The indices doing very well, the passive investors doing very well, but a lot of investors' portfolios this year were not tracking the indices. A lot of times the index would be up 0.5%, 1%, and people's portfolios would be down multiple percent. So it's been a tricky year. I just want to round out the discussion with the sector action. As promised, XLE, the best performing sector of the year, up over 46%, followed by real estate, 41%. Then we got tech, financials, and consumer discretionary rounding out the top. Everything's in the green. Utilities, staples, those round out the laggards, both up over 14%. If I didn't say it before, just want to say XLE, the energy sector for the S&P 500 and the real estate sector for the S&P 500 having their best years ever. Adam.
Let the good times roll. Jared Blickery, Happy New Year, and thank you. When we come back, we're going to take a look at Bidenomics. Rick Newman joins us with the final Bidenomics of 2021, setting up for 2022. All right, we are saying goodbye to 2021, but there are a couple things we have to look at, especially when it comes to the Biden administration. Rick Newman helps us do that with Bidenomics. And one of the things you're pointing out, Rick, is that while the economy is booming, a lot of people don't feel that way. Although I can hear, if I were to say that to some of my friends, they would be yelling at me. Feelings are not facts.
Well, let's look at what happened in 2021. We probably had about 6 million new jobs created in 2021. That is the most ever in a single year in records that go all the way back to 1939. The unemployment rate fell 2.1 points from 6.3% to 4.2%. We have income growth now at 4.8%. Those stats on their own are phenomenal. If you just looked at those numbers, you'd say, wow, the economy is just booming. But of course, that's not the way people feel. And there are two reasons. One is obviously inflation, which is now at 6.8%, highest since the early 1980s. And we just cannot get past COVID. I mean, things are just not back to normal. So voters are grumpy. Consumers can't get everything they want. Businesses can't get everybody back to work. I don't think this is all doom and gloom for Joe Biden, though, because there's a pretty good case that the economy is poised to kind of hit a steady state, smooth sailing, perhaps, if we can get over COVID. Growth rates for the next couple of years are likely to be pretty good. And if we can just start to figure out how to live with COVID, Biden's approval rating, which is pretty lousy right now, might steadily rise during the next couple of years.
But feelings, I don't want to get an argument about feelings are not facts, and yet you talk about if we can live with COVID, and then there are the inflation issues. Do we have a timeline or an example in the past of a president whose approval ratings were so poor, probably suffered defeat in the midterms, but then was able to bounce back?
Yeah, there are several actually. In fact, it almost seems like presidents actually seem to do better in terms of their popularity when they're not doing all that much. So Barack Obama's popularity bottomed out during his second year. That was 2010 when Congress passed the Affordable Care Act, which was very controversial. But it rose during the next couple of years, and it was actually above 50% when Obama ran for re-election in 2012. Ronald Reagan's approval rating in the first couple of years of his presidency were even lower than Biden's are now. He was all the way down around 35% approval. That's dismal. But look what happened to Reagan. The economy recovered. He won re-election in 1984, and he ended up as a very popular president. So, there's not going to be that much legislative activity next year, not as much as there has been this year for sure. And that could actually work in Biden's favor. People will hear less about things likely to pass Congress that they don't agree with. And maybe that could end up being good for Biden.
Switching gears, President Biden has had some big headlines with his counterpart in Russia, Mr. Putin. What's the offshoot? What's going to happen as this goes forward? There's actually going to be another event in early January.
Yeah, this is all about what's going on in Ukraine and around Ukraine. Russia has something like 120,000 troops massed at their what is their western border with Ukraine, Ukraine's eastern border. Are they going to invade Ukraine or not? This is the eastern Ukraine is a Russian-speaking part of Ukraine that some Russians consider part of Russia. So what is Putin planning here? Biden has threatened serious repercussions. We don't know what those would be. Probably not military action, but sanctions if Russia does invade. But I think, Adam, there's a good chance that this is a bit of a feint by Putin, who is very crafty and probably would not be making such a big deal for such a long time over these troops on the border if that was his real intent. So he may be intending something that's a little more sly, such as cyber operations in Ukraine. This is going to be a really interesting story to watch for 2022. And it affects security in Europe, it affects NATO, and it affects the United States directly.
Rick Newman, have a happy new year. Thank you for the update
too,
on Bidenomics. When we come back, got to take another look at how your retirement portfolio is doing, and we're going to do that, getting ready for 2022. All right, as part of our retirement segment brought to you by Fidelity Investments, we want to talk about the strategies and the tax implications of withdrawing from your retirement accounts. And we're going to do that with Larry Swedroe, the author of Your Complete Guide to a Successful and Secure Retirement, also the Chief Research Officer of Buckingham Wealth Partners. Good to have you here on this New Year's Eve. Is it a little too late to be looking at tax planning, especially when it comes to retirement withdrawals on the last day of the year with essentially financial offices? I mean, they've been at home and in bed for a week now, but closing shop in 30 minutes?
Yeah, I'd say you're probably past your bedtime on this one. Yeah.
Okay, but for 2022, a lot of people are going to be looking at what should be some pretty hefty gains this year in their retirement accounts if they're tied to equities. Looking forward, is it, the issue of withdrawals and the tax implications really depend on where you are in the age spectrum, right?
Well, the tax efficient withdrawal is really an important part of the winning investment strategy because you can extend the life of your portfolio by getting the asset location withdrawal right. And many people make mistakes here. What you want to do, the general rule is first take your withdrawals from your taxable account. The second place in order would be is your tax advantage accounts like a 401k or a traditional IRA. And then the third and last place you want to take it from is the tax exempt accounts like a Roth, because you want that to continue to grow either tax deferred or in the last case, tax free as long as possible. And too many people make mistakes and don't follow this order. That's one of the things that I would point out. But generally the biggest mistake I see is that people try to minimize taxes in the current year instead of focusing on minimizing taxes over the lifetime. And sometimes it's better to pay some taxes now if your tax rate is low in order to save taxes in the future.
I am so grateful for your response to that first question in which you talked about how to plan, because I've always wondered, where do you take first as I'm staring at the off-ramp in about 15 years, maybe less? Do you go to the Roth, 401k? Do you go to the traditional IRA? So thank you for explaining that. But then, and I realize this is a question probably better suited for my financial planner on my issues, but a lot of people wondering, when you are exiting, when you're on the off-ramp and you're delaying Social Security, you're going to be forced to take withdrawals from IRA by the government. Does it work against you if you've been a good saver for 30 plus years? And do you get forced out of being able to do a Roth conversion? Does it become cost prohibitive at that point in the retirement cycle?
Well, this is really part of a longer term planning strategy. What we often see, I'll give you a good example, is a lot of people are retiring early. Partly they've been enabled by very strong markets, as you've indicated. And if you're also a healthy person, likely to live long, the best strategy, because it buys you longevity insurance, is to delay Social Security as long as possible. So you would enter what we refer to in my book as a blackout period, where you have little or no income, certainly no earned income, you're retired, you're delaying your Social Security. And what you want to do then is withdraw from your taxable account, number one, but you also want to take advantage of the fact that you're in a low tax bracket now, and you want to fill up the lowest tax brackets, depending upon how much wealth you have. But for higher net worth people, I would suggest at least up to the 24 or 26% tax bracket. Take money out of your traditional IRA and convert it into a Roth, where you then get all of the growth tax free. So you're reducing your RMD, your required minimum distribution later. So that's kind of a good strategy. Live off of your taxable income, take some money out of your traditional IRA or 401k as long as you're in the lower bracket. And you can also take advantage of, if you're in a low tax bracket, to, again, not minimize current taxes, to actually harvest gains and take them if you're in the lowest bracket as well. So there's another opportunity that many people miss.
Larry, we appreciate that advice. A buddy of mine just did the off-ramp, and he's 58 years old, but he's been having the discussions you've been having with his financial planner. He's not touching anything, and he's too young at this point, but it really is about coordinating into the future. Larry Swedroe is author of Your Complete Guide to a Successful and Secure Retirement, and I just have to tell you, I'm envious of my buddy, 58, and he's on the golf course and on the off-ramp. All the best to you and a Happy New Year. Real quick, let's see where we ended the year on these markets before we wish you a Happy New Year. The Dow, the NASDAQ, the S&P 500, they closed down today, but for the year, here's all you need to know. S&P 500 was up 27%. Have a wonderful new year. We're coming up next with influencers.
Michelle DeCaris is the CEO of AB InBev, the largest beer brewer in the world. Prior to being named chief executive, DeCaris filled several executive roles within the company, including president of its China and North American regions. In this episode of Influencers, I'm joined by the AB InBev CEO as we discuss the COVID-19 pandemic and its impact on the beer business, the AB InBev footprint around the world, and what the company is doing to keep up with emerging trends in alcohol consumption. And welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Michelle DeCaris, CEO of AB InBev. So nice to see you, Michelle.
Nice to see you as well.
So you've been CEO since July of this year, and you have, 600 brands, 150 countries. It's a giant company, and I'm wondering, what sort of surprised you the most since taking over as CEO?
So you know that I've been with the company for 25 years. And I think that would be strange to say that something really surprised me. Mm-hmm. But I did spend a lot of time with people, talking to them in the first 100 days. Sometimes people are very busy announcing things, doing things. I took a role of talking to people, listening to them. And then in this area of maybe surprises, what came across very strongly was our people really love the company. really engaged. They really want to advance our strategy and execution. They were really looking forward for us to make some moves. For example, the one that we did with our purples. We had this well-established purpose that served us very well to this point. But at one point in time, I think that we missed the opportunity to evolve because everything around us was moving, transforming, and changing. And our purpose was no longer like as inspiring as it could have been. And with this new idea of dream big to create a future with more cheers, we see now the energy in the office. I'm sure that you walk around, the engagement of people moving up. And this is a much broader umbrella that brings us not only what the category represents to people, which is this nice word cheers, that has to do with celebrations, diversity, inclusion, prosperity, but is also very close to the core of who we are, like a beer company. And this came very well from the conversations with people. Then when you think about talking to investors, to analysts, maybe the biggest surprise was people repeating a narrative around beer declining, beer is not growing, beer is losing share, and without data and without facts. And we just put together this week to the investors a very nice compilation of Euromonitor with like 100 countries showing the last 10 years, the last 5 years, and the next 5 years projection. And the facts are very clear. Like beer had an issue in between 2010 2015 where the category stopped growing and then was even in a little decline. But in the last 5 years, the category is growing globally, very healthy. It's a very big and profitable category. And the forecast from Euromonitor is that will continue to grow in the next 5 years. And even more exciting is that across different categories, beer is the one that has one of the lowest levels of premiumization. And because of the brands we have, you quote very well, we have 500 brands globally, some of the most iconic global beer brands that you see out there. We have a lot of headroom for premiumization in the years to come.
So much to drill down there. I want to ask you about the pandemic, though, specifically in your business, Michelle, because obviously that's rocked everybody's business, including yours. In what way did the pandemic specifically impact your company, and how specifically have you responded?
In many, many ways. I think that every time that I talk about the pandemic, I always start from businesses. They come and go. Opportunities, they come and go. But this pandemic brought some things that are hard for you to deal with. So a lot of people that we all know, they had losses that are losses that you cannot repair. And we are always trying to do everything that we can to be close to these people and have our prayers and our thoughts with them. But from the business standpoint, I think that was very disruptive for the supply chain, especially when you think globally. We had an advantage early on, given the footprint that we have. We saw this happening in Asia, moving to Europe, so we could learn from what was going on. And we prepared ourselves very well with 3 priorities, like the safety of our people, business continuity, and how could we support the communities around us, because we are very local as a beer business, right? So beer happens in the country, in the state, in the city where we have operations. It's either on our breweries or with our wholesalers. We are very close to the communities. And then in doing that, we first used all the resources we had to make sure that our people, they were safe in our operations. And we had like outstanding practices that we used globally to protect our people. Business continued to go on through the pandemic, which was very interesting because the category then proved to be very resilient. And beer is this kind of sense of normalcy, right? So people could not go out, could not go to the theater, could not travel, but they could all go to a grocery store, buy some beer, and have some good time at home cooking or on a barbecue or just unwinding, right? And then in terms of supporting the communities, we did a lot, from building hospitals in Brazil to supporting the vaccination campaigns here or in Africa, to having our teams really partnering with community partners to bring not only normalcy, but also solutions from the moment of the pandemic. And the main disruption that everybody's still dealing with, not only in beer, but across all categories, is supply chain. Right. So commodities prices went up, aluminum disappeared because overnight people stopped going to bars and everybody was buying the convenient packages in convenience stores and groceries. So just imagine resetting your entire footprint to sell more cans than bottles or draft beer. So this is a massive change. And then when you have the reopening, it's all over again on the other direction, right? So now you have cans, then you don't have bottles, then people are struggling with draft beer. But we've been adjusting well. We've been using a lot of data and analytics throughout the entire pandemic to very quickly shift from one side to the other, anticipate a little bit the movements, and have a good service level to the customers.
We'll be right back with more from AB InBev CEO Michel DeCaris. Welcome back to Influencers. I'm Andy Serwer, and I'm here with AB InBev CEO Michel DeCaris. I want to ask you a little bit about the business, and for people here in the United States, you have these iconic brands, of course, Budweiser, et cetera, that people know, but how big is the U.S. in terms of your global business right now?
Oh, it's the biggest country that we have is the U.S., and it's been like this for a while, and a very important one, given the brands that we have, even more important when you think about trends. I think that one of the big advantages of having like a global footprint and be a company like ours is this ability of learning from the good part of our scale. Usually people talk a lot about scale in the past was very good, then became a liability because disruptors can attack you. I do think that there is some beauty on the scale that we have and in the size, because trends, they show up in different places. You see what's happening, for example, in the United States and Canada with this so-called fourth category, right? The intersection between wine, hard liquors, and beer. And a lot of things happening there. Seltzers, ciders, ready-to-drink cocktails, things that we can learn here. Then we have an opportunity to pilot or to partner with some brands. When we get this right, we can quickly deploy this globally with the scale and the footprint that we have. So I think that US is very important, is our biggest country in which we operate, has been for years sliding, and we are in the last 3 years in a good turnaround. So top line is growing. We know that bottom line follows top line. Our portfolio is much healthier today. We have brands growing very well. Brands like Michelob Ultra, Stella Artois, Cutwater. They are really accelerating the transformation and the rebalance of our portfolio in the US. And you put together Canada, which is another North American market, same zone, is doing very well as well. So it's an industry that was in decline for like 10 years. And we had a business in decline for 10 years. Now we expanded our portfolio to this Beyond Beer, and we find ourselves in an industry that's growing with a business that's growing. So huge turnaround, very happy with the results over there.
I'm so glad you brought up that fourth category, because it's so compelling on the one hand, but so confusing. Certainly from a consumer standpoint, I go into a store and I see all these different bottles and drinks, and I don't even know where to begin to experiment. It must be challenging for you to sort of pick your spots, as you say. And at first it was hard seltzer, but as you say, of course, it's blending all these different drinks together. Can you talk about how specifically you're positioning the company there?
Yeah, this is new for everybody.
Yeah.
Of course, I think that if we step back for a second, and I'll give you some information, you tell me how much you want to take. But it's like, when you think about all the beverages, usually you have like 5 to 10% of the volume that is really like the latest innovation. And you think about energy drinks, it's like this. You think about soft drinks, it's like this. You think about water, right? People for years and years thought that nobody could innovate in water because water is water. And we just saw a few years ago the seltzer with flavor and no calories, nothing added, exploded in the US and in some other markets. So there is always like this 5 to 10% of the industry that's innovation that comes and goes. Sometimes some of these innovations, they stay longer. In the alcoholic beverages, though, is very interesting, because what we've been seeing is that this space between wine, hard liquor, and beer is a space that has become like almost like a void for a lot of innovation to come. And when you think from the consumer standpoint, all the categories, they have benefits, but there are some barriers for you to address, right? So think like in a simple way. People have been talking a lot about how sugary and high calorie wine is. After all these years of people only talking about the benefits of wine, people start to pay attention on calories and sugar in wine. When you think about the hard liquor, is this idea that one is hard liquor, so a lot of alcohol. Two, you need to mix, and then people never really pay attention of the amount of calories in a cocktail, but there is a lot of calories there. And a lot of people think about the convenience, because I don't really like to drink the hard liquor. What I really like is the cocktail. But the cocktail cannot walk with me from the bar to the walking, to the mountain, to the barbecue session. In beer, people talk a lot about, especially young people, that sometimes it's too bitter, that they like more flavor, more Starbucks type of flavors. People talk about calories, sometimes in beer. And these new beverages, they've been finding a way to solve some of these issues and to provide a solution to underserved consumers. So think about this consumer that likes cocktails, but he cannot have a cocktail on the barbecue or at the beach. Then you have a ready-to-drink cocktail. We have, for example, Cutwater. Brings delicious cocktail in a can you can carry anywhere. Think about the seltzers, and they bring this flavor from the flavored seltzer, but they don't bring gluten.
Right.
They don't bring sugar, as wine brings. So there is people that go for this gluten-free, no sugar option in seltzers. And the way that we see this shaping up is basically like 3 segments. One that is this very simple, more flavored type of beverage. In the US, they call like malt flavored beverages. You have the limeritas, you have the ready-to-drink bottles with a lot of taste. Then you have one specific that's light and refreshing, where seltzers happened, but you see, for example, in Canada, is ready-to-drink vodka soda, right? So convenient in a can, you know, you control how much alcohol you're having, you can carry whenever you go. And the third one is the more complex, like these ready-to-drink real cocktails that you can also have today on a can, where you can control the ABV, you know that the taste is going to be always great taste, and you can carry and have the cocktail at your convenience, wherever you want to go, in a stadium or in a barbecue. So those are three spaces. We have plays and brands in each of these states. They manifest a little bit different country by country, right? But they are like global trends.
And so you talked about it before, there's always the 5 to 10%, and that this is sort of reflects that thinking. And so does that mean this is here to stay, or is it just the same as it always is, that some of it will stay and some of it won't stay?
I think that's both. I think that these trends, some of these products will stay and will stay for longer because they will find a very good opportunity to solve these consumer problems, and then they will become part of the repertoire. And some of these trends we have seen in the past, they come and go because the product is very good, but doesn't have a very unique place in consumers' mind and in consumer repertoire. Of course, if you think about beer has thousands of years, is always part of people's repertoire, will continue to be very relevant, but as consumers start having more choices, it's only normal that people start trying different beverages in different occasions. So there is no such a thing as a only wine drinker or only beer drinker. So people go through categories for occasions and they switch things around. So this fourth category is a very good opportunity for the beer companies because of the capabilities that we have, right?
And just one last follow-up on this. So where are they taking share? It doesn't sound like you're saying they're taking share away from beer, because you're saying beer is growing, but are they taking share away from wine or hard liquor or water?
Yeah, the numbers are very clear. You look at different countries and different companies providing this, but what we know is that at least 50% of this volume comes from hard liquor and wine. In some products, in some regions, this can be as high as 80%. It's incremental and expands the possibilities of the beer category, and it takes from occasions that are often dominated by wine and hard liquor.
We're going to take a quick commercial break. We'll be right back with more from AB InBev CEO Michelle DeCaris. Welcome back to Influencers. I'm Andy Serwer, and I'm back with Michelle Tequila, AB InBev CEO. You grew up in a rural town in Brazil and studied chemical engineering in college. How did you end up at Anheuser-Busch then?
So I was born and I grew up in Brazil, but my family is half Brazilian, half Greek. So I have somehow lived everywhere that you can name at this point, from Asia to Europe to North America and South America. And in the engineer course that I took, beer was a big thing, not only because people like to drink beer, but because fermentation is a chemical process and was part of our areas of study to study fermentation. So I visited several breweries. I always liked fermentation, yet was not my first job when I left college. At one point, I found this opportunity to join ABI. At that time was Brahma, a local Brazilian company in Brazil. This is 25 years ago. And you look back, a lot of fun, living several different places in Brazil, moving to a position that was Latin America. Then I moved to Asia. I lived 7 years in China, where I had China first, then our Asia business later, moved to global as Chief Sales Officer, then CEO at Anheuser-Busch in the US, which is like life going all the way through one side to the other. And now in the last, let's say 5 months, had the privilege to be leading ABI globally.
Can you tell us quickly what that other job was though?
I worked for a bank actually.
A banker?
Yeah.
Are you going from a banker to work for a beer company? It sounds like a good move to me, right?
Yeah.
Excellent.
It was.
And so you have this global perspective, obviously. How has that shaped your thinking? I mean, people say it's all very local, but you have to have a global perspective running a company with such a big footprint, right?
Yeah, I think that the fact of having the opportunity to work in different places, to live in a house that was very diverse, right? So my father Greek, my mother Brazilian, it always gave me like perspective into cultural differences and how to talk to people and understand what people want to do and value a lot communication. So when I put together all the countries that I lived in and all the places that I worked, it's like a huge collection of tools. Imagine this big backpack that every time that you move from one city to the other, you can always learn something. You add something to your backpack in terms of tools. And at one point in time, you find opportunities to use what you have learned from different people, different cultures, and to have like a different perspective when you analyze things. Of course, locally, you always need this local knowledge to solve local problems. And we are very focused on solving consumer problems and customer problems. And those are the real opportunities to grow our business. You could be very focused internally in what you are doing, or you can have more this outside-in perspective. People talk a lot about empathy today. Right. I think that there is nothing more empathetic than understanding people needs, different culture aspects that they have, try to pay attention on what they want, and then be able in a company like ours to service them with the best products, high quality, great services, and something that they can trust. So our products globally, our brands, are brands that people trust because of our quality, and our customers, they like our service, and we are always investing to deliver better for them in what we can do.
2 quick last questions. 1, do you get to taste and test beer yourself? And yes, no?
You can ask around. So I taste a lot of products, almost all of them before they go to market.
Right. Okay.
And even products that are in development phase, like our protein that I just described, I bring home, I always taste it.
And you can't do that at a bank. And then finally, this is the toughest question. I don't know how you're going to handle it. Favorite one? Come on.
Everybody knows that I love Budweiser. This is one of the brands that I like the most. I have a long history with Budweiser, even before I joined the company. And I love this brand. I had the opportunity to work with Budweiser here in the US, to work with the brand globally, and work with the brand in China, which is a big market for us. And there is others. I like beer all the way. I often say that I'm a beer guy. So there's people that are always hopping between one category and the other one. If I can choose, it's always beer.
Got it. All right, Michel Decaris, CEO of AB InBev, thank you so much for your time. You've been watching Influencers. I'm Andy Serwer. We'll see you next time.